on year, a near 150% surge in silver, and over 50% rally in copper in just the last 1 year, many investors are suffering from FOMO, the fear of missing out. But FOMO investing is not a strategy, which is why this week we are going to do a full classroom on the metals meltup. Yes, that's what I call it, the metals meltup of 2025, which is still continuing, by the way, in 2026. So what is driving this massive price spiral? What is the outlook on gold, silver, and other industrial metals in the coming months and years? And then we ask the experts if there is still some merit in investing in these metals as an asset class. Joining me on the show are Peter Mungwire, CEO of Trading.com, Mrin Agrawal, who's a financial educator and director of FinSafe India, and Kunal Shah, Vice President, Head of Commodities Research at Nirmal Bang. Thank you so much, ladies and gentlemen, for joining in. As you heard in my opening remarks, this is a classroom because this is for the actual retail level investors out there who are watching all these headlines and wondering what happened. Gold and silver have moved like small cap stocks, right? And so here we are. So first of all, thank you very much for joining in. Maybe I can get opening thoughts, Peter, from you first, and then let's hear from Kunal in terms of what really has happened. 50% to 150% price rise. Peter?
Absolutely, Shrubi. Pleasure to join you. And I'll tell you what, if you would have rolled this show back 12 months and we were sitting here, no one would have believed what you have just said as far as that intro. I don't think Jim Rogers wouldn't have believed it.
Yeah.
Because every market analyst was saying possibly you might get 3,500 out of gold. You may touch 3,750 as a long shot. And silver, yeah, all right, let's go to $40. Well, we've touched $84 for silver, as we know. They're the numbers on the chart. I mean, it's just extraordinary. And the overall momentum and appetite, I think, from retail traders, central banks, and the paper market has just been absolutely game on. So I feel as though that will continue very much into 2026, Surabhi, and I'm not expecting any of that heat to come out of the market anytime soon. So that's my observations, and I think strap yourself in. It's going to be one wild year.
All right. So, it's going to be interesting. It has been interesting, probably will be. But Kunal, your thoughts? The thing is, now we know that silver has wide uses as an industrial metal. It's used in data centers, it's used in electronics, it's used in electric vehicles. That all is known. It's been known for years. So what changed in the last few months?
Okay, it's a very good question, and I just like to. It all started last year with one fact that people realize that with every year going by, US is going to find very difficult to service its debt. Because at the start of the year, the US interest rate stood at 4.5%, and their total debt was standing at $37 trillion. So they had to service this debt with the 4.5% interest rate. So that was never going to be possible every year whenever they have to service this debt at a higher interest rate. So the main reason, the main ground for this rally was the rising debt of US at an alarming pace. So the way US debt from 2021, the way it is being every year, $1.5–2 trillion, $1.5–2 trillion, that was absolutely unsustainable. Second, fear of crash of US dollar because of the rising debt level. The way their debt was soaring, so everyone was fearful. What if dollar, loses its value by 10–15% going forward? Or what if the dollar crashes, So that was the starting point, when people started to buy commodities. Third thing, most important, we are living in a multipolar world. We are no longer in a globalization economy. Earlier, in globalization economy, there was a transfer of goods and services to all economies. Now, we are going back towards the protectionism. So everyone is bothering about securing their own supply, okay? Because of the tariff era, which was started by Mr. Donald Trump. So now everyone wants to have a hard asset in their portfolio because the paper currencies are seen losing its value. And when the paper currency are seen losing its value, and that is dollar, in fact, everyone wanted to be in commodities. So that's where the bull run started in 2025. So post-COVID, the fourth reason, there was no incremental growth in the supply of any of these commodities, what we are talking about. May it be copper, may it be silver, may it be gold. So the supply side was weak from last 4 years. There was no major supply side growth which has come in all of these metals, the price of which have rallied. Okay. And now we are talking about the new age demand, which was not there 5 years back, which is the data center demand, battery storage, electronic vehicle, the way the transitions of EV taking place. So it all combined and led to this humongous rally in a price of all these commodities. So you take precious metals, you take base metals, you take, even for that metal, even in last 2 months, even the ferrous metals have started to catch up.
Yeah, yeah.
So all commodities have been moving up, not because the demand was so strong or the supply, but because everyone wanted to be in commodities because of the hard asset. Everyone wanted
Okay.
to own a bit
Own
of
something
commodities
tangible,
because,
yeah. Something
yeah,
that can be
because
an
the
alternate to the dollar, like you're saying. So it really started from
absolutely.
there.
And if you
Yeah.
see what has been going on from last 4 days, what we are seeing from the Fed chairman, from the Walmart, from everyone now is accepting crypto, and crypto is now becoming a reality, where the Fed is saying that we are going to regulate this. This is going
Yeah.
to stay. This is alternative payment system. This
Yeah.
is a simultaneous monetary system. So
Yeah.
they know eventually there is going to be a collapse in the dollar. The debt level every year, if it is rising at $1.5–2 trillion,
Yeah.
dollar is going to collapse one fine
So,
day.
Kunal, for the sake of financial market stability worldwide, let's hope we don't get to that point, the collapse of the dollar, because that will be like Armageddon. But I take your point. I mean, largely there's a lot of fear about what's happening with the US policy, and the way these US tariffs also shaped up over the course of the year. So that's led to heightened interest. Mrin, I want to come to you, and we'll go through each of these metals one by one in a minute. But Mrin, I'm sure over the last couple of months, the last year, you work with investors widely. I'm sure you got a lot of these questions thrown at you. Should I buy crypto? Should I buy gold, silver? Anything beyond Indian equities? Because Indian equities, anyway, were among the worst performers of the last year.
Yes, absolutely. And I think, there's been a lot of trend chasing. And in fact, even now, there are so many investors after the 150% return. The most common question right now is that should one buy silver, or, should one get into copper right now? And of course, we know that it's not easy to get into copper investments in India, right? So, but there's a lot of interest from investors. But I would still say, Surabhi, that a lot of it is driven by FOMO, and a lot of people are really trying to play the catch up, having missed out the rally probably last year.
And that is why this conversation is extremely important, because obviously we here, and viewers of this show, Let's Talk Money, would know that FOMO is not a strategy. We never believe in it. None of our experts ever advise it. It needs to be far more scientific. So Mrin, bear with us. I'm going to ask the commodity experts to go through each of these metals one by one, and then we'll come back to the investing strategy in a minute. But let's take it from the top, gentlemen. So let's talk about gold. So the triggers have been, sort of captured by Kunal earlier, the fear around US policy, what's happening with US interest rates. The question is, can gold still keep rising despite a 60% rally last year? Peter, why do you think so?
Yes, I do believe so. Building on, and Surabhi, building on what Kunal mentioned, I mean, you could discuss this all day as far as the framework, what are the key drivers and the metrics associated. I do believe, if you're looking at far as central bank buying, appetite as far as retail traders, paper market and physical acquisition, yes, I do believe that gold is in its early stages of a bull market. And when I say that, it's not unusual when you see these hyperdrive events that they take a long protracted time to grow. And the overall theme at the moment, I think, is certainly bullish, and that will continue. I look into 26 as a year that you would have to think very closely. If you don't have it in a portfolio or you don't have physical, now's the time to probably say, yes, I want to be a part of it, because the momentum and I think the attraction will be fairly solid going into the first half of the year. I'm tipping by the end of this month around about 47,500, so up about $300 from where it is at the moment. And there is no way that it is not Main Street news, because people are talking about it from 15 years of age all the way through to 90. Male and female, everyone is talking about it globally, and I think that that's very much on everyone's radar.
Okay, so that's a full thumbs up to gold from Peter. Kunal, come in on this. A lot of the targets that I saw, like I said, I think UBS, JP Morgan, Bank of America, a lot of these big global banks, they are calling for 5,000, which is actually not too far away from where we are. But what is your own call? Can one still get onto the gold bandwagon despite the rally?
See, the fundamental of gold is bullish, and a lot of these fundamentals are already priced in. So after the 65-70% rally, what we've seen in gold futures, I think a lot of fundamentals are in the price right now. So I believe that going forward into 2026, we are expecting that gold will continue to remain bullish, but the incremental return will be very less as compared to what we saw during the year 2025. So I'm expecting a conservative 15 to 18% upside in gold futures. So if they are trading at 4,400, 4,700 to 4,750 would be my conservative upside target for gold futures. So it can come the way it is rallying these days. It can come in a matter of 3 months or 6 months also. But I would not believe that one should not aggressively go along at gold, assuming that we are not going to get gold and the way things are going to unfold, because you have to also remember what is in the price. So like the word you mentioned at the start of the show. So now there is a FOMO. Everyone is like, nobody wanted to buy silver at $40 and entire world want to buy silver at $80.
At $80. That's my question, Kunal, really. Between gold and silver, and again, I'm not talking about a speculative trade here, a couple of days. I'm talking about people taking exposure from an investment point of view. Between gold and silver, what looks better?
Anytime gold at these levels. I would not recommend silver to go along at silver aggressively at this level. So gold has more value right now. If you look at the gold silver ratio, that has come down from 105 to 55. So the possibility of this ratio going down to 40 or 35 is very less. And I believe that from here, there can be a possible reversal in the ratio where gold again starts outperforming. So looking at the current landscape, looking at the way there is a fear of the dollar crash going forward, the way cryptos have been accepted in the world. So the entire West, US is after crypto. And if you look at the BRICS, they are after gold and silver. So in this battle of crypto and gold will still be a winner with a moderate gains because it is already outperformed. So gold
Peter,
is my favorite pick.
Gold is your favorite bet. Got that. Peter, gold versus silver. Where would you put your money this year?
I'm erring the silver, and the reason for it is data centers, electric vehicles, and the overall shortage as far as investment over the last few decades has been immense. And so that means that I think the upside for silver is going to keep this momentum going forward. I'm not expecting 150% up from here, but I'm certainly expecting it to be over $100 in the probably 3 to 4 month time frame. And we were at $84 last week. So again, the horsepower that's being created across the silver market, I think is going to actually outgrow gold from a percentage terms leading into 26, Surabhi.
Okay. All right, gentlemen. So that gives us a view on both gold and silver. And as we can see in the house, we've got a gold bull and a silver bull, which explains why both of these commodities continue to shoot higher and higher. We need to take a very quick break. But remember, this metals rally is not just about precious metals. Look at what's happening in the industrial space. Look at what's happening with copper, with aluminum. Again, the same question. As investors, should we take a considered view or leave this to the traders? Back with that after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week on Let's Talk Money, we're not talking plain vanilla mutual funds or fixed deposits or insurance. We're talking metals, because that metals melt up is making investors around the world and here in India sit up and take notice. The question is this just a FOMO trade that we should be away from, or do we need to evolve ourselves in our portfolios and take some exposure? Well, we have three experts with us, Mrin Agrawal, Kunal and Peter, of course, are with us on the commodities front as well. We've discussed gold and silver. Gentlemen, now I want to understand what's with copper or even aluminum for that matter. These other industrial metals which are also shooting higher. Now, Kunal, I mean, with gold and silver, we understand there are a store of value, there's industrial use, there's a whole dollar and Fed element, etc. But copper, I mean, is it how much of it is actual genuine shortage in the market, supply issues, and how much again is just becoming excessive speculation? Where is that line? And what's your view?
So, well, we have come up with a report 2 months back that copper will be the new gold for the year 2026, and we believe that that's going to be the case. The concentrate side of the copper have been weak from last 3 years, and the quality ores have been completely missing from the market. Now, the refined copper, the smelting capacity in China is going to go down. China is following involution policy because of the tariff trade war going on. China doesn't need excess capacity, so they are going to cut down the capacity in copper smelter. So all the copper production in China, the refined output is going to go down. The concentrate output was already going down, and the demand is rising at a rapid pace from the AI, from the data center, power consumption, from the electronic vehicle point of view. So all this new demand is coming and the supply is shrinking. The demand is growing at a double-digit growth in countries like India. So where is the supply? Today, India copper is trading at 10% premium than the LME prices. So in my 20 years of career, I have never seen such phenomenon when Indian prices of copper is trading at a premium of 10% the price of LME. So this is a clear-cut scenario that the shortages are clearly visible, and going forward it is going to get worse. So I believe that the likelihood of copper still doing well. There will be bouts of correction here and there. There will be profit taking. There will be dips. But the underlying strength of copper makes me believe that I will not be surprised to see LME copper at 15,000, 15,500 6 months down the line. So I'm very bullish on copper in particular, then followed by aluminum and zinc and other metals.
So
copper,
Kunal,
very bullish.
Kunal, if a friend or a family member asks you, and again, I use that analogy because we're not talking to the savvy traders here. We're talking to people who are trying to take considered investment calls in their portfolios, which otherwise only perhaps had fixed income or equity. So for such a person, what are the options? I mean, what is the realistic upside you'd see, say, over the next 1 year? And in India, I don't know if multi-asset funds have enough exposure to copper. Is there any other way? If you're so convinced that copper fundamentally is looking good, then how can one take exposure?
So either you create a long position in the MCX future, number one. Number two, you invest in a multi-asset fund. Like there are funds like ICICI Prudential multi-asset fund, which do actively invest in all of the commodity futures, including copper, including silver, gold. So those kind of funds where they are taking exposure in, so that will give a good exposure towards this metal. We don't have copper ETF in India, so that remains out of question. And as far as the copper producing stocks, that can be an attractive option also going forward. So these are some active
options
and passive ways to invest in copper.
Got it.
And I think the best one is to go long in the M6 futures.
Okay, all right. Mrin has been listening to the commodity experts very, very patiently. And Mrin, I mean, you got to feel a bit convinced, right? I know when we started the conversation, Mrin was like, look, don't get into this FOMO. It's probably FOMO. But the gentlemen here have outlined a lot of fundamental reasons, and both are convinced that these metals are going higher. So now I ask the portfolio question. Should one be taking gradual baby steps? If yes, how much? I mean, how do you ensure that you don't get burnt?
Yes, and I think that's the whole point that, while everybody's talking about this, the fact that we could see some really good numbers and we could see some really good returns from all of these metals. But I would still say that, I think it's important that any investor understands that, do we want to add this to the portfolio as a part of our core allocation that we're going to hold for the long term? Or do you want to do it as a tactical allocation, right? And I think that's very, very important. And, from whatever I heard from Peter and Kunal, again, as a financial planner, I would still say that this is more of a tactical allocation. Second, while there were some great return predictions that have come, I think, again, which we see, Surabhi, across the markets, whether, whatever the asset class is, that whenever a particular asset class does well, a lot of people just jump into it thinking that they're going to make similar returns. And I think they did, kind of point out that, of course, you can't expect 150%.
The same returns, yeah.
Which Peter pointed out, but he did mention that you can expect good returns, but I think it's always good to go with the average returns in the long term. So whatever asset class you get into, let's say you're thinking of getting into silver, for example. Again, be mindful that after 150% increase, you could get some corrections. That's the first point. The second thing is that in case if there is a correction, do you actually have the ability to hold on? Because this is what we typically see, right? That people get in and then there's a correction and they feel upset and then they get out. And the correction, nobody knows, right? I mean, you could correction for some period of time. With the way things are changing in this world, nobody can...
Mrin, that's a great point you brought up. Let me actually take that back to the experts, and unfortunately we're running out of time. But Mrin brought up a great point. While the projections are still, northwards of whatever levels, current levels on these metals, Peter, last word with you. Are you expecting sharp corrections given the rally anywhere? And among all of these metals, silver, gold, aluminum, copper, which would you still be most bullish on? And what is the downside risk? What is that drawdown that investors better be prepared for if they're entering now?
Surabhi, in commodity markets, it's not unusual to see washouts. We could see 10 or 15%, 20% be stripped out very, very quickly. That's not unusual. But the overall theme moving forward, I think, is going to be a very solid year for the industrial metals, precious metals, and some of them could rally 40%, 30%. Others might rally 60 or 70%. So not the rising tide doesn't lift all boats at the same time at the moment, because some of those markets have performed incredibly well. But there are sleepers out there, the likes of aluminium, the likes of zinc, that will probably have better upside, possibly in the second half of 26 versus the first half.
Okay, that's interesting. I think the takeaway from this conversation is that it's going to be a roller coaster ride. There could be potential upsides, but you need to judge your own risk appetite and your holding capacity. Are you willing to ride that roller coaster without getting burnt out? I think that's the takeaway. Mrin, finally, if someone wants to get into commodities, into metals, would multi-asset funds be the best way forward for you, or would you recommend something else?
Well, of course, you have gold and silver ETFs that are available. But over the ETFs, actually, I would recommend the fund of funds because, we're seeing that the ETFs are trading at a premium. And so, I would just say do the fund of funds. And, it depends on what your allocation is. As such, I'm not really a big votary of the multi-asset fund. So I always prefer if you take the exposure separately. And it's, of course, based on the existing exposure that you have right now in the portfolio.
Okay, all right. Thank you so much, Mrin, Preet, Peter, and Kunal. This has been a very, very helpful conversation at a time when you feel almost dizzy, given the heights at which these metals are trading. But it sets us up with more perspective for, of course, the ride ahead, which promises to be a pretty interesting one, as you've all pointed out. Thank you so much for joining in, and we look forward to more such conversations during the course of 2026. Thank you for watching.
Let's talk money.
Typically, a 60-year-old going into retirement was thinking about how do I give back to my children or leave more for my children. It was never about how do I take care of myself.
Having done this for 15 years, I'm now starting to see this demography wanting to spend. The pie has increased. I think the wealth that India has seen and the wealth that the current 60-year-olds hold, they're not having to make that trade-off.
As we look at this longevity debate, Tara, I want to understand how you're viewing it.
I think it's almost too short-sighted to think that you can, twist and play with the fundamentals of how life is going to work. We want to make the years that you are alive physically, as joyful, as healthy, and as happy as possible. Forget even for a minute the 350 million people over 60. You take 1% of that. Who is going to care for them? My nickname growing up was Granny. So I think I always...
Why were you called Granny?
I was always older than my actual age. I think I behaved older. I thought like an older person. And then I got into the senior care business. So it's clearly proved everybody right that I am inherently a lot, I think, older.
Old soul.
An old soul.
India is aging faster than it is prepared for. According to reports, 11% of India's population today is 60 plus, and by 2050, this number is projected to be double to almost 21%, which means that 1 in 5 Indians will be a senior citizen. Longer life expectancy, smaller families, dual income households mean more seniors are living alone. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Joining me on the program today is somebody who has been on Young Turks and is trying to address the problem of what we do for senior care. We put the spotlight today on Antara Senior Care Company that's reimagining senior care, not as a charity or custodial living, but as a structured, scalable business opportunity built around dignity, wellness, and continuity of care. Tara, it's wonderful to have you back on Young Turks, and thanks very much for joining us here on Reloaded.
Thank you. So happy to be back.
So 15 years now, Tara, of doing this, but I want to understand from you, as you look back, this was a space that had a whole bunch of societal sort of stigma attached to it. Nobody wanted to even talk about the possibility of setting up senior care homes because the idea of sending your loved ones to a senior care home, courtesy Bollywood and all of that, was just traumatic. But has that changed, and how much has that changed in the last 15 years?
It's absolutely changed. I remember walking into a room for the first 2 or 3 years of starting Antara and always having to push the conversation and having exactly that reaction, saying, oh, you're making an old age home. I don't want to live in an old age home, or I don't want to send my parents there. And I feel when we started Antara, we were very clear that this is going to be more than just senior living or retirement living. We wanted to be a brand that people thought of as they got older or had loved ones who were getting older. And so when COVID hit, and at that time, we had the one Antara Dehradun residential community, and we had launched our second vertical care homes. I think that changed the game and the narrative for us. People started believing in wellness a lot more. They understood that as they get older, they need an ecosystem to support them. And so when I walk into a room now, especially actually the last, I would say 2 years, investors, organizations, corporates, and even people looking at starting new businesses have been talking about this space as a whole. So it's very exciting.
So it took the pandemic for people to understand the use case for a business like yours.
I think it did. And also by then, I suspect that because we had done things the way we had done things and people had something to engage with as a concept or a product or a service, it changed their mindset as to what the concept could actually be. And it took that much time for us to prove ourselves. And then for other players also to start seeing, hey, this could possibly be a benchmark for the narrative to change.
But let's talk about the business case of this now. And, Max Holding is the listed entity. Antara is a part of that. As you look at your expansion plans, as you look at building this out pan-India, if that is in fact the aspiration, what do you think it's going to take for you to be able to do that?
So Antara is 3 different business verticals, and I want to create that distinction because each one will have different opportunities and challenges. So the first with what we started was what we call senior living, retirement communities. Dehradun was the first. We then launched a project in Noida, which is fully sold out. And then we did a partnership with Max Estates for Gurgaon. And so in that ecosystem, now I feel what it's going to take is just us being aggressive and finding opportunities to grow. And the pathway to that is 1.5 million square feet a year of commitment, which will over the next 8 to 10 years give us 8 to 10 communities. I think there's a huge opportunity there. And so really it's just about us being aggressive and saying who can we partner with, because we as Antara will not go buy land and do all of that. We want to partner with people who have the land, who have the expertise of construction, but we will bring the expertise of design, sales, and of course, eventual operations. The second vertical is what we call care homes. That's sort of the sort of colloquial way to explain it is assisted living, short-term and long-term. There, I think there are going to be three things that are going to push us. We have 500 beds as of the next 2 weeks, in Bangalore, Chennai, NCR. A is going to be finding infrastructure that allows us to retrofit and move quickly. And that has been a challenge, and I think will continue to be, because we know compliant infrastructure in India is a challenge. 2 is insurance, which has also started to get unlocked. For insurance players to potentially think of assisted living as a focus product, or even combine it with a healthcare product, is going to be the big unlock there. And 3 is actually going to be just awareness, which again, we're starting to see shift because it is category building as well. AGZ, which is our newest baby on the block, D2C platform for products to really help people with conditions that are chronic and age related. I think that's been the most quick to market and the most exciting. And I think the challenge there is just to keep our metrics of ROAS, of margins, and hold those very, very tight so that we can play the long game there.
So let's unpack each one of these, and let's start with the first, which are these residential communities, courtesy Antara Living, that you're creating. Now, typically, who are the people who can afford to be at an Antara Living facility? I mean, how much does it cost? And when you talk about building out an ecosystem of partners, because you don't want to buy the land, you don't want to get into actual construction, you essentially are managing the property for somebody, who would typically be interested in partnering with you? What have you seen so far?
Yeah. So I think who is buying is, we actually have 2 variations of the product. When we launched Antara Dehradun, it was almost product first. We had a dream. I had a dream, a vision, and that was what it cost. And we tried to find the market that would buy it. After that, I said, look, I think to make this a scalable business, I have to think customer first. I have to think, what are they willing to pay and what are they willing to pay for? And that's how Noida came about. So 2 very different price points. The thing that stays sacred amongst all of our communities will be our deep mission to impact quality of life. So our services don't change, but I would say the per square foot cost between Dehradun and Noida and then
It's very different.
Is different. So example, today, Antara Dehradun is reselling at 26,000 rupees a square foot. We launched also back then at 100% more expensive than the next real estate comparison. Our monthly charges are 3 times of that. And so that was the big pushback there, and it took us therefore longer to sell. But today, I mean, when I think about the resale value, I'm shocked myself. Noida launched in 2021 at about 9,500 rupees. It's now reselling at 15 to 16,000 rupees. So there's still a 10,000 rupee per square foot price difference there. And we just launched Gurgaon Estate 360 and 361 at 21,000 rupees. So who is buying are therefore people who can afford a ticket size of 2 to 7-8 crores, depending on the size of the apartment they want, and who are willing to pay a monthly charge more than a regular condo, because we pack in a lot more services. And that can vary from about 30 to 80,000 rupees a month, again, depending on the size of the apartment. So that's who is buying. And in terms of the partnerships that we want to create, when we finished Dehradun and looked for partners, it was a big struggle, because why would anybody partner with a concept that was so nascent? They could command velocity as well as per square foot rates of traditional real estate. But as the market has changed and people believe in what we do, they realize that we can command a premium. So we actually sell 15% more per square foot in terms of a sales price than anything that's next to us. So now those are the partners who say, we want to diversify our portfolio. We believe in the senior care spaces being high demand. And we want to work with an organization like Max and Antara that has high governance and high standards. So far that partnership has been with Max Estates. Haven't had to go too far, and they will continue to be our partners in NCR. And we are therefore looking for partners in the top 5 markets that we believe, which are, Chandigarh, Bangalore, Chennai, Hyderabad, and perhaps even Goa.
2 to 7 crores is the elite market.
Yes.
I mean, it's what you could call premium or what you could call luxury. Is there space then to do anything for the mass market to make this product more affordable?
100%. I actually believe if we are 350 million people over 60 by 2050, there is a market at every price point. The reason we haven't entered that market yet is because we know this market better and we want to play to the strength right now. So in our scale up the next 3 to 5 years, we want to continue to play in this price point.
So what have been some of the big learnings, of the last 15 years in terms of customer behavior, in terms of customer expectation, also in terms of customer fulfillment? Because, so far the Indian marketing community or the Indian sort of entrepreneurial community has been servicing the demographic dividend, because that is what we have been accustomed to believe, that India is a young market, India is the youngest democracy, and so on and so forth. For the silvers to open up as a market has been a fairly recent phenomena. What have been some of the learnings on account of it?
So having done this for 15 years, I'm now starting to see this demography wanting to spend. In the early years, it was still it was a previous generation of 60-year-olds. And so when we were selling, there was always a hesitation to spend on yourself.
Yeah.
And spend on yourself with wellness. That was something that just didn't exist. So what was our fundamental offering in Antara, Dehradun as an example, was, a beautiful place to live. What we believe was also beautiful infrastructure, and a promise that as you get older, the services would kick in to keep adapting to those needs. And so 10 years hence, the population is 10 years older.
Yeah.
So those who moved in at 62, 63 are now in their early 70s. And we have a fair amount of people over there living that are over 80. So I think the expectation now is that we want the wellness and what we call life care elements to kick in. And that was always the vision and the promise. We were never going to be an offering that said beautiful place to live, great food, learn a language, socialize with each other, do yoga, go for a walk. That's hygiene now. Now it's all about the wellness in terms of care, not just wellness in the way we know it today, but care. And so I think what sets us apart is that we will always be the player that looks at the longevity and long-term care of our communities. So whether it's the quality of the food that we serve, or the nursing, or the doctor care, or the way we do preventive care, or the physical aspects of it, for us, the expectation has now become care, and we're ready to fulfill that completely. And people are willing to spend on it as well.
It's interesting that you said that typically a 60-year-old going into retirement was thinking about, how do I give back to my children or leave more for my children? It was never about how do I take care of myself and my needs, or invest in myself and my needs. It was almost as if, as you get to 60 and as you get to retirement, your life is over. And now you're seeing that change. What has been the big surprise element there for you?
Two things. One has been, I think the pie has increased. I think the wealth that India has seen and the wealth that the current 60-year-olds hold, they're not having to make that trade-off. So they are being able to say, we are going to fulfill our obligations to our children. We're well healed enough to be able to take care of them as well as take care of us. And early on we would see actually next of kin come in the way of taking this decision, because they were worried about what would be left for them.
Yeah, you're taking away from my share. Yeah.
But that has also changed, because I think when the next generation is also done well and created financial autonomy and independence for themselves in the India ecosystem, which is, furthered everybody's economic prosperity, that level of insecurity doesn't seem to exist that much anymore.
Or is it less so? I mean, less insecure, I would say.
Less insecure. Also, Shireen, the truth is we are also in a position where we're talking to a certain type of consumer and customer.
Yeah. That's what I said. I mean, you're talking to a very discerning, very elite, audience. They don't have to worry about writing out the next check.
Exactly.
That's not what their concern is.
Exactly. So therefore, we get to see the benefit of that shift. I would assume that in other sort of economic, demography, it would be a different type of conversation. And like I said, maybe I'll unlock that later. But we are seeing just a more, I think there's a generosity to oneself that is starting to happen, and it's wonderful. And why not?
No, absolutely. I couldn't agree with you. Why not? Yeah, absolutely. But as we look at this longevity debate, Taran, I want to understand how.
US futures are under pressure this morning after a positive close last Friday. This after the Department of Justice has opened a criminal investigation into Federal Reserve Chair Jerome Powell, an escalation by President Donald Trump of his attempt to pressure the central bank. Asian markets have started the week on a positive note, though, while the GIFT Nifty is indicating a subdued start for our own markets. Oil prices are up for the third day running as markets continue to weigh geopolitical risks. Gold prices are also up more than 1% amidst heightened geopolitical tensions and expectations of further interest rate cuts. In confirmation of a CNBC TV 18 news break, Lemon Tree Hotels has approved a strategic reorganization of its business and a fresh investment by global PE firm Warburg Pincus in its subsidiary Fleur Hotels. Warburg Pincus is set to acquire APG's entire 41.1% stake in Fleur Hotels with an investment of up to 960 crore rupees. And earnings season begins today for the Nifty 50 companies with bellwethers TCS and HCL Tech reporting numbers after market hours today. TCS's dollar revenue growth is seen growing 0.3% from last quarter. Meanwhile, HCL Tech is expected to rise 2.7% on a sequential basis. SEBI Chairman Tuhin Kant Pandey indicates that the process of granting an NOC for the NSE IPO is nearing completion. Although he did not commit to a definitive timeline, he said, and I quote, "It may be done within this month." Well, if you ever thought that the weekend was a quiet one, make no mistake. It promises to be an action-packed day and an action-packed week. At that, you're watching Power Breakfast right here on CNBC TV 18 in the Mumbai News Centre. I'm Hormis Fatakia. Let's first take a look at how the Asian markets have started off this morning. And contrary to what the Dow futures are doing, the Asian markets are still relatively positive as we speak. The Hang Seng is trading with gains of around 0.25%. The Taiwanese index, which was underperforming last week, is also trading with gains of close to 1%. The Japanese markets are shut today on account of a holiday. The Kospi trading with gains of over 1% as well, and the Shanghai Composite is trading just above the flat line. Meanwhile, the Dow futures too have seen a marginal recovery. They were down around 200, 220 points. Now they are down 150 after the criminal investigation launched against Fed Chair Jerome Powell. We'll speak more about this as the show goes by. Pull up the GIFT Nifty to give you an idea of how our own markets are likely to start off. Well, nothing much to write home about here. The implied open is suggesting an absolutely flat start after the worst week that the index had in over 3 months after the fall that we saw over Thursday and Friday's trading session. But to set you up for today's trade, our research team is here with the stocks that should be on your radar and of course the FNO side of things as well. But before that, let me tell you about some of the important things that you need to watch out for today. As we mentioned, it was a forgettable week for the Nifty bulls last time around. It was a 2.5% cut on the index. The broader markets too fell in line or maybe even worse than the benchmarks. The small cap index was down over 3%. The Nifty Bank, a marginal outperformer that was only courtesy of ICICI Bank, that gained from Monday to Thursday only to decline on Friday. But it is a very important week that lies ahead for our markets, and that's because earnings season begins in full flow. TCS and HCL Tech report results today. Most large cap IT names report results this week. Reliance Industries reports on Friday. HDFC Bank, ICICI Bank report on Saturday. So there is no dearth of any cues that you need to watch out for in the course of the week. Now, after the fall that we saw, the Nifty is now well below its 50 DMA as well as its 20 DMA. It's closed below that 25,700 mark as well, which was the low point of the range, that 25,700 to 26,200, 300 range that it found itself stuck in for a better part of the last 2.5 months. So 25,600 now on the downside is an important level, and for the Nifty Bank, 59,000 on the downside will be an important level to watch out for. It's just around 250 points away from those levels. Of course, it was a very broad range on Friday for the Nifty. 25,620 was the low, so that becomes the first important level on the downside. 25,940 on the higher side, so that you need to keep an eye out for. There is no dearth of activity in the primary markets though. Bharat Coking Coal's IPO was subscribed over 8 times on the first day. So, and as of now, the GIFT Nifty is indicating a subdued start as well. So it is in a wait and watch mode is where the markets currently are. Over to Sudarshan. He will tell you all the important cues that you need to watch out for from the FNO space. Sudarshan, good morning. What's the FNO data indicating now, considering the kind of sell-off we have seen over Thursday and Friday?
Good morning, Harma. Just a few trading sessions ago, if you remember December when it was a record high level that we had hit for majority of the indices. Nifty had hit the record high of around 26,370, and from that level, we are down more than 700 points. And now we have seen the broad-based fall across the market and mainly courtesy FIs selling. Now also FIs, if you take long exposure, it's at multi-year lows. Now the longs exposure has fallen to 8%. If there are two silver linings, one, that is the PCR put call ratio, we remain in the oversold zone. On Friday, it was 0.62 from the earlier level. We have slipped. Earlier level was 0.68 or 69. Second, while we have been seeing selling in the stock futures and the index futures, on the option front, we have been seeing buying. On Friday, also in the index futures, while it was a FI selling of almost 3,200 crore, but if you go to the option side, there was a buying of more than 14,000 crore. Talk about the exposure, yes, it has slipped to 8% with FIs, reducing the long positions by more than 1,100 contracts. Also on the short side, they continue to add. On Friday also, they have added more than 17,000 positions, and with this on the short side, their exposure increases to 92%. On the option front, major call writing was seen in 25,800 and 25,900. On the put side, two most active options, 25,400 and 25,650. So first support level for Nifty would be around 25,620. If it falls below that, then next support comes around 25,540. That is 50-day moving average. And resistance would be 25,960. That's the 50-day moving average. Two stocks remain in the band, SAIL and Saman Capital. I'll keep an eye on few stocks. On Friday, there was a big fall in the Manappuram. I won't be surprised if there is a recovery in that. And second, after Q3 earnings, keep an eye on Avenue Supermarts, or better known as DMart.
Oh, yes. That'll be the most important stock to watch out for today. Sudarshan, thank you for that update. Now, the other big story has been the remarks from SEBI Chairman Tuhinkant Pandey, who indicated that the process of granting an NOC for the NSE IPO is nearing completion. Listen to what he had to say.
I think we are at very advanced stage of issuing the NOC for NSE IPO.
When can we expect?
Maybe within this month.
Now, the SEBI chairman also commented on the further course of regulatory action in the derivatives market. Here's what he had to say there.
In the derivatives, we have taken a number of measures, as you know, earlier, first in October 24, and then in May 25. And the last of the measures got kicked in December 25. So we are looking at the data. And after the data is there, we will be able to define our next course of action. So at this moment, I don't think that we are going to disturb anything.
Take a short break, get you all the updates from the White House on the other side in our special segment, Trump Watch. Stay tuned. Welcome back. The big story of the morning has been the futures on Wall Street that have declined after the Department of Justice opening a criminal investigation into Federal Reserve Chair Jerome Powell. The move comes as an escalation by President Donald Trump of his attempt to pressure the central bank. The Fed chair called the action a pretext aimed at further pressuring him over a dispute with Trump over interest rates. Listen into what he had to say.
On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people.
Now, in what could give further impetus to US President Donald Trump, the Supreme Court of the US did not rule on Friday on the legality of his tariffs. The court rather issued the opinion on its decisions, indicating that additional opinions could follow over the next 2 weeks after returning from its holiday recess. Getting you the latest on the Donald Trump related developments further, Vinny is here in our special segment, Trump Watch. Vinny.
Hi, good morning, Horma. So starting with all the updates that have come in over the weekend, the important one, Trump stated that the United States has seized an unauthorized oil tanker outbound from Venezuela, redirecting it and its cargo through their new energy deal. He also declared and added that end to Venezuela's oil and money flows to Cuba after the United States strikes killed their security agents, positioning America as Venezuela's protector. Moving on, and separately in a separate post on Truth Social, Trump announced that Venezuela has begun mass releasing political prisoners. He credits U.S. intervention and warned the freed individuals to remember America's role in capturing Maduro or face the consequences. Moving on, Trump met with top global oil firms and executives on Venezuelan oil deals, security of the people, lower U.S. prices, and halting drugs and criminals. So that was an important update that's come in overall on the Venezuelan oil front. Now, shifting focus to Greenland, Trump has insisted on securing the island to block Russia or China from taking over Greenland. He has threatened the hard way if Denmark resists and dismissed their historical claim touting his NATO rival. Moving on, amid the political unrest in Iran, Trump posted on Truth Social and said that the United States is ready to help as protesters in Iran face an intensifying crackdown by authorities of the Islamic Republic. And he also said that Iran is looking at freedom like never before, and the United States stands by them and ready to help them. Now, moving on, Trump declared a 1-year 10% cap on credit card interest rates that come into effect from January 20th and called it an affordability relief that came in for his people. Lastly, Trump has credited his $200 billion bond buy authorization for boosting housing affordability as mortgage rates have fallen to 5.7% from Biden's 8%. So that's all the update that we have coming in on the Trump Watch segment today. Back to you, Hormas.
Oh, yes, there are plenty of updates to track from Wall Street, from the White House. It promises to be an action-packed week on Wall Street as well, considering the slew of economic data and the earnings season starting there as well. Speaking of Wall Street, it was a positive session there as well. The Dow is now just 500 points away from a record high. The S&P 500 also made new records. It's 30 points away now from that mark of 7,000, while the Nasdaq also ended with gains. And that's after the jobs report, which was below than estimates, while the employment rate, the unemployment rate, inched lower to 4.4%. That was better than expectations. Here's some opinion now from Allianz Chief Economic Advisor Mohammed Al Arayan on the jobs report.
It is okay for where we are in the cycle. In fact, relative to expectation, as Sarah said, there's something for everyone in this report, and it's no drama. And it reinforces the notion that Chair Powell has that we are well positioned to wait. The big issue in my mind is that increasingly we're seeing employment decoupled from output. And you had Kevin Hassett on earlier, and he said it's all about productivity, and it's going to raise three issues. One is who gets the benefits of this productivity? Does it go to companies or does it go to the workers? And this is really important because the second issue is affordability. This is a real issue. It has economic, political, and social aspects. And then third, I think the inflation number next week is going to be even more important. So no drama relative to expectations, but it highlights these bigger issues that we're going to deal through this year.
I'll take a short break. Cues from the commodities market on the other side. Stay tuned. Welcome back. Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. No dearth of action there as well.
Oh, yes, absolutely. Especially with the dollar index declining as criminal investigation on Fed Chair Jerome Powell puts independence of Fed into question is one of the major factors today morning that has led to a lot of movement in various asset classes. So, yes, we have gold hitting all-time highs at $4,600 an ounce. Silver also gained almost 4% in Asia to hit $83 an ounce. We've seen 84 on the higher side as well. The weaker than expected U.S. payrolls data at 50,000 versus market's expectation of 66,000 also seems to be supporting the metal prices. But it's not just precious metals because almost all tangible commodities seem to be doing quite well. So while last week wasn't so great for metals, where we did see profit taking by the end of previous week, but today you've seen gains come back. Copper is up 1.5%, zinc, aluminum gaining by a percentage point as well. The markets are anticipating further stimulus from China. Also, China's buying ahead of the Lunar New Year holidays. And then, of course, all of these geopolitical concerns and uncertainties are leading metals to gain better than other asset classes today.
Manisha, thank you for that update there. Take your leave on this edition of Power Breakfast. Thank you so much for watching. Bazaar Morning Call on the other side to set you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, good morning.
Morning.
Hi, good morning. There's so much to track geopolitically in terms of the developments from the Federal Reserve. And this comes on the back of a very painful week for our markets, where the Nifty was down 2.5%, the small cap index was down nearly 4%. So amidst all that noise and the earnings which are expected, how will we perform?
It's up to your IT boys, IT boys and girls, Reema.
But I think they might just be overshadowed by what's happening globally, right?
Possibly.
All right, let's get straight to the action then.
Absolutely. Let's just kick it up and take it from the top in terms of what you need to know as we begin a fresh new trading session. I think, the first news item, of course, is what did not happen. And this is, of course, the US Supreme Court, which was expected widely. And by the way, expectations rose as we went into the end of the week on Friday. I mean, started on Monday, Tuesday, Wednesday, and by Thursday it had reached a crescendo that, well, the Supreme Court is going to rule and they're going to strike down at least all of Trump's tariffs under the emergency IEEPA section, or is at least going to do it partly. Well, the Supreme Court did not publish its ruling, which is, by the way, also a possibility that we put out, that an opinion, but perhaps no ruling. Now, the court is likely to, but I just want to make it clear, not guaranteed to deliver a tariff decision this coming Wednesday. The point is it's coming. So it didn't happen on Friday. Will it happen on Wednesday? Are the markets ready for it? Is it all in the price? I don't think so. Even though it's widely expected, I think if the court does decide to strike it down, and if we get a decision on Wednesday, I don't think it's in the price in that sense. Not in equities or in the rates market as well. The other bit of news flow on Friday was, of course, the US jobs report. And in a way, it had something for everyone, right? The actual absolute number was about 50,000 job additions. The estimate was about 70,000. But the one thing which markets focused on is the unemployment rate, which fell about 16 basis points to about 4.4%. And what that means is that the bar for Fed, as unemployment rate goes down, the bar for the Fed to cut rates perhaps goes higher. So it requires a lot more. By the way, there are 2 rate cuts priced in for this year. And I said it on Friday morning that it would take a lot for those expectations to change. I don't think this jobs data really changes that in any meaningful way. Now, on Friday, you've got the S&P 500, which ended about 0.65% higher. NASDAQ was up 0.8. 2026, it's been 10 days. It feels so much like 2025. US is right on top. It's doing exceptionally well. By the way, silver was up about 5.5% on Friday. Oil prices about 63, but they've been in a $3-4 range now, between 60 and 64. But it feels a lot similar, right? US equities, defense doing very well, precious metals doing very well, base metals at the margin, and of course, emerging markets like Korea, etc., which are also performing very well. Now, the Trump team is, and this is the other thread which I think we will see more and more of, the Trump team is pushing to address the affordability question ahead of the midterm elections. Remember, the midterms are only in November, but look at what is happening. President Trump proposed that interest rates on credit cards be capped at 10%. He said that large financial institutions should not buy single-unit family homes. He's essentially authorized MBS purchases by the government, some $200 billion worth, aimed at lowering interest rates on mortgage, that is home loans. So, and I think there is perhaps that element of New York, what's happened in New York with Mamdani. Affordability is a buzzword in the Trump administration in a big, big way. And I think between now and November, we will see perhaps a lot more. All of this in any other period in time would have been negative for markets, right? This is government intervention into how markets work. But, well, so far markets are kind of ignoring it. At least, there's no durable impact in that sense. Well, the other bit of news flow here for us in India, and we discussed this on Friday as well, Sergio Gore, the US ambassador designate to India, and more importantly, he's very much a part of the Trump's inner circle, is in India now. There was a flash visit. He met a lot of leaders, including Prime Minister Modi, but now he's in India, arrived this weekend and here to stay. And I think, people like, and I said this on Friday, Ashok Malik, etc., have said that this is an important piece of the news flow which markets should not discount in terms of repairing relations between US and India. The other bit, of course, is all that is happening geopolitically. Venezuela, there is Greenland, and of course there is Iran as well. Protests continue in Iran. I mean, the level of international conflict that we have on our hands, perhaps unprecedented at any other point in time. Now, coming to markets here, severe pressure, absolutely severe pressure. The Nifty with 200-point sell-off on Friday has lost about 700 points from last Monday's high. I mean, just looking bombed out. And it's actually even more visible in mid and small caps where there is tremendous pain. But remember, the small cap index, by the way, on Friday sold off almost 2%. I looked at the NSE 500 list of stocks. Only 40% of stocks in that basket, and that's the widest basket we have, are only 40% are even trading above the 200-day moving average. That is the Lakshman Rekha between being bullish and bearish, long-term average. But, I mean, it's an important indicator in that sense. So, mid and small caps, lots and lots of pain. With Friday's sell-off, the Nifty is now exactly at a very long-term moving average, which is the 20-weekly moving average. That number is 25,580. So that's the big support. The Nifty Bank has just broken the 20 days, a very short-term average. The Nifty Bank has just broken the 20-day on Friday, and that level is 59,412. So very tentative, very careful, and I think the only US-India will see whatever happens, and from the global side, I think it's all focused on earnings. If earnings growth picks up in the third quarter, I mean, I think, there will be bids and people would want to look at the market in a more constructive way, which has not happened for a while now. Nigel has walked across to the wall with the positioning and how is it all looking? Nigel, over to you.
Well, at the start of 2026, there were hopes that the FIs actually will lower their selling or, in fact, will turn buyers. No signs of that, at least in the first couple of weeks that we've seen in 2026, because they sold close to 3,800 crores. Institutions, though, that's the DI and the FI put it together, they were net buyers. What's plaguing the Indian markets? Well, one wonders, right? The FI selling is not abating. There's no breakthrough with regard to the US trade deal and also geopolitical tensions all across the globe. And there is a bit of a skirmish on our borders as well. So maybe that's weighing on sentiment out here. But last week, we were rank underperformers with the US markets actually doing quite well. What did the FIs do on index futures? Well, they went ahead and they added close to around 17.6 thousand short contracts in trade. And now the short positioning, if you just pull up a chart in the last week, it's up by close to around 50,000 contracts in the past week. You need to keep in mind that at the start of January, the F&O series, the Nifty lot size, well, that had been revised to around 65 from around 75 earlier. So effectively, we're at those peaks in terms of FI net short positions. And in percentage terms, we're at the highest we have seen all the way since October 2025. The FI's short positions at around 92.5%. Well, that's the highest we've seen all the way since the 14th of October 2025. But if you just see what history suggests, well, at that point of time as well, 10 sessions later, that's effectively between the 14th of October to the 29th of October, the Nifty actually bounced 3.6% on 906 points. The street will be hoping that with these FIs aggressively net short, what we saw recently in October can repeat itself in January 2026. That's the hope out there. And with the markets being so aggressively net short, the bulls will be really grabbing on to this data point. What happens from here on is going to be interesting, though, because the FIs, they're selling in cash market, they're adding shorts, and they're writing calls as well. They wrote close to around 3 calls for every one put position. And the strikes like the 25,800 call, 25,900 call, well, they were getting written very, very aggressively with the premium coming down as well. So one data point is the FIs are net short. The other data point that the bulls will be looking at is the Nifty PCR. That's come down to around 0.62. History suggests from these levels normally we see a bit of a bounce. So that's the other data point that will be actually favoring the bulls to see some kind of a bounce from the lows of the day today itself. Well, the Nifty levels to track, we're trading below the 20 MA, even below the 50 MA. So now all eyes on this vicinity of around 25,500, 25,550. That's going to be important. Incidentally, that's where the 100 DMA comes in at as well. The problem in Friday's trading session was that the Nifty went ahead and broke the 20 DMA. But the good news is, at least Reliance Industries, in Friday's trading session, that managed to defend the 200 EMA. And in fact, it outperformed in Friday's trading session. So I'll keep an eye out on that factor. Well, the stock that I'll be looking at post the SEBI chairman's weekend comments is BSE, because he commented on the derivatives volumes. He said that he doesn't think they need to disturb anything at this point of time. So I'll keep an eye out on BSE. He said this before as well, but maybe some kind of relief on this one. It's going to be an interesting trading session, but the PCR at the lower end and the FI net short positions at the up end, that's going to give some hope for an intraday bounce in today's trade.
Thank you very much for putting that in context. The FI sold 8,800 crore in the cash market, with the FI selling picking up significantly over the last 2 trading sessions. 8,800 crore in cash market selling in the last 5 trading sessions. Let's get to the equity calls then. It's Rajiv Batra from JP Morgan who says, despite the ongoing uncertainty around the trade deal, they expect earnings to grow further, underpinned by last year's low base, policy tailwinds and renewed economic momentum. He says their year-end bull, base and bear case target for the Nifty remains at 33,000, 30,000 and 24,000 respectively. They reiterate their preference for domestics over exporters. Meanwhile, Chetan Seth of Nomura says that the Asian stocks are off to a flying start, with the MSCI Asia ex-Japan index already gaining 3.5% in 2026 so far, driven by solid gains in the AI-themed market like Korea and Taiwan. While the AI have-nots like India and parts of ASEAN continue to underperform. They expect this positivity trend to continue, at least in the early part of 2026, and they expect the MSCI Asia ex-Japan index to hit 1,035 sometime in 2026, and that is an upside from the current spot levels.
Okay, well, that's some opinion, and we'll have some views coming in just a bit. But, well, this happened just, I think, an hour and a half out back, right? Wall Street futures have slipped after Fed Chair Powell essentially revealed, he posted a video message from the Federal Reserve handle on social media, essentially revealing that the Department of Justice in the US essentially has threatened criminal proceedings. This is in relation to his testimony before the Senate over renovation of the official Federal Reserve office buildings. He, of course, saying that, well, this is a political attack and this is basically directed at pressurizing the Fed to lower interest rates. Listen in.
On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people.
And the Dow futures is opening under the shadow of this. What's also important to note is that while Powell's term as a chair ends in May of 2026, he has the legal right to stay on the board as a governor till January of 2028, which means that if he stays on the board as a governor, despite being ousted as a chair or not being the chairperson, he still gets a vote on interest rates. And the question is, will the criminal investigation maybe create a cause or a legal path to force him off the board entirely before 2028. But joining in now is Arvind Sanga, Managing Partner, Geosphere Capital Management, and David Chow, Global Market Strategist, Asia Pacific Investco, joining in. Gentlemen, thank you very much for joining in. Wanted to get your thoughts in. You know, this standoff between the Fed, Trump has been building. We've been questioning whether the Fed will remain independent, but it's sort of hit a feverish pitch right now with this unprecedented video by, Mr. Powell, countering all the statements. How big a risk is this for the markets? Arvind, you want to go first?
Sure. I think the market has been extremely sanguine about everything that President Trump has been doing. But it's clear that, on the one hand, you have a government which, Bernie Sanders or Elizabeth Warren would be comfortable with in terms of threatening people like the defense industry last week. Now, over the weekend, going after the banks in terms of the interest rates that they charge on their credit card fees, and now going after the Federal Reserve. I think there's a risk here that, at some point it might be the straw that breaks the camel's back in terms of market sanguineness about whatever President Trump does having no consequences. And if Fed independence is at risk, that is clearly, market may celebrate lower interest rates on one side, but on the other side, I think it would give real concerns about, inflation and financial depression and other concerns which could cause economic uncertainty. So I think it's really negative, and I think it's very interesting that Chairman Powell has taken a direct stance against President Trump. So it'll be interesting to watch what happens in the days ahead. But, there's also stuff going on the political front in terms of Greenland. And then on the background, there's also stuff going on in Iran. So the world is looking a much more uncertain place. And yet the markets are behaving like everything is hunky-dory, which we are a little nervous about.
All-time high everywhere, right? 26 just like 25. Arvind, hi, morning. David, hi, morning. By the way, there is, as we speak to both of you, there is news coming in. This is Donald Trump. President Donald Trump has given an interview to NBC, and we'll try and get the sound bites out. He says that Iran called yesterday to negotiate, on nuclear. Essentially on, the attempts has been to prevent Iran, to ask Iran to abandon its nuclear program and nuclear uranium enrichment, etc. So I'm assuming this is the context. Iran called yesterday to negotiate. Meeting with Iran is being set up. This is according to President Trump. That's big. If it were to happen. This is, it's almost as though we were living in a real-time video game. It's like non-stop. Arvind, any thoughts?
Well, I'm not sure what to make of it because Iran has denied that it has tried to make peace. But maybe Iran is concerned that this whole protests, which have become very, very serious, they want to cover their flank on the taking the pressure off from the U.S. front. But I'm not sure everything that President Trump says is completely factual. So we'll wait and watch what happens there.
He's you're right. But you remember Arvind and David, last year there was all this talk of taco and this thing. He's completely flipped that, right? I think he took it personally. He's basically doing everything he says he will do. Through and through, is following through. David, your thoughts on the point that Arvind made earlier, which is that markets seem to be unbothered by everything which is happening. It's a highly news flow is also at an all-time high and very disruptive news flow, but markets have been unbothered so far. You think at some point this is going to take a bite out of the strength in markets? All of this.
I would maybe push back against what Arvind said. Are we whistling across the graveyard? Maybe a bit. Is the dollar likely to depreciate if this criminal probe goes through? Probably. Are U.S. assets going to look less attractive? Yes, probably. But in the near term, I think ultimately what matters is earnings. Are companies growing? And I think that that's going to continue to happen this year compared to last year. We have to think about in 2025, everyone worried so much about the tariffs, and it was supposed to be stagflationary, and they ended up not being so stagflationary. In fact, growth actually accelerated in the US better than expected. So ultimately, it's about fundamentals. And I think that fundamentals are going to improve, not only in the US, but in other parts of the world. But I think that emerging markets are looking more and more attractive relative to US assets for a variety of reasons, including this subpoena that was just given to the Fed.
All right. Hi, David. And hi, Arvind. Good morning. Nigel on this side. Well, David, let me take you a little bit forward on that point then, since you're saying that the emerging markets are looking attractive. FIs, they appear to be on a prolonged break from the Indian markets. Is this temporary reallocation driven by global yields, geopolitical issues as well? Or is there a deeper shift in perception towards India? What's your take?
Well, I think that India markets massively underperformed last year. I think up around 3% compared to EM, which was up around 30%. And I think that it's just, India used to be the darling of emerging markets. It was the only index, the Nifty was the only index that outperformed the S&P over the past, 10 years from 2010 to 2020. But I think over the past few years, there have been a lot of other rising stars that have been coming up. For example, the AI trade, China over the past couple of years, Taiwan, Korea, a lot of these competing EM narratives that India previously didn't have to compete with are now out there. So I think that ultimately coming into 2026 and the year ahead, I think investors are looking to allocate, and I think that they will start to allocate more so to India because it's underperformed, but also because Indian earnings estimates are finally starting to improve. GDP growth in India is starting to hit more normalized levels. So I think that the India's story is going to improve over this year, and it should drive foreign flows back to India.
And you believe India will outperform in 2026?
I think that EM will outperform largely due to China. China has the biggest weight and EM, but I think that India is starting from a much lower base in terms of outperformance. I think that India could be one of the best performers for EM this coming year.
That's nice to hear after last year's underperformance. Arvind, getting back to your earlier point that how market sanguineness towards everything that's happening is making you nervous. Markets are shrugging off everything and hitting record highs day after day, at least on Wall Street. How would you position your portfolio? If you are nervous, are you positioning for risk off? What is your expectation, say, for the next 3 to 6 months?
Well, I wouldn't go as far as 6 months, but for the next 2 to 3 months, we are quite overweight anything that is to do with precious metals. We are long other metals names because we think the dollar weakness is one of the risks, and today's action against the Fed highlights that risk. So again, in a broader market sense, we are overweight, of course, some of the beneficiaries from a power infrastructure standpoint on the AI trade, this on a global basis. And I agree with David that emerging markets are likely to benefit because the US market could see flows out if dollar weakness because of expectations that Fed policy is going to be much more dovish than it makes non-dollar assets attractive. And I think the growth side of the story is looking attractive. And India, I think finally we're starting to see signs from a bottom-up standpoint, data like auto sales in December, electricity demand in December. There are other data points that we've been looking for signs that the domestic economy, and I think the GST moves and other things that the government is doing, are starting to show signs that 2026 could be a year where India stands not just on expectation that it should go up because everybody else is going up, but it should go up or it will go up because earnings are starting to reaccelerate. And I think that's going to be the key driver for India. But on a global basis, we're a little more bullish on India this year than we were last year.
What we're going to do is continue this conversation later on. Arvind and David, thank you very much, both of you, for joining us here on CNBC TV 18. As I said, more later. We'll take a quick commercial break here. Let me just quickly run you through the interactions which are lined up on the program today. 8:40, we have IIFL Institutional Equities' Renu Baid to put the spotlight on the capital goods sector. That's coming up. 9 o'clock, we're joined by Avnish Roy of Nuvama Institutional Equities to discuss the Lemon Tree Hotel's restructuring plans. 9:20, Harish Krishnan of Aditya Birla Sun Life AMC is a market master today. 9:30, we bring you a special discussion on the textile sector as US Supreme Court holds of ruling on Trump's tariffs. Following that, we'll be chatting with Warburg Pincus on their 960 odd crore rupee investment in Lemon Tree's Fleo Hotels. Towards the end of the program, Latha in conversation on the state of India's private capex cycle with Mahesh Vyas of CMI and K. Ravichandran, Chief Ratings Officer at ICRA.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you today. We'll get to that in just a bit in our special Top 10 segment. I'll just highlight the few stocks: Lemon Tree Hotels, Avenue Supermarts, IRDA, Manappuram Finance, Tejas Networks, Phoenix Mills, Vedanta, UPL, and Rallis India. They'll all be reacting to positive news flow, while we have Dr. Reddy's laboratory that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. Asia is tracking the gains and the record close across Wall Street on Friday. The Japanese markets are shut today on account of coming-of-age holiday. But you've got a 1% plus rally on Kospi, Taiwan, almost up nearly 1%. Hang Seng China have opened up mildly in the green. The Gift Nifty will also come up for you on your screen. But the Powell probe hangover is still hurting Dow futures, which is down close to more than 200 points. But let's get to the stocks then. Our entire research team is standing by with the CNBC TV 18 list of top stocks for the day. Good morning, everyone. Full house. Mangalam, you start first. Some restructuring at Lemon Tree Hotels.
Yep, it's an interesting deal that is announced. We had an inkling of that as Yash spoke to us and, broke that story last week. But importantly, it's the restructuring, value unlocking and fundraising. Essentially, all these three are announced together. What they want to do is create two separate entities. One is Lemon Tree Hotels, which will be a pure play asset-light hotel management platform, which will basically have high ROCs, high margins. They'll collect management fees. And then there'll be Fleur Hotels, which will have an ownership platform with development capability. So all the hotels will sit under Fleur. Warburg Pincus will acquire 41% stake, which is currently held by APG in Fleur, and they will further invest 960 crores in Fleur Hotels in tranches whenever required. What the scheme is that Lemon Tree will merge two of its wholly owned subsidiaries with itself first. 4 of Lemon Tree's hotels will merge with Fleur against issue of Fleur shares to Lemon Tree, and finally Lemon Tree will also transfer 12 hotels and the ones under development to Fleur for issue of shares directly to Lemon Tree shareholders, for which Lemon Tree shareholders will get 20 shares of Fleur for every 311 shares that they hold in Lemon Tree. as a result of which we will have two companies. Fleur Hotels will be a listed entity within 12 to 15 months. Lemon Tree will be a high growth, high ROC, zero debt company. And post this scheme, Lemon Tree will define a dividend distribution policy to reward shareholders annually as well. So all three things done together, the street likes it. Brokerages have not changed their target prices yet, but they will await further clarity from the management on the structure, the growth patterns and the balance sheets of both these businesses going forward. But the fact that it's announced, going with green on that.
Okay, all right. Mangalam, thanks a lot for that. That's on Lemon Tree. But what about Avenue Supermarts? The quarterly update wasn't great, but the margins were a pleasant surprise. Tell us more.
That's correct. So when the quarterly update was lower than expected, the inkling one got was that it's because of GST rate cuts, there are lower realizations. And that exactly is what, the margin surprise and the management commentary confirmed. So the street was expecting about 8 to 10% EBITDA growth. The company went ahead and reported 20% EBITDA growth. So the consolidated EBITDA margins were at 8.1% versus 7.5%. The street here too was expecting a compression, but the company's gone ahead and shown margin expansion. And a large part of that is on account of gross margins, which improved by about 60 basis points. Here too, the sense that I get is that there is a slightly higher share of revenue coming in from the company's own private label brands, and which is why it is more gross margin accretive. Management has said revenue growth, which was 13%, was partially impacted due to deflation in staples. So all in all, 13.5% revenue growth on a consolidated basis, gross margins expanded, EBITDA up 20%, 18% PAT, and like-for-like growth, while it's 5.6%, it's on account of lower realizations. So because the stock has already seen a mild correction post its quarterly update, and the store expansion is also positive, going with green on T-Mart.
Thank you. Got that. Green for Avenue Supermarts. Some margin expansion. Ekta is now joining in on Dr. Reddy's.
Well, yes, Dr. Reddy's is in focus because they've received a letter which is basically a post-application action letter from the US FDA for an inspection which took place at their Bachupalli facility, which took place in September. Now, this particular letter is a response submitted by the company following an inspection. Now, what this basically is basically for a biologic that they had applied for in terms of approval. The US FDA has more questions, and hence they've issued this letter to Dr. Reddy's, and Dr. Reddy's is going to respond to it. In my understanding and speaking to analysts, it is different from a complete response letter, which has a tinge of US FDA issues attached to it. It's more about asking for additional information. Maybe we could see a little bit of a mild red on Dr. Reddy's because there could be a delay in their biologics application process. But overall, it's different in terms of a complete response letter because it's asking for more additional information as compared to bringing up an issue with the application.
Okay, all right, Ekta, thank you very much for that. IREDA and Manappuram Finance are in focus. Sud is here with details. Sud, morning.
Morning, Prashant. So IREDA last week had released Q3 updates, and disbursements in Q3 was slightly weak if you compare against H1 of FY26, but results are looking good. Profit has increased by 37%. Even there is a healthy improvement in net interest income. There improved by 35%. Improvement in the asset quality as well. Gross NPA has come down to 3.75% from 3.97%, and net NPA has come down to 1.68% versus 1.97%. So here also almost 30 basis points improvement. Second one is Manappuram. If you remember, Friday afternoon, there was a Reuters report that RBI has raised concerns related to Bain Capital deal. Now, Manappuram has issued the clarification post-market on Friday, and it has denied the report. It's saying that it's factually incorrect and speculative in nature. Now, it has given the detailed timeline. First, it had got the approval from RBI for the deal, and after that, RBI had asked certain clarification to which Manappuram had clarified. Also, now it's waiting for the final approval from RBI. But as far as the Reuters report is concerned, Manappuram has comfortably denied. And today also, gold and silver, both prices are at the record high.
Okay, all right. Thanks for that, Serge. So Manappuram will be a stock in focus. Got slammed in the final 90 minutes of trade on Friday. But clarification coming about, so let's see how the street reads that. But let's hop across to Upasana. She's here to tell us some stocks in the news. Hey, Upasana, morning.
Good morning, Nigel. First up, let me start with Tejas Networks. The company has reported a sequential uptick in terms of its revenue, with an uptick of 17% on quarter-on-quarter basis, but there's a 88% Y-on-Y decline in terms of its revenue. Now, the weak sales was mainly impacted by the company's delayed in major BSNL orders, and this delay continues to persist, is what company is indicated. Now, in terms of losses, the company's reported losses for the fourth consecutive quarter, with Q3 losses at 196 crore versus a loss of 307 crore sequentially. Next up is Phoenix Mills. On the back of its Q3 business update, the retail consumption has seen an uptick of 20% on a one-year basis. And if you look at the 9-month figure, there is an uptick in consumption of 15% on a one-year basis. Now, company says that the consumption growth continued to remain strong. Select assets continue to undergo planned revamp and premiumization initiatives to strengthen the company's portfolio going forward. And lastly, coming to Vedanta, the company has received NCLT nod for demerger scheme with Talwandi Sabo Power Private Limited. So all in all, we'll be tracking all these stocks today.
Thank you very much for that. And now it's over to Ria on UPL and Rallis India.
Well, yes, good morning. You know, some reports have suggested that China has cancelled the export tax rebate for pesticides, including glufosinate, starting from the 1st of April of 2026. Now, as a result of this, the FOB price of these products will immediately rise by 9%. And it is anticipated that by the 1st of April, some overseas customers will also place advance orders in order to stock up for these products. Now, as a result of this, players like Rallis and UPL, for UPL, remember, glufosinate is one of the key herbicides in their portfolio. Both of these companies may see some short to medium term benefits, both in terms of volume and margin uplift.
Thank you very much for that. Let's do a quick recap then of the top stocks you should have on your radar. Stocks with positive news flow are Lemon Tree, Avenue Supermart, Irida, Manappuram Finance, Tejas Networks, Phoenix Mills, Vedanta, UPL, Rallis. Well, Dr. Reddy's could be the only stock on our radar that could open in the red, but that's on the back of news. But now it's over to Manisha, because gold, silver continue to hit record highs. It's a big pop-up, opening gap up, and crude too has spiked, Manisha.
Oh, absolutely. Almost everything in commodities seems to be doing quite well. So that tells you the pure economics fact that when you are there, you are looking at uncertainty. It is the tangible commodities that continue to do well. And we also are looking at geopolitical concerns. So gold prices have hit a record high of $4,600 an ounce. 5,000 is a level that most banks and brokerages believe you will see in the first half of 2026 itself. Silver as well is trading 4% higher, $84 an ounce onto this one as well done. We are looking at a decline in dollar index. The news coming in from the U.S. Federal Reserve and the fact that you have seen weak U.S. payrolls data have been supportive factors here. Strength has continued for the copper prices also. We saw all-time highs in the previous week, and that's exactly where copper is trading right now. The major gains clearly have come in for the crude oil prices. We started this year with almost $59 or $60 a barrel. We are trading at $64 right now. This is due to escalating protests in Iran, uncertainty over Venezuela, and of course, U.S. President saying that financial support and Venezuelan oil to Cuba could be cut off. So various statements and the impact on ground clearly can be seen in sense of bullish prices.
Okay, all right. Thanks a lot for that, Manisha. For the time being, though, I think we'll slip into a short break. Come back, we'll connect with Dharmesh Kant, Head of Research at Chola Securities, for some fundamental stock talk. Stay tuned. Welcome back. Hope you're having a good morning. Well, as promised, we're going to get some fundamental analysis going. Dharmesh Kant, Head of Research at Chola Security, joins us on the show. Hi, Dharmesh. Good morning. Good to see you in. The tech results start rolling in today. But over the weekend, we got a result coming in from DMart, Avenue Supermarkets. And actually, the update that they put out was a little bit weak. But the results are not too bad. And I'm just going through Jeffrey's note. They say that the EBITDA margins have come in at the highest they've seen in the last 6 quarters. Some kind of relief, at least on that front. What's your view on the stock from here on? It's corrected substantially from the top. It's been under big pressure. But now it appears, at least in the profitability aspect, there's a bit of a beat.
Yeah, good morning, Nigel. Thanks for having me for the show. Definitely, I mean, results were a bit better than what the expectation was going by the updates on the revenue which they have given. And they have also added 10 new stores, so that also, will suit well with the trading community. But to my mind, I mean, still, the Avenue Supermarts is not a structural wealth creation kind of a buying value. You can get a trading gains if somebody is buying here, I mean, 10-15% kind of a pop-up may still happen over a few months. But what I think is this is the best they can do going forward. So 24-25% kind of a PAT growth, 8.5% kind of an operating margin is the best in light of the competition which has been hitting up. And stock is still valued at around 75 to 80 times PE multiple basis even 1 year forward. So such kind of a valuation multiples with 20 to 25% kind of a shaky growth is hard to sustain going forward. So I mean, trading play is on, but if somebody is looking for a fresh entry for a wealth creation kind of a concept for 2 or 3 years holding, to that the answer is avoid.
Point taken. Dharmesh, hi, morning. This lemon tree news, the information coming through, and by the way, we had reported on this just 3 days back. So in that sense, it's a confirmation of our story. But what did you make of it? Any thoughts?
Yeah, good morning, Prashant. I mean, we haven't figured out the valuation part as far as that is concerned. I mean, more details are awaited, and there we will work on the numbers as to how it goes through. But structurally, entire travel and tourism industry is on an upswing, and we have seen the discretionary spends are getting invested there. And then if you are buying a lemon tree hotel as of now, so investors have a choice of retaining either of the two businesses. One is the asset-light model on the servicing part, and the second one is the Fleur is a pure play on the asset ownership. So I mean, it will make sense if somebody gets into for trading play for some time, and thereafter, when the further details emerges and the valuation can be ascertained, one can hold whichever one likes. Structurally, for next 3 to 5 years, this entire space is looking very good, and Indian hotels we have been recommending for quite some time to be added into the portfolios.
Value unlocking for Lemon Tree with this restructuring in a way. We'll wait by to see how the stock reacts. Dharmesh, any commodity plays that you're recommending at this juncture? Because across the board, stocks have run up. So from here on, any stock where the risk reward still looks attractive?
Yeah, good morning. Definitely, yes. I mean, commodity is a structural theme in the making, and I think this year again, 2026 would be good for all the commodity players who are the producers of them. And dollar index is also helping them. It is not much is happening out there. It's benign. At the same time, interest rates cuts are expected from across the board. So recent development in the US may even speed up the interest rate cut. So there we have been liking Hindalco for quite some time. Though valuations are now reeling the +1 standard deviation kind of a zone, but still I think a lot of juice out there. And Vedanta is the second one in play. Both benefits from aluminium, copper, price upswing which is happening in the international market. At the same time, Vedanta also have a similar play. They have not mined yet to that extent from the Hindustan Zinc for 2 quarters, but maybe going into the fourth and subsequent quarters, this output increases, so that will be a value accretive. And for the ferrous play, JSW Steel is one which we have been liking for quite some time. And also in light of safeguard duty which has been levied, again an elbow room has been created for them to speed up. So though higher, volatility will be there, but structurally if you're buying it for a 1 year perspective, I think plenty of upside is still left.
Dharmesh, stay with us. You may want to listen to the next conversation. We'll ask you as well, right? Capital goods stocks and power especially all sold off aggressively over the last 1 week or so. There was that story, of course, which talked about, Chinese companies being allowed to bid for government contracts in India, and this is of course after they were disallowed to do so after the Galwan clashes in 2020. It's all been source-based reporting from various media outlets, but of course, the damage showed up in stock prices, names like Hitachi, BHEL, so many CG Power, fair bit of damage occurred after these stories. Renu Baid is with us, Senior Vice President, Research at IIFL Institutional Equities. Renu, good morning. Good to have you with us here. As I said, this has all been source-based reporting. I don't know if you've been able to get some clarity on this first up. We've been trying to talk to companies individually, and some companies have told us that, especially in power transmission, etc., this is true. It's not without nothing. So just wanted to start there, Renu.
Yeah, hi, morning. So clearly there has been no government notification of lifting the restrictions. Doesn't seem to be the intention so. But even our interaction with industry experts suggests that in the transmission space, power transmission, high voltage, apparently for reactor category, one of the Chinese manufacturers who are based out of India for over a decade, TBEA, they have been approved for reactors, that too for next financial year. So there have been approval for them. It's not that the restrictions are lifted. So there is no risk of imports here at the moment. But yes, in the transmission space, where players were constrained on capacities and the average pricing in the market have shot very sharply, there we are hearing Chinese players or their factories which are based out in India are now being allowed to participate in future bids.
Any other companies?
Sorry, just one thing, Renu. You're saying that in high voltage reactors, in transmission.
This is for the extra high voltage, 400 and 765 kV.
So this is transformers, just to get it.
These are reactors. The capacity which is used for transformers is also used to make reactors.
I see. Because I saw this reactor bit on social, etc. And well, people were asking whether this is, when you say reactors, you automatically start to put nuclear in front of it.
No.
Yeah. So this is in high voltage transmission. So just to give us put a name to it, this is the kind that Hitachi, etc. are involved in.
Yeah, in this space, we have Hitachi Energy, GV Vernova T&D, there is CG Power, transformer rectifiers, who are pretty active in this high voltage, extra high voltage space.
And they've been, so this is Chinese companies with facilities in India, manufacturing facilities in India.
So this company called TBEA Energy, they were, as their factories were established in India way back in 2014. And they were very active. They were, in fact, they used to have the market leadership in volume terms with Power Grid then. But after the Galwan clash, Chinese entities were not allowed to participate in India, irrespective of whether they being a local manufacturing entity or not. So this company is very well a domestic company from a local manufacturing footprint perspective. And they have been operating in India since then. They have been exporting, and last few years, they've been supplying to private transmission utilities and exports, though they have not been dealing with directly Power Grid or the state utilities or government contracts, basis the restrictions which were there.
Renu, so now particularly in this segment where TBEA seems to have been approved for a particular project for the next fiscal year, and that is negative for companies like Hitachi, GE, Vernova, T&D. Now with, say, case by case, in the case of, say, TBEA, what would be the market competition now? How would the competitiveness change? Because typically what we hear is that Chinese bids are lower, 10%, 20%, 30%. And plus there is increased competition. So what happens to these companies? And is there any other example where a Chinese company has been appointed for a order?
Well, we still need to see the details. Typically, Chinese players don't have a great track record when it comes to maintaining price discipline. But that was the case during last cycle when demand was extremely weak and there was excess supply in the market. In today's environment, if we count TVS capacity, which is almost close to 50,000 MVA, the capacity has been very much active in the market. So as a market as a whole, which comprises of public, private and exports, the capacities were already there. So there may not be a nosedive impact on pricing because they are also very well occupied. The factories are full for them. It's just that they'll be now re-entering the government space, that too for reactor as a category to start with. And for a segment, if a private utility was using the capacity earlier, which now will partially be used for the Power Grid orders, the private utilities which was dependent on or using TBA's capacity will now look for other vendors as well. So for a market as a whole, it will take time for prices to moderate. Nonetheless, I would want to highlight that over the last 2 years, most of the capacity expansion which was announced by companies in the space, most of those capacities are coming up for commissioning in the current calendar year. So anyway, the transformer industry supply or manufacturing capacity of transformers is expected to near double in the next 12-15 months. So whether TBA was allowed or not, market prices were expected to correct. It's just that the entry or the announcement of Chinese-owned manufacturers being re-allowed in the market will have a sentiment overhang on the companies. We don't perceive or foresee any material impact on earnings or sudden crackdown on the market pricing because capacities are constrained.
Okay. So stock prices, the names that you mentioned, they're adequately factoring all this, Renu?
We think, yeah, they are now consolidating and valuations ought to correct for increased competition and the risk which market is discounting.
And you don't think that in other areas this is going to happen, in EMS and things like that?
No, this restriction was placed way back in 22 on power and infra segment. So power generation and T&D generation, unlikely that NTPC, which is a central government utility or SEBs may directly use Chinese equipment. Anyway, on the BTG side, there are no domestic Chinese manufacturing facilities. If at all, they'll have to import. But private sector usually is more comfortable with Chinese vendors than state utilities like NTPC, central and state utilities. In other
Renu, back in the day, BHEL and all used to, I mean, there used to be a lot of boilers and all used to come, right, from China?
Back in the days when BHEL was the only manufacturer, Chinese used to have almost nearly 35% market share, but largely concentrated in the private sector hands. So private utilities or IPP players were the customers who were very keen to use Chinese vendors, both for cost and delivery timelines. In today's environment, BHEL, L&T both are full on their factories. We have seen JSW acquiring GE Power boiler facilities. So probably in the next 12-15 months, JSW should start participating, both using the boiler and the turbines which they have through Toshiba. But on the government sector contracts, we don't think, at least our perception is NTPC as a customer has never been comfortable with Chinese vendors. And I don't think so they would reopen the door. And if at all, there is a minimum localization requirement which none of the Chinese manufacturers have in India. So on the generation side, it could be imports, but that too on the private sector, nothing on the government utilities or customers front.
You know, I just want to talk about other issues with the EMS, right? I mean, memory prices surging. What does it do to companies like Dixon and others, etc.? But I'm out of time. We're running into market pre-open. Renu, thank you very much, and we'll invite you back on the program. Thanks very much for joining us here. We'll take a quick commercial break here. We're going to come back in just a bit. Some volume buzzers from Friday's session, some price action that we want to focus on. Sudarshan Sukhani and Mitesh Thakkar also with us with some technical trading ideas. Stay tuned. Coming up. Okay, welcome back. 5 minutes to go for the pre-open session. Hormuz is here with the big movers on Friday with heavy volumes. Hormuz, morning.
Morning, Prashant. And IEX cannot talk about it. The price action that you saw on Friday's trading session, almost 8% lower, had tumbled back towards its 52-week low levels as well on Friday. And of course, the volumes on that day were the highest since July of last year. On that day, when the stock fell 30% in a single session, almost 22 crore shares were traded on IEX on Friday. The 20-day average is just around 1.5 crore. And out of those 22 crore shares, 2.5 crore shares were marked for delivery here too. The 20-day average is around 40 lakh shares, so 5x in comparison to the 20-day average in terms of delivery volumes. And Friday's turnover as well, close to 3,300 crore, almost 30% of its free float market cap. Now, HDFC Bank is another name, and it wasn't a big price mover, but it has been the one big factor as to why the Nifty did what it did last week. Declined on all 5 trading days. The worst week that the stock had since January of 2024, down almost 6.5% last week, and delivery selling worth almost 13,000 crore took place last week on HDFC Bank. Friday's volumes were the second highest in the week gone by, and almost 4 crore shares were traded on Friday, 20-day average of 2 crore shares. And out of those 4 crore shares, 3 crore shares were marked for delivery, and the 20-day average here was just around 1 crore. And the stock from its 52-week high, which it very recently hit of 1,020, is already down 8% from those levels. And lastly, MTAR Tech defense names are moving higher in the recent times. The biggest single day gain in the last 3 months was up 14% last week. It was the best week that the stock had in 3 months. The volumes on Friday were the highest since September of 23. So the stock moved on very significant volumes as well. Close to 50 lakh shares were traded. The 20-day average is just 2.5 lakh shares. But out of those 50 lakh shares though, only 5 lakh shares were marked for delivery. Here the 20-day average is less than 70,000 shares. And in that 6% move that the stock had on Friday, the stock hit a 52-week high on an intraday basis.
Thank you very much for that. And with the FI selling intensifying last week towards the end, a lot of these FI stocks where there is a lot of FI ownership, like HDFC Bank, Reliance Industries, also took a bit of a knock. And that's one of the stocks Hormuz identified. We will slip into a break. We'll come back with the pre-opening rates. We'll also be joined by Abneesh Roy of Nuvama Institutional Equities to talk about the Lemon Tree Hotels restructuring plan. Stay tuned.
Welcome back. Well, we're going to be getting our pre-open rates that have gradually started trickling in, but a good time to get in our technical experts. We have Sudarshan Sukhani, proprietor technical trends, as well as we have Mitesh Thakkar, President Retail Research at Bonanza Portfolio, who joins us on the show. Good morning, gentlemen, and good to see you all in. Well, Mitesh, you go first. The structure clearly has been weak over the last few days. We're making lower lows and lower highs as well. And there's been a one-way slide, 600 to 700 points or thereabouts. What the bulls will be hugging onto is the PCR has come to the lower end of the range, and the short positioning is at around 1.9 lakh contracts. What's your view? If we see some kind of weakness today, would you look to buy, or do you think this market is actually breaking down?
Morning, Nigel. So I think, a couple of things. One, the Nifty has broken some averages on daily charts, has broken a rising channel, which was around 25,950, 26,000. And with that, I think, there's a good possibility that the near-term structure is weak, and we could possibly, head towards levels of 25, 350, 400, which is where we had a intraday low on the 7th of November. So that's the support pivot. And that's an area where also a couple of weekly averages coming. So to my sense, I think, there could be some volatility. There could be a day of short covering when a pullback could happen. But broadly, I think stronger bottom could be made around 25,400. So one, I would want to go long only if we get closer to those levels of 25,400, 350. And on the upside, I think this weak structure will persist till we get past 25,950, 26,000. So that's the range on the upside. The structural bias in the short term is negative. So I would believe that there's a good chance of testing 25,400, 350 before giving an upside risk.
Got it. All right. So you'll be a buyer only at around 25,400 or thereabouts. Sudarshan, what about you? How are you feeling about the markets?
Good morning. It's almost the same view that Mitesh was talking about. See, two things have happened. First, a very significant support level of 25,700 was breached decisively when the Nifty closed below it on Friday. Second, that closing also at least gives a sense that a double top is getting confirmed. Now, the confirmation comes later when the market keeps on sliding, but the pattern is now clear and visible. So that's not good news. So all said and done, this market's first support level is 25,400. The chances are that given the current technical picture, we will slowly slide towards that support level. News can change it in a minute. That's a different matter. But I would expect the markets to keep sliding down with small rallies in between.
By the way, some update coming through on Kotak Mahindra Bank. Kotak Mahindra Bank has appointed Anup Kumar Saha as the whole-time director of the bank. He will look at the consumer banking and the digital business of Kotak. Remember, he is the ex-CEO MD of Bajaj Finance. He was one of the contenders for the top position at IndusInd Bank. That didn't happen. And now he's been appointed by Kotak Mahindra Bank. And the question is, will he bring that growth mindset, that aggressive growth mindset that helped Bajaj Finance become a titan in its industry and help Kotak Mahindra Bank build its consumer and digital portfolio? So important update coming through on Kotak Mahindra Bank. Gentlemen, morning, and thanks for joining us this Monday morning. What about stocks, Mitesh?
Yeah, good morning. I have actually a mix of buys and sells, two buys and two sells. On the buying side is Dabur. In this entire decline, Dabur has been sideways. The overall structure is positive. So keep a stop at 519 and buy it once it breaks above this recent consolidation range of 525, 526. Keep a stop at 519. Look for targets of 540. Bosch is a positive chart which has given a pullback to its 10-day average. So buy here with a stop at 37,600 for targets of 38,700. And on the selling side is L&T. Sell on a mild pullback, let's say around 40.40. Keep a stop at 40.90. Look for targets of 39.50. And Geo Finance is a sell as well. In the short term, it could decline to about levels of 275 and keep a stop at 292.
Got it. All right. And Sudarshan, what about you?
It's also a mix. HCL Tech is a buy because IT has been a little better. Buy with a stop under 1630. Asian Paints is another buying opportunity with a stop under 2790. DLF is an intraday short with a stop above 685. And Adani Enterprises is another short with a stop above 2200. Take the long positions only if you find some stability, not otherwise.
All right, gentlemen, we'll come back to you for 9-10 calls. For now, let's address Avenue Supermarts and the margin surprise. Abneesh Roy, Executive Director, Nuvama Institutional Equities, is now joining in. Abneesh, your first read of Avenue Supermarts. And is there enough in the performance for you to go ahead and buy the stock today?
Hi, good morning. Yes, it's a good number. I think this stock is in the oversold zone. Of course, FI is selling, we need to see. But I think a few key positives in the results. So clearly, around 50 bips improvement in gross and EBITDA margins. Even in terms of DMart ready, our calculation suggests around 20% kind of a growth, which is a reasonable number. Third, of course, is in terms of store addition, around 28 stores in the 9 months they have done. And generally in Q4, the quantum of stores really addition improves. So we see that around 60 stores addition can happen. It is not a cheap stock, but I think it's an oversold stock. So I think near term it should do well. Here we need clarification on whether the gross and EBITDA margin sustainability is there or not, because it has corrected a lot in the past few years. So it could be bottoming out. Last 2 quarters also, there was a small dip. This quarter, there's a small improvement. So sustainability is important, but yeah, near term, the stock would react a mild positive because of this number.
All right. Hi, Abneesh. Thanks a lot for joining in. So maybe some kind of relief is what we could see, since the quarterly update wasn't too great, but the margin surprise is encouraging and the stock has fallen considerably. What about Reliance Retail? Any read-through? I recall when these numbers came out, Reliance as well was under pressure. There was some fears that Reliance Retail as well will see some pressure. What are your expectations? Those numbers come out later this week.
I think difficult to take away from one result to another, because retail, as you know, is fairly competitive and every company will have its nuance, and the business models are different. Demand is much bigger and all those. But yes, we do see that in this quarter, the GST transition happened. So is there any interplay between the reduced discounting and GST rate cuts? We need to see that. Second, of course, for DMart, one more thing which is positive in terms of lease, because generally DMart likes to own the stores, which limits the expansion. What we are picking up clearly, lease liabilities versus assets, we see a movement there. So that could mean that in the new market of UP and some of the other market, companies a bit more open on the lease rather than ownership. So I will say that yes, we need more clarity here, but I think every retail company will have to take on its own rather than extrapolate.
What's the fair valuation multiple for a company like Avenue Supermarts, which is facing increasing competition from quick commerce, and it's showing up in the numbers? Revenue, same-store sales growth is slowing down. Not talking about this quarter where there could be an impact because of GST rationalization, but as a broader trend, what is the valuation multiple that you think is appropriate for this company?
So yes, you're absolutely right. Currently, if I see the stock rates at 90 and 75 times FY26 and 27 P multiple, we have a target price of 4351. So we see small upside here. You are absolutely right. E-commerce, quick commerce, new players are also coming. Amazon now has become extremely aggressive, which may bode well for the FMCG companies, especially food companies. But that also means that Avenue Supermart and some of the other players in quick commerce and generally retail, they will see that competition. So that continues to remain. I think for the significant re-rating for Avenue Supermart, around 17-18% sales growth and slight margin recovery, I think that will be needed. So we'll say that currently 4351 seems to be the reasonable target price at this juncture.
All right, Abneesh, very quickly, there are two stocks that have got hit very hard in the last few trading sessions. One is ITC, post that tweaking in the duties. The stock is down 16%, I think, in this year itself, and we're only getting started. And the other one is Trent. That as well is down close on 7% post their quarterly update. Any view on both these two names? Would you look to buy either of these two?
Sure. Firstly, I'll take on the retail trend. Our topics currently will be Titan and Jubilant Foods. Avenue Supermarts near term could do well because of the margin surprise. So Trent, as of now, we continue to wait for improvement in terms of growth numbers, margins, etc. Coming to definitely ITC here, I think FI selling continues to remain a overhang, but in terms of pure valuation, dividend yield around of 5%, improvement in FMCG, agri, paper, etc. Those are positive. I think the stock further downside seems limited. Only FI selling continues to be a unknown development, because we are seeing that across the board that selling is happening. One more important thing is, I think in February and June, we expect 2 rounds of price hikes by ITC to pass on that. So, and next year, the chance of a tax hike remains very, very low given the quantum. I think from a 2-year perspective, ITC makes sense. Near term, definitely overhang is there, but I don't think the correction too much I expect on ITC from here on, except the FI selling, which is very difficult to predict.
Okay, and there are price hikes on the anvil in June for ITC, as you expect. Thank you very much, Abneesh, for joining in. Back to Sudarshan for his 9:10 call.
Well, DLF is an intraday short with a stop above 685.
Mitesh?
I will go with the sell call on Geo Finance. Keep a stop at 292 for targets of around 275.
Okay, now let's get to the brokerage call of the day. It's Macquarie on financial. Sudarshan joins in to tell us why he's picked this.
Expecting more than 15% earnings growth for banks in FY27, and some of the key factors that it has mentioned. First one is improving margins, second falling OPEX, third is credit cost, and even the valuations Macquarie is finding very reasonable. And it's positive on PSU banks and life insurance sector, and it believes that large PSU banks will deliver sustainable 13 to 14% ROE, and for life insurance there should be improvement in VNB margin as well as growth. So it has upgraded SBI to outperform from underperform, target is increased to 1150. Upgrade Paytm to neutral from underperform and target is increased to 1265. Upgrade HDFC Life to outperform from underperform, target is increased to 900. Upgrade SBI Life to outperform from neutral and target is increased to 2360. And downgrade Bandhan Bank and SBI Card to underperform from outperform and neutral.
Okay, all right. Thanks a lot. Thanks a lot for that, Sudarshan. Well, I think we can hop across to Mitesh. Mitesh, for his 9:10.
We did that. He's got a sell call on Geo Finance.
Right.
So that's the 9:10 call. Mitesh, anything on the... All right, we've lost it. But you should also keep your eye on tech names because both TCS and HCL Tech will be reporting their Q3 numbers post-market hours. For TCS, expect a fairly lackluster quarter on account of seasonality, etc. So I think the constant currency revenue growth expectation is just about 0.3, 0.5%. But the company is turning aggressive. So the street will want to know more about, they've made an acquisition, they've made investments in data centers. So more on that. And the other one is HCL Tech, which will have a very strong quarter, nearly a 2.5-3% top line growth on the back of seasonality in their products business. But it's over to Mangalam now. He's joining in for more on Lemon Tree Hotels and the restructuring.
Well, that's right. So the company announced a strategic business decision along with value unlocking and restructuring of the company with fundraising as well. So let's just put this into perspective. Lemon Tree currently has about 58% stake in Fleur Hotels, 41% is at AVG. Warburg Pincus will go ahead and buy that 41% stake from them. And at the same time, what the company will do is Lemon Tree will take 2 of its wholly owned subsidiaries, merge it within itself, and at the same time have 4 of its subsidiaries which will go along with Fleur Hotels. For those 4 subsidiaries, Lemon Tree will get shares of Fleur, and at the same time they have about 12 hotels which they will then give to Fleur Hotels, for which the Lemon Tree shareholders will get Fleur Hotel shares. So eventually the resultant structure will be 2 companies. One will be Lemon Tree Hotels, which will be the company that manages hotels, and along with that we'll have Fleur Hotels, which will be the company which has a platform of all these hotels which will then be developed as well in terms of assets. So together, Warburg Pincus in Fleur will go ahead and also have the right to go ahead and invest about 960 crores of equity as and when called for in tranches. What the street really wants to understand from here on is how the growth rates of each of these companies will be. As of now, Lemon Tree will have, the hotels company, which will have about 70% EBITDA margins in as a branded business, as a managed business, and Fleur will have about 42% margins. So all these factors, we will await more clarity on this day.
All right, I think just market opening, it's been a terrible, terrible last 1 week. 16 points lower, absolutely flat now on the Nifty. The Nifty Bank is also slightly in the green, but not very much beyond that. The small cap index is flat. The mid cap index will come up on your screen. And I think there as well, there isn't very much at all, which is kind of discernible in any meaningful way. So it's flattish, I guess, this morning. I think the Nifty 50 heat map will give you a quick sense of how how we're starting, and then we look at individual names with regards to moves. HDFC Life, SBI Life. I mean, so the life insurance data, came through. And I think the reaction is on account of that. On the other end, you've got Max Health, BEL and Indigo, which are coming up. under pressure at this point. 20 points lower on the Nifty is what you have. It's absolutely flat. Rima.
Well, Avenue Supermarts is a standout performer, 2.5% up. We knew the revenue growth numbers at 13.5%, but the street likes the improvement in margins. Avenue Supermarts has opened up strong. Then you've got HDFC Life, SBI Life, both of them gaining nearly 1%. Hindalco continues with its up move, so that surged over 1% in early trade. Some of these stocks, on which are dependent on crude prices, are moving in different directions. So Brent crude price surged on the back of rising risk in Iran. Brent is at $63.50 per barrel, almost hit 64. Asian Paints is up 0.5%, but on the flip side, you've got Interglobe Aviation, which is down nearly 1%. And some of these oil marketing companies should also come up for you on your screen. IOC has a downtick to begin trade with. One of the stocks which is in news today is Lemon Tree Hotels, where there is monetization, restructuring, value unlocking. Lemon Tree Hotels has opened up with strength. BEL is seeing some profit booking after last week's run. Defense, rearmament is emerging as a big theme globally, and even stocks in India had a good run. BEL from the start of January is up nearly 3.5%, but seeing some profit booking. Eternal opening up in the red. Apollo Hospitals, ICICI Bank. In fact, HDFC Bank and Reliance Industries should also come up for you on your screen since they were the big drags last week. HDFC Bank down 0.25% and Reliance Industries down nearly half.
Well, a few stocks that are actually outperforming today. IRDA, well, that stock is up and about in today's trading session. Good move is what we're seeing, up closer around 4%. The profitability was up by close to 37%, and the NII is up close to around 35%. Remember, the stock is a half of what it was at its peak, but that one's seeing a bit of a relief rally. Manappuram Finance, remember, that stock got slammed in Friday's trading session, particularly towards the end of trade. Now, the management has denied Reuters' report of RBI raising concerns with regard to the deal that they've done with Bain Capital. So that explains why that stock is bouncing back. Metals, they're back in focus. They had a couple of off-trading sessions last week, but Hindustan Zinc is moving up. That's the only way to play silver. And Vedanta, since it's a parent of Hindustan Zinc, and the demerger is moving in the right direction. So we see that one as well is participating on the upside. Hindustan Copper, that's the other stock that's doing pretty well in there. That one, in fact, up and about in today's trading session. What's not doing too well? Tejas Networks continues to struggle. The stock is now down close to around 6%. Intense selling pressure is what we're seeing on that name. Remember, that's a stock which is a third of what it was at its peak, but no relief being seen on that stock itself. Net, the markets are lower. The Nifty is down close to around 60 points, but the street will be hoping at some point of time you would see some kind of an uptick because the FI short positions are at aggressive levels and the PCR is at around 0.64, which is the lower end of the band.
All right. Well, Harish Krishnan is with us, co-CIO and head of equity at Aditya Birla Sun Life Asset Management Company. Markets, of course, starting lower. Harish, good morning. Good to have you with us here. Our first chat of 2026. So let's hope the remainder of 26 is not how we've started this year off, which has been painful, Harish. And, so many money managers now talking about how they've kind of sort of reoriented and moved to large caps entirely because maybe the call is that in mid and small caps, it'll take time and perhaps there is pain for the foreseeable future. I don't know if you have a view on that specific thought process, Harish.
Happy New Year to you and to your viewers, Prashant. So we do have a similar kind of a construct wherein we do think that larger companies have a far greater risk reward. And this is borne by two particular data points. One is that we do think that, given the fact that there has been a pivot towards consumption, there is a certain amount of focus moving away from B2B franchises, which have done very well from 2020 to 2024. And we do think that there are certain set of sectors and themes which are going to be the winners of the next 2, 3, 4 years, which are markedly different from the winners of the past cycle. So there are 9 sectors which underperformed in the last 3 to 4 years, on which we think at least some of these sectors may end up being the big winners. And if you look at these 9 sectors, which includes banks, which includes IT services, which includes metals, cement, textiles, chemicals, FMCG, oil and gas and energy, etc., overwhelming amount of these sectors have a larger representation in the larger companies rather than in the small cap companies. Flip back 3-4 years back, wherein the call was more on going into the investment theme. And at that point of time, if you recall, on the PSU side, barring maybe a couple of names, almost everything was in the mid and small cap. If you look at capital goods, barring say 2 or 3 names, everything was in the mid and small cap. And so therefore, there was a greater strength going into the mid and small cap at that point of time. So that's point number one. The second point is that, there has been a lot of money chasing the small caps over the course of the last 3-4 years. And just to give you in numbers, close to about 23% of the total AUM of the Indian mutual fund industry is into small caps, which is 251 and below, which account for about 11% of total profit pools. So this is a bus which is significantly overcrowded. And while there are a lot of good, interesting names out there which can potentially surprise, we think that the overwhelming risk reward is still with the larger companies at this point of time.
So Harish, getting back to the first point, you're saying 9 sectors had underperformed, and you outlined the 9 sectors over the last 2 or 3 years. Now, over the next 12 to 18 months, which of these 9 sectors have enough in their fundamentals to do well and outperform from here on?
So we think that there are 3 particular sectors which are dark horses at this point of time. One is the consumption pack, wherein there has been a significant amount of reset from the government side, which is focused on both tax cuts as well as monetary stimulus. This has been an area wherein companies have kind of focused on margins over volume growth over the course of the last almost 4-5 years. And what we've now been seeing in the last year or so is the focus back on volumes rather than margins. So many of the leading FMCG companies have cut down their margin guidance by focusing on volumes, and have also started using the cash flows to buy bolt-on acquisitions to further their growth agenda. So I think that is an interesting area of point. The second is IT services, wherein while we do acknowledge that there is a threat of the AI, which can kind of disrupt many of the incumbents, the reality is, I think that expectations are running very, very low. This is a space wherein a lot of companies will use a lot of these IT services to actually, do the change as far as AIification of their enterprises. And therefore, for some of them, we do think that this is a great opportunity, especially with the currency where it is in the 90s. We think that that's again a space that can be quite interesting. The third area that we think is a dark horse is the material sector, be it chemicals, building materials. Again, these are spaces where we've seen a significant amount of underperformance. In many of them, there has been a large capex or a large gross block addition, which is not contributing yet in terms of revenues. And so these are the 3 broad areas, along with metals, which has had a great 2025 and which we had kind of picked out as a dark horse at that point of time. We continue to maintain a positive stance. So these would be the areas where we do think that either there is increasing margin of safety, or there is a potential catalyst over the course of the next 18 to 24 months that can drive up as far as value creation is concerned.
All right. Hi, Harish. Good to see you win. And consumption, as you mentioned, various fiscal as well as monetary measures have been put in place to boost consumption. And if I got that number correct, you mentioned in your note around $7 billion USD is the kind of push that we have seen. What do you like out there? If you could drill it down a little bit more.
Sure. So I think on the FMCG pack itself, there is reasonable amount of under ownership. This is like a pack wherein most people have a view that, valuations still are expensive. But we do think that there is opportunity out here, even though headline numbers are quite large, are quite steep. The reality is that many of them are throwing significant cash, and we think that incrementally they are headed in the right direction of focusing on volume. So here we have plays which are either into very niche personal care or into the food space, where we are a lot more positive, where the scope for quick commerce-led disruption is meaningfully lesser. The other area that we are positive on is in terms of consumer durables. Again, a space where revenue pools are very, very large, but margins are extremely low. And we do think that, listing of many of these franchises will bring in certain amount of pricing discipline. This is a space, if you recall, say 5 years back, many of these B2C franchises in the durable space used to trade at 5-7 times price to sales. They've all derated to anywhere between 2 to 3 times price to sales, whereas the B2B franchises, which used to trade at, say, less than 1 time price to sales, have moved to close to about 4 to 5 times price to sales. We do think that there is a point to transition from the B2B franchises to the B2C franchises. So on the consumer basket, this is where, increasingly we are finding value.
Okay, all right. And another point, Harish, which we have discussed in the past as well, that the Nifty in gold terms is at its cheapest that we have seen all the way since the pandemic. But gold, going by the geopolitical tensions that we are seeing, and, Mr. Trump, plenty of uncertainty exists in the globe. And that's why, you'll have gold that will continue to hold its own. And maybe the central bank buying as well does hold on. In that case, it'll be difficult for gold to fall from here. But you believe that's a strong case that the Nifty or equities actually outperforms gold from here on?
We do think so. Just go back to the COVID pandemic times. In March of 2020, I would imagine that the overwhelming thought process would be that we are not sure of how our own lives, our own safety would be. Forget about cash flows of companies. And that is where, peak fear psychosis kind of took over. And at that point of time, if Nifty in gold terms had kind of bottomed out, and that's the same level which is bottomed out in at the GFC level, at the .com level, etc. Invariably, living through these motions might always kind of give a sense that, even more worse things are going to come through. And potentially it can. See, all we are saying is from a probabilistic kind of a time frame, given that, over the course of the last 30 years, equities in gold terms have kind of bottomed out here. From a medium term perspective, it does make sense that, one should be increasingly allocated more and more to equities rather than to precious metals. Now, whether this will play out in 3 months, whether this will play out in 6 months, 18 months, 24 months is anyone's guess. It'll only be in hindsight that we'll really know. But my limited point is, when we go through all of these motions as we have during .com, during GFC, during COVID, I'm sure that there would have been peak uncertainty. And each time the nature of the uncertainty and the catalyst of that uncertainty is very, very different. And it will always appear that, these risk-free assets or the safety assets one needs to really load up on at that point of time. And I'm not saying that, gold will not perform. Don't get me wrong. All I'm saying is that incrementally one should be better off allocating to equities as an asset class from a medium-term perspective, rather than just purely chasing price action of precious metals.
All right, just take a look at the Nifty, guys. We are breaching crucial levels as we speak. The 20 DMA is gone, the 50 DMA is gone, and now the 100 DMA as well is gone. And we're at the low point of the day, 150 points. Just wondering whether the street is fearing something that's not really come to light as of now, because, we've underperformed last week. And in today's trading session, we're trading for the last 13 minutes and we're down 150 points. The Nifty Bank is trading way below the 20 DMA as well.
Look at the Midcap
index. Is there something unknown that is plaguing the street as of now?
Nigel, I don't think so. I think it's just, there is a sense of despondency which is set in. And then you talk to a range of players that becomes very clear on air and sometimes off air as well. That's why I started by asking Harish, a lot of fund managers managing large amounts of money saying that, well, now I'm just sort of protecting NAV, protecting capital, moving to large caps. And some have sort of done it over the last 3-4 months. Some of course, some are doing it now. I don't think there's anything new in that sense the market's responding to. But it's just, there are no triggers at hand. Maybe third quarter earnings, but, again, their expectations are fairly well advertised and little by way of surprise, I think, expected. Maybe in terms of single stocks, etc., here and there, they may be. But on an overall basis, yes, there'll be some strength, etc. But I think, as I said, it's well known and people realize all of that. So without any meaningful turns around the corner, I think it's just kind of a broad sale which is underway. 0.5% lower on the Nifty is what you have. Look at BHEL. We had Renu with us in the morning, right? Renu Bedab IIFL. BHEL is down 5.5%. It's the number one volume-led loser on the NSE. And look at Hitachi, which is Power India. It's down 5%. It's under 17,000 rupees now. And maybe we should look at the others as well, right? GE Vernova, and transformers and rectifiers, etc. I'm not sure if this action there. GE is down about 3%. CG and transformers, 4% on transformers, and CG, etc. will also come up on your screen. So, that's the picture. Just a quick word, Harish, on just that. It's just a market question more than anything else. This is not time correction. Let it correct. Let prices grow into earnings kind of a space. There is aggressive de-risking in mid and small caps, Harish?
Yeah, so I think as you laid out, catalyst in the sense of earnings growth, we do think an incrementally on the margin that is going to be an improving earnings growth, but how much is already in the price? And like I said, the bus is largely overcrowded. When we have, say, 22-23% of total AUM in small cap with 11% profit pool share, we do know that the bus is significantly overcrowded. So it doesn't mean that, you can't create winners out of small caps. But as an aggregate, even if earnings does come through, is there a room for element of surprise? Is there room for element of further buying that can emerge from these kind of names? We kind of think otherwise, and which is where we think that there are pockets of mean reversion rather than looking at the last cycle winners. So I can say that from a small cap perspective, where we do see value and where we are buying in this fall is a lot of consumer names, a lot of consumer-oriented small cap names in the material space, in the consumer durable space. They are available at 3 to 4% cash flow yield, free cash flow yield. I'm not even talking about earnings yield, etc. A lot of them are throwing 500, 600 crores of cash flow available at 14,000 crores market cap with a net cash balance sheet, a lot of capex done. So there is opportunity out here. It is just that a lot of money still is in the winners of the last cycle, and therefore I'm not saying that these names are going to fly through in the next 3 months, 6 months. But we do think that there is opportunity even in the small cap. It's just that the nature of the winners are going to be very, very different, and one needs to therefore view the lens and the opportunity basket from a very fresh lens rather than getting anchored to what we already own.
Harish, we leave the conversation here. Thank you very much for joining in, but we'll watch out for the dark horses that you outlined, which could potentially do well this year: consumer, IT, and materials, which includes chemicals, building materials, etc. But look at the mid-cap index and the small-cap index. The mid-cap index is down 1%, and the small-cap index is down over 1.5%. And this is over and above the 3.5% fall that we had in the small-cap index just last week. And the advanced decline ratio, the gap between the two, will come up. One stock in the green for more than 5 stocks in the red. But now let's focus on the textile sector. The expected ruling by the Supreme Court on Trump's tariff powers did not come through. Now all eyes will be on the Supreme Court as they will deliver the verdict, hopefully, on the 14th of this month. But it's also been 4.5 months where the Indian textile industry has been facing the crushing 50% tariffs. So what's been the situation on the ground? R.K. Vij, National President at Textile Association of India, and Pallab Banerjee, MD and Group President at Pearl Global, are now joining in. Gentlemen, thank you very much for joining in. We were all hoping that the next time we speak, there would have been a resolution to the tariff issue. But as I began by saying, it's been 4.5 months. In August of 2025, Donald Trump, the president of US, imposed a 25% tariffs on India. So since then, we've been reeling with that. So Mr. Banerjee, can you give us the situation on the ground now? And then, Mr. Vij, I would like you to throw in what you've seen in terms of have companies folded? What is the order book? How are they managing this? Mr. Banerjee, you want to go first?
Thank you. Thank you for having me on this call. Definitely 4.5 months, long time. And most of the customers do, at this point of time, don't have, they are not going to give us that support until they see that there is a light end of the tunnel. So that's what is happening for India. For order books and all, yes, all the Indian suppliers, we book the business with some kind of, tariff sharing with our customers. And that's still continuing, but it's not sustainable. And for Pearl, definitely we have options outside of India. So most of this business, we are under pressure to move more and more into those countries. And that's happening. So yes, from Pearl point of view, it is good. We have more than 70% of our business, which is outside of India. And in the India portion of the business of the order books has to be readjusted. It has to be more of outside of US, domestic, other markets. So that's what is going on at this point of time.
Mr. Banerjee, morning, Prashant here. Could you give us a sense of the industry? When you say 70% of your business, what you mean is 70% of the production for you happens outside the country.
Yes.
So in that sense, you are less affected. But India business, you'll have there is a reset which is underway and I guess ongoing. But for the industry now with these tariffs that we've been living with, what is the situation? I mean, is it for those who are largely producing in India and sending it out to the US? What's the situation?
So you see, like 25% of a penalty tariff, that's something most of the customers said no to. So they said that if you bear this portion of the cost, then we continue with the business in India. So that's, I think, most of the manufacturers of India are taking that hit of that 25% tariff, which works out to be about 15% in terms of our first cost. That means whatever my selling price is, if I go down by 15%, the landed cost after the tariff for the customer is almost the same. So that's how it has been for this last couple of quarters. And that's something I think at this point of time, most of the players, the smaller players are definitely going to give up sooner. And that means there will be job losses and factory closures in India to a certain extent if it doesn't get solved immediately.
Mr. Vij, you want to come in? Have smaller companies given up? Have factories been shut down? What is the data on the ground?
I'm just telling Ram Ram ma'am, if you say this now, 50% tariff already is very high for India, because once we are exporting to any country, it takes us to change and anything takes 6 to 8 months. So all the material was in pipeline, machines were set accordingly, and USA was a very big buyer for us. So this 25% higher is a very big hit for us. If you say this Tirupur market, Karur market, and NCR, Panipat market, all are suffering. And about what we have no option. So whatever the material was in pipeline, we were discounting with 15 to 20%, and somewhat the USA buyer also gave us 2, 3, 4% higher than that, but it is not for the long term. Now we have to see how to sustain further. If you see the data of September 2025 versus September data of 2024, the export from India has gone down by 6%. And from China, of course, China has gone down very much, 50%. But Bangladesh export to USA has increased by 10%. And from Vietnam also, it has increased by 2.5%. So, of course, this America is getting the material from there. And now it will be a difficult time how to go further. Of course, with the government support of FTA and other things,
right,
we are started looking after the other market, but it will take time. 7 to 8 months is very tight for us, even for the big player. MSMEs are really hit very bad, even with the big player of Gokul Das, Wellspan, Aryan, and these are all people are suffering because cotton was the major garment we were going to it was going to the America. About out of $12 billion in a year, about $10 billion was going to USA. So cotton is very much hit. Now, one thing is very clear that government, of course, is supporting us in terms of and the credit facilities, but this one, we should have a raw material. Cotton, the government has given us 11% custom duty rebate up to till December, but it has not so far extended. So one thing we need export from the government, that man-made fiber raw material, cotton raw material, viscose raw material should be at international prices so that we can shift over to the other country. And it is not easy to shift over other country because China, which were exporting to USA, has also dropped down, and they are also pushing to the other countries. So this is the time is there, but it will take 8 to 9 months to adjust these things. Of course, PLI scheme is there. Our Indian domestic market is very good, but it will take. It is a very tough time, next 6 to 8 months, and so that we can find out other markets.
Okay, all right. Got that, sir. Palab, coming back to you. As you were mentioning that you're trying to de-risk yourself, and that's why a lot of production can happen outside India as well at the other facilities. We'll just pull up a chart. The facilities that you have all across the globe should come out, and Bangladesh is particularly a large part of it. You're de-risking yourself with regard to exports to the United States. But what about the tensions on the border? India-Bangladesh tensions, well, they have perked up a little bit in the last few weeks. Is that a bit of a risk to your business?
Not really. Because you see, Bangladesh is very much dependent on this garment manufacturing and exports. So what we are seeing, Nigel, is that definitely the industry is doing fine. There is definitely a political turmoil at this point of time. And there are some benefits also, like, India, the domestic market is buying less and less from Bangladesh. So that might be giving some kind of opportunity for the Indian manufacturers to do more of domestic business. But yes, in general, we are not seeing any change. Also, if you look at it, the Western markets, they are doing pretty well at this point of time economically. We thought that there would be, due to tariff, there would be some kind of slowdown or lack of demand, but we have not seen that. Whether it's US market, the European market, or like even Japan and Australia, I think the markets are doing well at this point of time. So yes, it's a little bit frustrating for being in India at this point of time due to this tariff. We are not able to capture this opportunity. But if I look at as just now Mr. Vij also mentioned, the Bangladesh, Vietnam, and other countries, they're experiencing a good growth at this point of time.
Mr. Banerjee, in August, what was the company's exports to the US? And now what does it stand at? Trying to assess if you have managed to diversify your output to other nations, because that process also takes time. So it's underway, the efforts are underway. But to what extent have you managed to do it? So if you could share some numbers to illustrate that.
So yeah, for example, if you look at Pearl Global, we have almost 70% of our manufacturing was happening from Bangladesh, Vietnam, Indonesia, and Guatemala. And India was constituting about 30%. And in that 30%, we had almost about 50% was a US market and the 50% was the rest of the market. So the trend that we are seeing now is that US market is going slower. That means it's diminishing for India manufacturing. And that part of the business, if I look at US specifically, I'm experiencing a significant growth both in Bangladesh and Vietnam and Indonesia. Of course, Guatemala is favorable for US always. So these are the places where we're seeing a significant growth that's happening, not only for US, but if you see that the Western markets like UK, Europe also have done some kind of FTAs which are already active in Vietnam now. Bangladesh always had it. So that way, like we are seeing growth in these markets in terms of my order books, a significant growth. If I talk about India, yes, that 50% of the US component is slowing down a bit. I have to quickly replace it by other markets. So that's the transition that we are going through. So maybe like this particular year, I might drop down the India share a little bit just to compensate this, because other important part is US was the most, I would say, attractive market. The order sizes were good, customers were reasonably good, and good pays. I would say the price points were better. As just now, Mr. Vijay also mentioned that there are a lot of dumping happening from China to other markets, whereas US and the Western markets were more clear of, to reduce or de-risk from China. So that's helping in terms of the other markets, whereas for India, we have to compete in all these other markets. United Kingdom, we had a FTA which has been signed, but it's not yet actionable as of yet. European Union, we are expecting, but yes, a lot of geopolitics at this point of time, and we don't know which way it will go.
Okay, all right, gentlemen. We look to reconnect with you all and get an update. Hopefully, things flow in our favor. In fact, companies do battle past this a bit of a difficult phase and then conquer in the time to come. Thanks a lot for joining in and giving us your perspective. Well, the markets did see a bit of a bounce from the lows of the day, but that got quickly sold in too, and we're back down close to around 130 points or thereabouts. Extremely crucial zone. This 25,500, 25,550, extremely crucial zone. You don't want this level to break on a closing basis. For the time being, we slip into a short break. On the other side, Manisha Gupta is waiting for us. She'll turn the spotlight on the commodity space. Welcome back. Markets are still down 130 points, but some of the larger constituents are trying to fight for the bulls. I think HUL is a stock that's now moved to the high point of the day. It can do little actually when you have this sort of selling, but that one as well is holding one end up. Interglobe Aviation actually has cut its losses, so that one comes up for you on the screen. I'm not sure whether or not the street is believing that the FMCG index could be the pocket to hide, because that index is trading a little bit in the green. But let's get you some commentary that we got over the weekend actually. SEBI chairman Mr. Pandey indicated that the process of granting an NOC for NSE's IPO is nearing completion. Let's listen in to what he had to say.
I think we are at very advanced stage of issuing the NOC for NSE IPO. When can we expect? Maybe within this month.
All right, eagerly watched NSE IPO could be getting a bit of a leg forward. But let's also listen in to what the NSE MD and CEO, Mr. Ashish Kumar Chauhan, had to say on the potential IPO.
Today we had a great darshan in the early morning at Tirupati Tilumala Devasthanam. We took blessings for NSE and for all our members or our shareholders and the country. Yesterday only the Honorable SEBI Chairman announced that this month NSE will get an approval for IPO, and we had planned this Tirth Yatra long back, but it happened that yesterday only when we arrived in Tirupati, the announcement was made. So we think it is a good omen and God's blessing that this announcement has come from SEBI.
Well, the SEBI chairman also commented on the further course of regulatory action in the derivatives market. Let's listen in to comments on that front.
In the derivatives, we have taken a number of measures, as you know, earlier, first in October 24, and then in May 25, and the last of the measures got kicked in December 25. So we are looking at the data, and after the data is there, we will be able to define our next course of action. So at this moment, I don't think that we are going to disturb anything.
Okay, all right. At least we've cut our losses by close to around 50 points from the low point of the day. Coal India has moved up a little bit. I don't know, maybe, actually the Nifty Bank that was down 280 points. That's cut its losses, and that definitely helps because it's the largest constituent of the index. It's gradually moving towards the 20 DMA. Boy, oh boy, I'll tell you what, the bulls will want it to get closer to around that mark on a closing basis. For the time being, some bit of a relief rally. To be fair, actually, the Nifty has cut its losses by half from 160 points down. Now we're down only around 80 points, but we need to sustain these sort of levels and then hope. First, the Nifty needs to stop falling. And then since you have a market that's net short, the odds of seeing a short covering bounce actually move up. So that's the important trigger on the index. Let's address a couple of pockets of stocks, though, that are reacting. Vinny joins us to tell us about the capital goods stocks. Vinny?
Hi Nigel, good morning. So these capital goods stocks, if you see, since the second half of last week, we've seen them see a fall coming. And why? First, there was a report that came in that Reuters said that there's a high-level government committee that came in. They're recommending that, Chinese firms now could start bidding for these government contracts, especially coming in for power, railway and other sensitive contracts. Now, these restrictions were placed on these contracts when? In 2020. Now, obviously, there's an impact that comes in for all these companies if these restrictions are lifted. So, we started seeing a sharp correction coming in. When you look at L&T, BHEL, which are mainly into boiler turbine generator suppliers. So, BHEL, these were the contracts which they spoke about that maybe the restriction could be lifted on this one. Hitachi Energy, GE Vernova T&D, Siemens Energy, CG Power, they are in the power sector equipment play, as well as other stocks like transformer rectifiers, ABB, Siemens. All of them also fell in trade or are falling even today. Why? Because they're a part of this manufacturing supply chain. Then there was a clarification that came in, also reports that was suggesting that, maybe this is not going to be happening. And as of now, as per CNBC TV 18, the sources also suggested that no decision as such has been taken on this front. So that was an important update. But despite all of this coming in, there was no respite for any of these stocks. Today also a sharp fall continues for them. Now, what are brokerages suggesting? Whether you look at something like an IIFL, we spoke to Renubet today as well. What is suggested that Chinese company TBEA is likely to participate in this power grid tenders, and only restriction maybe is likely lifted for only these high voltage transformers or reactors. On those fronts only this restriction is lifted. This is according to the channel check that she suggested, but not as a whole for the sector as a whole, that Chinese companies can participate across the capital goods or industrial sector. It's not across that. That is what brokerages are highlighting. Even IIFL said that as well. Now, Jeffries also is saying that if this actually happens, highest impact coming for BHGL, L&T, Afcons, ABB, CG Power, low impact for defense companies, and T&D companies would see a lesser impact coming in as well. Bernstein also said that industry checks are suggesting that relaxation is only in some of these sectors, not all of the sectors, or some particular products. So important update is that if it comes in, it could be only for some particular products. As of now, there's no decision that's coming on this front, but pressure continues on the sector.
Thank you very much for that. It's over to Sudarshan now for more on Meesho and Grow.
So to initiation, BofA Securities has initiated coverage on Meesho with neutral call and targets given is of 190 per share. It says company is well placed to target value-focused mass market segment, and it believes that in FY 26 to 29, NMV CAGR can be as high as 26%. And adjusted EBITDA margin from FY 26 that company had reported of -3%, it can increase to more than 3% by FY 29. So from -3% FY 26 to +3% by FY 29. And at current levels, valuations are factoring strong fundamentals, and tailwinds are room to gain market share, fintech scale-up, and grocery expansion if company plans to undertake. Second one is Kotak Institutional Equities has initiated coverage on Grow with a buy call and targets given of 190 per share. And its constructive medium-term views factors in few positive catalysts. First, durable product-led growth flywheels. Second, expanding monetization across broking, margin lending, wealth, and consumer credit. And last one is scalable in-house technology. So positive brokerage notes for Meesho and Grow.
Okay, all right. Thanks a lot for that, Sid. Well, let's also focus on a couple of these other names. Premier as well as Wari, they are in focus post the news flow coming in for China over the weekend. Vivek joins us to decode that for us. Vivek?
Well, that's right. So on January 9th, the Chinese Finance Ministry went ahead and cut export rebates, cut the kind of support that they were giving to a whole host of value chain additive companies across quite a lot of sectors, key amongst them being the solar renewable energy sector. Now, what actually has China done? China has gone ahead and cancelled value-added tax export rebates for photovoltaic projects, and this will be effective from April 1, 2026. Now, remember, China had previously reduced the export tax rebate for photovoltaic products to 9% from 13% in December 2024. So now overall, how do we look at this particular impact as far as the India value chain is concerned? A whole host of PV modules, cell companies will marginally benefit. So names like Premier, Wari, even Vikram Solar, MV Photovoltaic, all of these names marginally benefit. And even a name like a Borosil Renewable, given the fact that solar glass too comes at much cheaper rates from China. But one important thing to note is that the Indian domestic market already has quite a bit of support. There is a 40% ADD on solar modules, a 25% ADD as far as solar cells are concerned. And along with that, there is also support in the form of ALMM, which is the approved list of module manufacturers, and also an approved list of cell manufacturers. Only those companies incrementally will be able to supply to renewable energy products. It's a mild negative for RE developers, but a marginal positive for PV module makers as well as cell suppliers.
Thank you very much for that. Almost 10 o'clock. Let's just get in Vinay Rajani of HDFC Securities now for a quick technical check on the market. Vinay, tough morning, tough start to the week, but markets trying to bounce back a tad bit. What is your read of the first 1 hour of trade? And would you have a strategy on the Nifty Bank and any of the big stocks?
Yeah, good morning. So tough day, definitely. And it has been 6th consecutive day of fall. And Nifty has already witnessed a 850 points fall from the recent swing high of 26,373. So it has been quite weak setup and we have been underperforming the global markets. Despite positive cues from the Asian markets, we are not able to recover. So that is a bad sign. Positionally, we are now below 50, 20 and 100 days exponential moving average. That is also another weak sign. But yes, since we have fallen a lot in last 6 sessions, we cannot rule out the possibility of the pullback in the market. So yes, there was the previous support at 25,700. Up to that level, we can see some recovery from this level. So risk reward ratio is not favorable going short over here because it looks oversold on the short term charts. So I'm expecting some pullback rally to come in the Nifty in the range of 25,700 to 25,750. There could be a bounce up to that level. So better to wait for that level to come and then you can think of going short again. But as of now, it looks quite oversold. Wait for a pullback and pullback should be around 25,700 to 750. And Bank Nifty also closed on a weak note. So in that also, it would be better to wait for a pullback and then we can execute the short strategy. So oversold right now, but positionally definitely it is weak. So lighten your commitment at higher levels.
Okay, all right, got that. Oversold, a bit of a recovery, but you could lighten yourself in case you do get a bit of a bounce. Vinay, what about individual stocks? Give us some ideas.
Yeah, so looking at the global commodities, industrial metal strength, I still feel that the stock like Hindustan Copper can do well. So it has been very strong in recent past and still looks like that it is headed higher. So Hindustan Copper can be traded long around 528. I would suggest a stop loss at 515. On the upside, I'm expecting a target of 515 in a couple of sessions. The another strategy would be to sell in the some of the capital good stocks like Cummins India around 4050, 4070. One can look for shorting in the January future. I would suggest a stop loss at 4130. And on the downside, I'm expecting a target of 3980. So Cummins India on the short side, which is January future, and Hindustan Copper on the long side with a stop loss of 515.
Thank you very much for that. And now let's turn our attention back to the commodity markets. Manisha is now joining in. Manisha, what are you looking at?
Well, all-time highs that the precious metals seem to be trading at is something that we'll need to talk about because gold is now trading at $4,600 an ounce. We have seen prices gain up by 4% in the previous week. And when you look at 2025, as we've been discussing, it had gained 64%. So the rally really started in the 2023 in the month of September. But from the 1st of January to where we're trading right now, gold prices have given you 140% returns. If you look at overall demand, apart from the geopolitics and macros as well, the estimates are that for 2026, the demand for gold globally could hit 4850 tons. Now, this is the highest since 2011. So we seem to be making records in various directions there. Take a look at the silver prices. 4% of gains is what we started Asian markets with. Last 1 year has seen 182% of gains come in for the silver prices. And this year, so far, we already have done 17% of gains there. Support clearly coming in from the weaker than expected U.S. payrolls data. Markets were anticipating a 66,000 of a number. What we got on screen was 50,000. That has led to a decline in the U.S. dollar index, supportive for precious metal prices. The street also estimates that with the kind of jobs numbers that we are looking at, you could be looking at least 2 rate cuts in the year 2026, and that in turn also has been supportive for the prices there. Also, it has been about safe haven buying. The US-Venezuela tensions has been supportive for gold prices in sense of tangible buying there. And then there is also unrest in Iran intensifying. That has been supportive for global gold demand. The dollar index declining as a criminal investigation on the Fed chief Jerome Powell puts Fed independence into question has been one of the reasons that we've seen a lot of safe haven come in for the tangible commodities. So when you look at what the markets will watch out now for is in focus is the U.S. inflation data, and the key bank earnings this week is what the markets will take cues from. In the meanwhile, you also have, over the last 2 or 3 days, seen more reports coming from the international banks. UBS for now has changed its estimate for the gold prices, and this year they believe that $5,000 an ounce is a possibility by the month of March. HSBC, in the meanwhile, also says that the first half of 2026 could see $5,000 an ounce for the gold prices. Last split should come in on your screens, which shows you on what we've done in sense of commodities for 2026 till time. So gold price is already up 6%. Silver outperforming yet another year until time, at least 17% of gains coming in for this one. Copper, we've seen all-time highs in the previous week, and we've seen 5% of gains already for this year. Crude prices, 3 years of decline. This year has started positive, 4% higher. Aluminum is gained 5%, and platinum continues to be in that race as well, 15% up already in 2026 for that one too.
Okay, all right. Thanks a lot for that, Manisha. For the time being, we'll slip into a short break. On the other side, an exclusive conversation with the Asia head of private equity, Warburg Pincus, on their 960 crore rupee investment on Lemon Tree Hotels and more. Stay tuned.
Hello and welcome to this edition of the Newsmaker. Over the weekend, a big deal in the hospitality space. Lemon Tree Hotels has announced a strategic reorganization of its business, creating two distinct platforms, an asset-light hotel management company and a scale hotel ownership and development vehicle, Fleur Hotels. As part of that transaction, Warburg Pincus, the private equity giant, is acquiring APG's entire 41% stake in Fleur Hotels and committing up to 960 crores of fresh primary capital to support its next phase of expansion. It is also a renewed partnership. Warburg Pincus was an early backer of Lemon Tree nearly 2 decades ago, helping build what is today one of India's most recognizable mid-market hospitality brands. The latest investment comes at a time when India's travel, tourism and discretionary consumption cycle is seeing a structural upswing supported by infrastructure build-out and rising domestic demand. With such a landmark move to kick off 2026, we thought it would be the perfect opportunity to speak with one of the primary architects of this strategy. We are joined today by Vishal Mahadevia, Managing Director and Head of Asia Private Equity for Warburg Pincus. Vishal also serves as the Global Co-Head of Financial Services, a role that is particularly relevant given the firm's recent successful $3 billion close of its third financial services fund just a few days ago. Well, this interview also comes at a momentous time for Warburg Pincus as the firm celebrates its 60th anniversary this year. Since its founding in 1966, the firm has become a pioneer in global growth investing, now managing over $100 billion in assets across more than 215 portfolio companies. In India, Warburg's journey began in 1996, making them one of the earliest and most successful global PE firms in the country, with roughly $10 billion invested in India to date. Their portfolio reads like a who's who of industry leaders, from the early success of Bharti Airtel to current powerhouses like IDFC First Bank, CAMS, Kalyan Jewellers, and many more. Air India has, of course, been one of the large new bets as far as the consumption space is concerned. Vishal, of course, has been at the center of that journey, helping deploy capital through multiple cycles, build scale platforms, and deliver some of the market's most closely watched exits. Vishal, it's a pleasure to have you with us here. Thank you very much. Thanks. Congratulations on the big deal with Lemon Tree. And of course, I mean, at the outset, let me say congratulations. 30 years of Warburg in India, 60 years of Warburg, I mean, as a firm.
Thank you, Prashant, and it's great to be here. Thanks for having me. It's actually quite amazing. 30 years, 3 decades in India when we first came out here. I think the economy was less than $500 billion GDP. It was really not on anyone's radar. And being here for 30 years, through ups and downs, through all these cycles, we're just terrific. So happy to be here. And we're lucky that we've been able to partner with some of the best entrepreneurs. And you started out talking about Lemon Tree, but to be back with Patu, as when we just started more than a decade ago, working with him, it's just been terrific and great to be back with him.
We'll come back to you know, a little later in terms of the journey of Warburg itself and what's ahead. But Lemon Tree, I mean, you're coming back in a way, right? Because you were there in the beginning 2 decades ago. Small company, it's a very large sort of company now. What's the logic? And just tell us a little bit what investors should expect now after this transaction goes through.
Sure. Look, I'll give you 2 very simple reasons we're back with Lemon Tree. And number 1 is Patu. I think in India, in 30 years, we've seen who you do business with, who you partner with, is much, much more important than the company that you invest in. And so a chance to come back with Patu and his entire team and seeing how they've grown and built really one of the leading hospitality businesses in India is terrific. 2, I really think hospitality is at an upswing. You've got all the reforms, the infrastructure build that's happening in the country. You've got a more affluent consumer in the country that's aspiring, that wants more. And as you have this increase in domestic travel, not just tourism, but even business, even overall larger and larger companies, I think Lemon Tree is in a great position to benefit from that. And really, with our capital and hopefully with our partnership, grow that business.
You're also buying out APG's 41% stake in Fleur, right?
Yes.
What was the logic there? And I mean, was they had to get out? They wanted to sell, and what? Just talk to us a little bit about that.
I won't comment on APG, but I would only say they've, as they've said publicly, they've done very well. They've been great partners for Patu. But like all financial investors, there comes a time when you've generated very good returns for your partner, and the partner needs an exit. And we were lucky enough with Patu to be able to buy out the stake, come back in, and be a partner with him, and not just buy out their stake, but really provide this additional capital to help grow Lemon Tree, which is the fuel again for the hotel business.
So actually, the overall transaction is much larger in that sense.
Yes,
right?
it is.
There's that 41% for what you're paying. I mean,
that's exactly right.
A meaningful sum, and then there is this primary capital of 960 odd crores as well.
That's right. The overall transaction size is multiples of the 960 crores, and hopefully there's even more of that in the future, because we are very positive on both Lemon Tree and the hospitality business in India.
And this, I mean, the logic behind asset light and I mean asset heavy is two distinct entities now, right? In that sense,
I think there will be two distinct entities because two have very different capital needs. And really someone with our capital and the scale of our capital should be in the asset-heavy entity to help them continue to grow where capital is required and us to come in. And there is a asset-light business at Lemon Tree that will continue. And both will really continue to thrive side by side as they become public companies.
Typically, I mean, this kind of a bet now is going to run for how many years? I mean, this is you're in it with no finish line in that sense?
Yeah, no finish line, only because it's so hard to find good people and good companies to invest in. And when you find it, as in private equity at least, you then want to be in there.
And then come back.
Continue there.
Come back.
Yeah, exactly. Why not? Why not?
The investment in Air India, right, with Bharti Enterprises. And of course, I mean, you work with Bharti. It's been one of the oldest associations here in India in that sense. Again, it's a consumer bet. So talk to us a little bit about that. What do you aim to achieve with that one?
Yeah, look, Haya India, amazing company. They've grown 25% compounded annually over the last however many years, grown to become the #3 brand in India in white goods. We've known Haya very well for years. We've known Sunil, of course, go back to our early days in India since 1999. When we made our first investment in Airtel, when it was just a North Delhi cell phone company. And we've come back again with Sunil in the past. So it really is, you see a little bit of a theme. Who we do business with is important. And a chance to partner again with Sunil, to partner with Haya in this new structure, and then create another Indian champion. Make in India, make for India, alongside Sunil, who understands the Indian consumer as well. I really think it's a terrific cocktail. A lot of hard work, a lot of execution required, but the opportunity is tremendous. Again, affluent Indian consumer. They want to buy better goods. They want value for money for their purchase. They trust brands. They want better technology. So all in all, if you can pull all of that together, I think Haya in India can have tremendous success.
You know, the big story for the last 15, 20 years with regards to the consumer in India is that, I mean, we all used to look at what's happened in China and say, well, you know, look category by category. What's happened here, there will happen here. I mean, you know, per capita consumption of this and that, etc. I mean, everything from ACs to footwear to everything. I mean, you have extensive amounts of experience in China. You travel extensively across Asia for that matter. Is that thesis still correct? I mean, that is the broad way to look at it, or is there a change?
No, I think I would say India will develop very differently in terms of both the speed and the level of its penetration rate and what consumer categories India will have. But the direction of travel is undisputed. In fact, what really changed, I think, for India and accelerated that trend from unbranded to branded, from unorganized to organized, was COVID. That actually changed everything. People were more comfortable using technology, buying online, paying online, digital payments, everything enabling that system, along with the government regulation that happened, you know, a decade ago. It just accelerated this trend. And so you have the Hayas of the world. We invested in a company called EBCO, in a company called WaterTech. As you go down that list, I think that trend is accelerated. It was always there, but Haya sits in the forefront of it.
So from a consumer perspective, the broad bet is premiumization across categories.
I think
that is what you're betting on.
I think the broad bet is premiumization at every level. So someone at the bottom of the pyramid is premiumizing what they used to buy, and someone in the middle of the pyramid is premiumizing what they need to buy. So it's not just premium products. I actually think you want to be able to serve that mass market in India, but every Indian consumer is aspiring to buy a slightly more premium product. And you have to be able to cater to that with good value and better products.
You know, what we're going to do, Vishal, is take a quick commercial break here. We'll talk about financial services. So many transactions lately. You've closed a very big fund, and I'll ask you where you plan to invest and put some of that money, especially in the Indian context. So stay with us. We are back with Vishal Mahadevia, Warburg Pincus, in just a bit.
Fly Emirates, fly better.
Welcome to the Syngenomics, which is a very important one on the capex cycle. The GDP advance estimates announced last week showed a very strong rise in investments, or what the GDP data calls gross fixed capital formation. Investment is seen rising by a strong 7.8% for the full year, real GDP, versus 7.1% last year. And for only the second half of this year, investment is seen growing by 8.1%, 7.6 in H1 and 7.4 year ago H2. So strong data. The data also shows that if one went only by nominal GDP, the share of investment in total GDP is 30%, or 107 trillion rupees. Now, the central government's capex is budgeted at 11 trillion. While the states have budgeted around 10 trillion, they don't always reach that number, which means over 80 trillion or 80% has to come from the private sector. So, is the private sector capex that good? That's the question we're asking. And joining us is Mahesh Vyas, founder and managing director of the Centre for Monitoring the Indian Economy, and K. Ravichandran, chief rating officer at ICRA. Gentlemen, good morning and thank you very much indeed for your time. Mahesh, directly that question to you. Your private sector data that you gave me, and we will flash it, is showing a seminal step up after around 2022. But is it strong enough? What's your overall sense?
I think it is strong. It's not great. It's not like the roaring investment cycle that we had a few decades ago, but it certainly is perceptible. Compared to what we saw in the preceding 5 quarters, the most recent 5 quarters certainly show there's a pickup in investment, and that investment is led by the private sector. And happily, that's also led by the manufacturing sector. So I would say that there are good tidings indicating that private sector investments are picking up.
Okay, but what about the completion? You also gave us a list of completed projects, and whereas at this, a decade ago, the percentage completion was about 25%. Now the percentage completion seems to be only 10%.
Yes, nevertheless, the completions this year in the recent past compared to the earlier times is still better. I agree that the completion rate has slowed down, but I think these numbers will get revised. The earlier numbers are fully revised, all revisions taken care of, whereas the most recent year's numbers will get revised upwards, and this difference will reduce. And nevertheless, this doesn't take away from the starting of an investment cycle, which is you begin by new investment announcements. And it takes time for completions to catch up.
Fair enough. And FY24 seems to be really strong with private sector investments at some 32 trillion in terms of announcements. Mr. Ravichandran, thank you for your patience. Well, the eye-opening part of the private capex cycle report that ICRA put out is that private sector actually forms a very small part of overall investment. It's only 32%. And within that, the listed universe is only contributing 5% of overall investment. Can you give us a perspective? Is that 5% at least growing?
Yeah, so in the case of private sector capex, the story is very different between listed and unlisted companies. If you look at the top 20 business groups in India, most of them are going ahead with their capex plans, whether it is in the new economy, like the renewable energy, battery storage, pump storage, and electric vehicles, and so on and so forth. In addition to traditional world economy sectors like steel, refineries, petrochemicals, and so on and so forth. In our estimate, capex with these large companies, industrial groups, has been growing in double digits, 12 to 13%. Whereas the story is very different in the case of unlisted space. Unlisted space accounts for almost 80 to 85% of the overall capex. That is where the problem lies in, where we believe the capex has been muted and it has been growing in single digits, perhaps 4 to 5% kind of a growth. A lot of SMEs and small enterprises, where because of the external demand environment and domestic related demand related factors, there was no need to add capacity, and import threat was also fairly at a high level. Because of that, unlisted space is where perhaps we require more attention. On the listed space, large conglomerates, they are pretty much going ahead with their stated capex plans.
Okay, but Mr. Ravichandran, are you getting the sense that Mahesh Vyas's data is showing that there is a kick up from, say, post-COVID, say 23, 24?
Yeah, certainly. One can see that from the the wholesale credit growth as well. While till now, one of the major issue has been that companies were not borrowing much. While capital formation was happening, it was not getting reflected through credit growth, because a lot of the capex was getting funded through internal accruals, and there was no need to tap either the bond market or the bank loan market in a meaningful way. But of late, even that also has been gradually showing signs of improvement, and largely it is coming from the both the kind of sectors, clean energy sectors as well as old economy sectors. We believe the capex has been inching up, and largely to do with domestically, to address the domestic demand, while export focused businesses are somewhat affected. But with regard to domestic demand per se, whether it is steel consumption, cement demand, or oil and gas, petrochemicals, etc., where it's largely domestically focused, and to the extent that there's no need to be worried about demand related issues.
Fair enough. Mahesh, CMI has been doing this for what, last 3 decades or even longer, the collection of private sector data. I think I came to the CMI library as a student, maybe in the late 80s, if I remember right. Now, what is the perspective you have? You're saying that there is this very good kick up in overall investment as well, post-22. How does it compare with the historical trend?
Well, so one needs to see the nature of the cycle. That there has been a prolonged, rather very prolonged period of extremely anemic growth in private capex. A very long period, almost from 2011-12.
Okay.
And compared to that, in the recent times, there is a pickup from 22, 23, and so on and so forth. That, compared to the most recent part, is a perceptible increase. But compared to what we saw in the, let us say, in the decade of the 1990s, that was something completely different. That was an order of magnitude much bigger than what we saw now. And I also agree that the investments are more concentrated in the larger enterprises, in the larger conglomerates. So the smaller companies are not investing as aggressively, but there is a new thing now is that there are many more startups coming with very aggressive capex plans. Not talking about the IPOs, which are largely not capex, but still there have been in the recent past a lot of new capex, which is happening by new startups. So the nature of investments is changing. It is not as aggressive as it used to be in the past, but there is a change. There is not just the capex database that you alluded to, Lata, that I will point to. I always compare this capex data with the net fixed assets growth of the listed companies and even the unlisted companies. And if I see the listed companies, because we have the September 25 results now, what we see over there is if I look at the 5 quarters ending September 2022, the average growth in net fixed assets was 4.5% year-on-year growth. And in the next 5 quarters, that growth goes up to 6.5% average. And the average is a good average. These are not some outliers canceling out. They're very close. 4.5 moves up to 6.5. But September 25, that number is 9.5.
Oh.
So, this is an indication that there is an increase in the capex cycle going on. These numbers used to be of the order of 20% in those great days.
You mean 90s or 2000s?
In the 2000s. Okay. In the 90s, sorry, in the 90s. 97, 98, 96, 97, 98, 99, that period, we saw 20% year-on-year growth in capex. But let's not belittle even this 9.5%. It's come after a very long time.
Okay. Well, that's good to hear. Mr. Ravichandran, a slightly unfair question in the sense it's an economist's question. Both you and Mahesh agree that you are seeing a step up in private sector investment from in the post-COVID period. And we know the data is very clear that government capex has, risen manifold in the period. Let me just inform our viewers that government forms a very small part. Central government, it's just 10% of the overall GFCF, gross fixed capital formation. But that said, Mr. Ravichandran, would you say that points out to a period of higher productivity and higher margins since so much investment is happening?
Yeah, in fact, if one were to look at this ICAR, the incremental credit output ratio.
Yes.
Where, India has been one of the best, in terms of, capital efficiency. So from that point of view, our investments are really delivering in terms of, achieving this kind of a growth. That is something one can see from the, the stated, the economic indicators.
Okay. Yes, sir. ICOR, I didn't want to use the jargon, but you're right. Capital output ratio, incremental capital output ratio does seem to be falling. You're getting more output per unit of capital that's coming in. Mahesh Vyas, would you say, therefore, that we are on the inflection point of probably a good capex cycle?
There are indications to that. I would still not say that we are at that inflection point, but we certainly seem to be heading towards that.
Okay. And Ravichandran, last word?
Yeah, I mean, I wouldn't say, full-fledged kind of a, recovery. Gradual recovery is seen, and for us, key thing would be to address this external, tariff-related headwinds. The moment, we are clear on that, I'm sure, there can be sustained, recovery on the growth side.
Okay. Yes, I take your point that the tariff introduces a great deal of uncertainty. But even global growth has not been impacted as much by tariffs as we thought. Global GDP has done reasonably well in 2025. Plus, we are more a domestic-facing economy. So one hopes that, that uncertainty need not stop what both of you agree is a fledgling private capex cycle that has started. But I just want to remind everyone of the data that both of them are putting in. Listed companies form a very small part of the overall capex. Households form the largest part. Therefore, we want the real estate cycle also to continue because dwellings is a large part of India's gross fixed capital formation. A great start to the new year from two people who are, very sincere observers of the economy and very informed observers. Thank you very much, Mahesh and Mr. Ravichandran. We have to wrap up on Bazaar Chartbusters coming up.
BHEL and Hitachi Energy fall for another session as the risk of more competition if the government eases curbs on Chinese companies continues to weigh on sentiment. The stocks continue to lose.
Tejas Networks is down 8% in trade as the quarter-3 revenue remains weak on a Y-on-Y basis. The weak sales and delay in major BSNL orders impact the company in the third quarter.
Real estate player Signature Global slips in trade after the company says they will fall short of their FY26 projections for pre-sales of nearly 12,700 crore amid a weaker macro environment.
And Avenue Supermart shares surge almost 3%. Post the company's quarter-3 numbers, the margins rise to around 8.1%. That compares with around 7.6% on a year-on-year basis, while the EBITDA grows 20% during the same period.
It's a cnbc TV18 news break that's confirmed. Lemon Tree Hotels in green after it announced a major restructuring plan to unlock value, split its asset-light business, and bringing Warburg Pincus as a strategic investor in Fleur Hotels.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you can see, the market's in the red yet again. The only solace is that the Nifty Bank at least has come off the low point of the day and the breadth of the market has improved a tad bit. But nonetheless, another down day, and holding on to the 25,500 mark, Mangalam, is going to be extremely, extremely important. Because otherwise, you can argue that there are a couple of parameters stretched, moving to extremes. But the selling, first out of trade, there's no trigger for the markets to be down 100, 120 points.
And there's no respite to that selling, despite the selling that we've seen for the 6th straight day, if you're looking at the frontline indices. And even as the Nifty Bank has recovered from the lows, still sitting with a cut of almost 150 points. If you look at a couple of these auto names, they are selling off quite sharply, vociferously, in fact. Eicher Motors, the intraday chart of that one comes up for you. We're also seeing a big gash on names like Bajaj Auto, as well as Hero MotoCorp, the two-wheelers in particular. And if you pull up the auto index, that will tell you that there is weakening on that front. And also, the pharmaceutical names, which were doing well earlier, have come in for a bit of selling. Yes, the market breadth has improved, but still 2,150 stocks in the red for about 624 stocks in the green. So good time to welcome Shivangi Sarda of Motilal Oswal for a quick technical check on the market. Those lines run like train tracks. Shivangi, there has been no respite. The Nifty straight off the bat, down about 120 points.
For having me. So we've seen that profit taking has taken over most part of the week in the previous week that we saw, and it has been trailing in this week as well. We've seen that important support levels have been broken. 50 DEMA has been broken, and now Nifty is nearing another important level, which is 25,500 marks. Now, if it manages to hold these levels, then we could see some consolidation here. Of course, upside still remains capped because of the lack of follow-up that we're seeing in the broader market. But of course, if it breaks 25,000, then we're looking at 25,200 next on the downside for Nifty index. But of course, India VIX has also risen by more than 20% in the last 10 trading sessions. And we are seeing that there is some bit of concern prevailing in the market thanks to the global geopolitical tensions as well. Talking about Bank Nifty, this one's comparatively resilient and is still holding above its key exponential moving average on the daily frame. And it has dropped less than the entire broader market. Of course, thanks to some of the PSU heavyweight banks that are still holding strength. Now, Bank Nifty hasn't, stepped down of 58,750 levels, which is an important support. This will be a make or break zone for Bank Nifty. If it manages to hold above these levels, then we could see some stabilization here with an upside target of around 59,500 marks.
Got it. All right, Shivangi, good to see you in. What about individual stocks? What's on your radar?
So, of course, Nigel, with this trend that we're seeing in the financial space, my first pick would be on Muthoot Finance. We've seen that this one has been quite resilient despite the market volatility. And we've seen that, this actually has been performing continuously from the last 35 months, maintaining an upward sloping channel. So quite a lot of strength here. Of course, we are seeing some bit of softness from the last three trading sessions, but overall it has correctly taken a support near its retracement level, which is looking quite positive here. So recommending a buy here with the next targets of round about 4,020 levels and a support of 3,770 zones. And the second pick on my radar would be Vedanta. We've seen Metal Pack has been outshining, and Vedanta has been one stock which has been resiliently more stable than the other metal counters which have seen a lot of swings. So Vedanta is one stock which is looking quite positive. It has given a pole and flag pattern formation breakout from the monthly frame, which is making a good upside potential for this one. So recommending a buy here with the next target of 650 levels and a support of 612.
Okay, all right. Thanks a lot for that, Shivangi. Well, let's turn our attention now to our special segment, where we get you a few ideas for profit from Money Control Pro. Lekha Badlani of moneycontrol.com joins us to talk about a stock that she's tracking closely. Lekha?
Our stock pick is Landmark Cars, a leading dealer of premium and luxury vehicles in India, well placed to benefit from an improving demand environment and operating leverage. Following the temporary demand postponement caused by GST 2.0 transition in September 2025, which weighed on Q2 FY26 volumes and margins, industry conditions have turned favorable. Lower interest rates, reduced GST on ICE vehicles, festival season demand, and OEM-led promotions are driving a recovery in showroom footfalls and bookings. Passenger vehicle volumes have already recorded double-digit YOY growth in the October-December quarter, supporting a strong H2 FY26 outlook. Landmark's strong OEM portfolio remains a key differentiator, while Mercedes-Benz continues to anchor the luxury segment and support higher ASPs. A robust pipeline of new launches from BYD, Honda, MG Motors and M&M is improving volume visibility across price points and customer segments. On the operational front, most of the Landmark's organic expansion is now largely complete. The focus has shifted to ramping up existing outlets, improving throughput and enhancing efficiencies, setting the stage for margin recovery as volumes scale up. Importantly, the after-sales business, though only 20% of the revenue, is a high margin and stable earnings driver. Lower GST on spare parts improves the competitiveness of the authorized service center, supporting steady cash flows and reducing earnings cyclicity. After a 25% correction, the stock trades at around 15 times FY28 estimated earnings and offers an attractive entry point for gradual accumulation.
All right, few stocks which are bucking the trend and currently doing better. Coal India is one, it's up around 3%. NTPC is the other one, which is up around 1% as well. And we are seeing some traction in trend. After the week last week that the stock had, seeing some recovery from the lows, up around 1%, sitting over that 4,000 rupee mark on that stock as well. Take a short break, come back, focus on a lot more stocks which are in the red than the number of stocks which are in the green.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. The markets continue to remain under some pressure. The hope is that at some point of time, we can see a bit of a recovery. I think first we need to stop falling, which is very, very important. And we need to defend this 25,500, 25,550 odd mark. But we're looking for some good news today. And Mangalam brings us that. Avenue Supermarts is a stock that's trading in the green. Mangalam, run us through some good news.
Well, Nigel, same time last Monday, the stock was lower. So that was bad news then. But now
you're giving us
the good news is coming this next Monday itself. The thing was that, when the company reported its quarterly update, 13% revenue growth. The street did not like that. They thought it's lower. But the sense one got that time was that maybe we have, realizations which are lower because of the GST cuts that have happened. And now that is confirmed in the numbers that are reported because margins have been a very positive surprise. Most on the street were working with an 8 to 10% revenue EBITDA growth after the company reported a 13% revenue growth. But the company has gone ahead and surprised. It's a 20% EBITDA growth, and consolidated EBITDA margins, where the street was expecting a compression, has actually seen an improvement, and that improvement is gross margin led. So it means that there were lower discounts, and at the same time there was perhaps a higher share of revenue coming in from their own product labels, on which the company has been fairly aggressive but not vocally so. Revenue growth, the management said, was partially impacted due to deflation in staples, but a 13.5% revenue growth on a consolidated basis does imply that there was 500 crore worth sales coming in from DMart Ready without an incremental EBITDA loss. That's a positive, and margins at around 8% with a net profit growth of about 18.3% as well. And the company last year had 16 million square feet in terms of retail space. Now that number's turned to 18 million. And average revenue per square foot hasn't fallen as much despite the realizations coming down. And the store additions have been positive as well. In the first 9 months of this year, they've added 27 stores. The street was working with a number of anywhere between 20 to 25. So store additions positive, margins positive. Two positives outdo the negative, which was revenue growth, which was obviously understandable and explained by the company.
Okay, all right, Mangalam, thanks a lot for that. Well, let's focus on Signature Global. From Mangalam, we hop across to Sonal. Signature Global, though, not very good news out there. Sonal?
This is for the first time that the realty player has gone on record talking about tepid demand sentiment. We haven't seen that in a while because all of them have been talking about higher demand despite a 5-year upcycle that we've seen. Signature Global reported its Q3 update where the numbers did not look so good. We saw a pre-sales decline of 27%. Number of units sold were down 73% on a YY basis. Their area sold was down 42%. Their collections were up 14%. However, overall numbers looked very weak on a YY basis. And this is one of the first ones which have seen a big decline in the quarter gone by. Now, they do indicate that, yes, they will not be able to meet their pre-sales guidance of 12,700 crore rupees. They say it looked comfortable till a few weeks back. But now demand trends suggest that it could be slower than what they had anticipated. Now, remember, Signature is largely in the NCR region. They were focusing a lot on luxury segment. And this is one of the segments which has been doing really well across developers. That's at least the consensus word. So this has been an agreement to the fact that there's some slowdown, and that's the reason the stock is lower in trade. Otherwise as well, realty index is down sharply from the highs of the day because in 2025, we did see a lot of enthusiasm coming in the sector, but now some admission of the fact that demand is slower, and we are seeing that reaction on realty pack overall.
Take that point, Sonal. Thanks a lot for that. In fact, it's rubbing off on all the others as well. You have DLF, which is lower, Bombay-based players as well. Some of the likes of Oberoi Realty, etc., are lower. But like the point was made, it has been off highs for a while right now. Yash joins in. December life insurance data has come by. Yash, which company stands out?
Well, it's almost like, putting myself on a repetitive note. SBI Life, Max Financial Services, both the best performers as far as the month of December is concerned. SBI Life and Axis Max Life both have indeed grown on a very strong base also in the month of December. To speak about specific numbers, SBI Life, the new business premium, that has grown by a strong 19%. The total APE has grown by 21%. And the retail business, that is the retail APE, that has also seen a very strong growth of 23%. Remember, this comes on a very strong base. Axis Max Life, strong growth again over a strong base. New business premium growing at 26%. Total APE growing at 25%, retail APE growing at 26% again. For HDFC Life, it's been a weak growth in the month of December, but that comes on a favorable base. New business premium growing by 15%, total APE by 11%, retail APE just growing by about 4%. ICICI Prudential Life, it's modest growth over a favorable base for the company. New business premium growing at 25%, total APE at 32%, retail APE at 11%. Canara HSBC Life Insurance, the latest entrant into the listed life insurance space, strong growth, but the base was very, very favorable. New business premium growing at 42%, total APE at 38%, retail APE growing at 41%. Finally, LIC, it's a very strong growth, but again, just like Canara HSBC Life, the base has been very, very favorable. So the new business premium on a favorable base growing at 39%, total APE at 44%, retail APE growing at 27% for LIC.
All right, thanks a lot for that, Yash. Well, Well, let's move on then. SEBI chairman commented on the further course of regulatory action in the derivatives market. Let's listen in to what he had to say.
In the derivatives, we have taken a number of measures, as you know, earlier, first in October 24, and then in May 25, and the last of the measures got kicked in December 25. So we are looking at the data, and after the data is there, we will be able to define our next course of action. So at this moment, I don't think that we are going to disturb anything.
All right, don't think they're going to disturb anything in the moment, and which explains why maybe perhaps BSE is high by about 3.5%, one of those rare outperformers in an otherwise very weak market. 2,300 stocks in the red, BSE holding in the green. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us.
Welcome back. Well, the earnings kickstart today and tech's going to be in focus. Let's get you a preview with Rima, who's joining in to tell us what do we expect from TCS. Rima?
Thanks so much for that. So expect a muted quarter. a dollar revenue growth of just about 0.3%, constant currency revenue growth of about 0.5%, margins unchanged at 25.2%, and a modest 5-6% jump in the company's profitability. But you know, the bigger picture for TCS is also important because there is renewed aggression seen from the company, investments that the company is making to accelerate growth. So whether it is their data center investment or even the acquisitions. And at the recently held analyst meet in December, for the first time, the company, remember, articulated its AI revenues. They said it's $1.5 billion, growing faster than the company average, is about 5% of the overall company's revenue. So more on that is what the street is awaiting. Secondly, you know, the company up until now has always maintained that FY26 international revenue growth will be better than last year. But Ambit says that perhaps could be challenged. You know, the company may not be able to meet this guidance. So we'll try and quiz the management on that. And thirdly, will there be any sort of an exceptional losses, one-time loss? Because there was a $194 million payout on account of an IP infringement case. And plus, generally on account of the restructuring of the workforce, will there be any sort of redundancies that the company will account? Back to you.
All right, Rima, thanks a lot for that. So that's about TCS. The big IT bellwether reports its numbers today. We'll get an inkling into what it looks like for the sector as well. Meanwhile, before we wrap up on this edition, just look at Lemon Tree. Now the stock's picking pace, up around 3%. It opened flattish, thereafter held on to some small gains, but now is higher. And the other one is Linde India, which too, on the back of decent volumes, is up around 4%. And IEX, the big gash that we saw on Friday, is now seeing some bit of recovery from the lows. IEX is up around 3.5%. Nigel.
As you said, Mangalam, on Avenue Supermarts, the valuation argument will continue because the stock, after being up close to 3%, it's actually slipped into the red. So, you know, that continues to plague the stock. I think sustainability of these sort of margins as well as the valuation concerns. But I'll tell you what, we'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.
Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Hormas Vatakia, and also, as always, we have Ritu Singh joining us as well. Good morning, Ritu. Happy Monday, if there was something like that. That's something that bulls won't be happy with. After 5 days of selling, the market continues to reel under pressure, and there's no respite. The only hope that the street has now is that 25,500 holds, because the shorts have been at an extreme, and the Midcap index continues to sell. The Nifty Bank's seen some recovery, but no respite whatsoever.
No respite, Mangalam, and I was hoping your FNO cues later will give us some sense of whether, these 6 straight days of losses that we've seen will see some reversal, later as positions build up. But yes, we're starting the week at sort of the midpoint of that trading range we've seen the Nifty hover around in the last month or so, and that's 25,700 to 26,300. That sort of a range, and it's now trading at about 25,550. So, that's where the Nifty is at. If it, crosses that 25,600 level and makes an up move from there, that's something we'll keep an eye out on. But it is earnings season. There's going to be a lot of stock-specific focus. IT sector kicks it off with TCS and HCL Tech today. And of course, as always, Nifty Bank, like you said, I think 59,000, that's the key downside to watch out for. Currently trading in the red as well. But Hormas, as always, is standing by to put a spotlight on some of the top movers in the market today as we start the week. Hormas.
Well, if only we could have called this a Super 6. Of course, it is a Super 6 for the bears for sure. It's a 6th straight day of losses coming in for the index. But surprisingly, in a market like this, today's list comprises of 2 stocks that are gaining, that are bucking the trend. One such name that's bucking the trend is Linde India. And that too has come off slightly from the highs of the day. At one point was up 6.5%, now up 4%. At the intraday high, it was the biggest single day gain since May. Was the second best performer on the Nifty 500. Volumes were the highest in over a month as well. They had close to 90,000 shares traded on Linde India today. The 20-day average is just 4,000 shares. So significantly higher compared to its 20-day average. The stock took support at its 50 DMA and then moved above its 100 DMA on an intraday basis. And now the 200 DMA on the upside comes up to levels of 63.84. So it's still some distance away from here. And when it entered 2026, Linde India was coming on the back of 7 consecutive months of losses. The theme that has been the talking point over the last couple of days has been the capital goods names, and it's so evident in the price action as well. Hitachi Energy down 6, BHEL 5, GE Vernova 5, and the lot of other capital goods names also trading with losses of around 3 to 5% as well. If you take a look at the volumes of barring GE Vernova, both Hitachi Energy and BHEL are declining on significantly high volumes. BHEL has had over 2.5 crore shares that have been traded. The 20-day average is just under 35 lakh shares, so it's almost around 6x of its 20-day average even in today's session compared to the fall that was seen last week as well in a lot of these names. And the last name on this list is BSE, another one that's bucking the trend today. That too is slightly off the day's high. At one point was up 4.5, now holding on to gains of around 2 3/4, bucking the trend in an otherwise weak market. We've had close to 30 lakh shares that have been traded on BSE. The 20-day average is around 13 lakh shares. The stock has moved above its 50 DMA, which is at 27.20. It's still holding on above the 50-day moving average, so that level becomes the key, and as a result of which it is now above all of its key moving averages as well. And in 2025, when the stock did very well, it turned out to be the 3rd straight year of positive returns for BSE.
All right, that's about all the buzzing stocks. But Horma started with all the capital goods stocks which are under pressure, that continue to be under pressure for the 3rd straight trading session. Vinny joins in to give us an overview of what's plaguing the space and why exactly are these stocks lower despite the companies having a commentary which is a lot more benign than what the street would have feared.
Hi, yes, thanks so much for that. Right, like you mentioned, right, 3rd consecutive day of sharp fall that we're seeing coming in for these capital good industrial players. When did it start? When we saw some reports that came in from Reuters. They suggested that there's a high-level government committee recommendation that has come in that the finance ministry is planning to scrap the 5-year-old restriction that was there on Chinese firms, maybe to start to participate in those government contracts for sectors maybe like power, railway and other sensitive contracts. And this had come into place. The restriction was there since 2020. So maybe if they lift these restrictions, that would mean some concerns coming in for some of these players, whether you look at an L&T, BHEL, which are into boiler turbine generators, Hitachi Energy, GE, Vernova, TNT, Siemens Energy, some of the names like CG Power, they are in power sector. So if this contract or, restrictions on Chinese firms to participate in the contract is lifted, then the street was worried that maybe this would come in as a concern for Indian players. Now, obviously, we had IFL's Renu Vaid also who spoke to us today. And what she suggested that, seems like the street is not, or the channel checks are suggesting that only TBEA, which is a Chinese firm, they are allowed to participate as of now in some power grid tenders for reactors. It's not a blanket rule that all Chinese firms will be allowed to participate. This is the clarification or an understanding that even the analysts or channel checks are suggesting, and a no bulk import is likely to come in from China. So that is not a worry. But the street doesn't seem to be too happy with this situation as of now. We even had, according to CNBC sources, CNBC TV18 sources, we picked up that, maybe as of now, no decision is made as such on this front as well. But the stocks continue to be under pressure. And just highlighting some of the reports that came in last week as well. Jeffries too had highlighted that, yes, highest impact would come in maybe to a BHEL, L&T, Afcons, ABB, CG Power. Lowest impact would be for defense companies. They don't need to worry much. While T&D companies could see some bit of an impact. So Hitachi Energy, that continues to be under pressure, severe pressure today as well. And even for Siemens Energy, we're seeing sharp pressures. Bernstein too highlighted that according to channel checks, relaxation is only in some form is likely, not a blanket rule. So that is the clarification that has come in. But let's keep an eye out on what the street is watching out for. Clearly, last 3 trading sessions, no one is accepting these clarifications or what analysts have been saying as of now.
Not good going for all of these capital goods names. Vinny, thank you for that update there. Continuing to extend losses. And speaking of those names, another name that comes to mind is Cummins India. That too has now slumped to the lows of the day, 4% lower on that stock as well. And the others, transformers and rectifiers, Hitachi Energy, CG Power, all of them not having a very good session. What's also not having a very good session today is delivery, and that has also now moved to the lows of the day, over 4% lower on the stock now. And with that move, the stock is now down 20% from its issue price, which is exactly 100 rupees above where it currently trades as 487. So 4.5% lower on delivery as well at the lowest point of the day. But speaking of such new age companies, there have been initiations that have come from brokerages on both Meesho and Grow in today's session. And Sudarshan is here to put the spotlight on both of these names. Sudarshan.
So first one is Meesho, where BofA Securities has initiated coverage with a neutral call and target here is 190 per share. It says that company is well placed to target value-focused mass market segment, and FY26 to 29 net merchandise value CAGR is seen at 26%. As far as adjusted EBITDA margin is concerned, in FY26, company had reported that margin of -3%. BofA Securities believes it can grow and it can increase to +3% by FY29. Also, at current levels, valuation is factoring strong fundamentals and tailwinds are room to gain market share, fintech scale-up and grocery expansion that company might undertake. Next one is Grow, where Kotak Institutional Equities has initiated coverage with a buy call and target here also is 190 per share. Some of the tailwinds that Kotak has mentioned, first one, durable product-led growth flywheel. Second, expanding monetization across broking, margin lending, wealth and consumer credit. And last one is scalable in-house technology. So 2 positive brokerage notes. First one, Grow, it's trading with gains while Meesho is under pressure.
Sudarshan, thanks very much for taking us through those. We have to slip into a short break though. Up next, we're going to focus on the bond market with Manisha Gupta, so stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
and India Bonds presents Bond Street.
145 points lower on the index as we speak. DMart has now moved into the red after the initial surge that it had seen after its earnings performance. What has also moved into the red is Tata Communications. That has also seen a sharp surge, a sharp downtick from the intraday high, so 2.5% lower on Tata Communications as well. But as promised, shifting focus to the bond markets, Manisha is here with the latest on that. Manisha.
Well, thank you for that. In the Bond Street today, we are talking about the overall market sentiment. And if you look at the government bonds, well, they are trading slightly on a firmer note. And this is on the back of the RBI's 500 billion OMO that the market has been talking about all of last week, by the way. Apart from that, it also has to do with the lower than indicated state bond supply. We do understand that 11 states are aiming to raise 268 billion rupees right now. This is versus the 361.9 billion. This was indicated in the calendar. So slightly smaller amount in sense of issuance is also led to some support in sense of markets there. That's about the government bonds, but the private really seems to be buzzing in the last many days and sessions now. So what we're talking about right now is PFC. They are looking to raise 50 billion rupees via the first tranche of public issuance of their NCD there. Interestingly, this is the first tranche rather, and the issue was opened on Friday. It's expected to close on 30th of January. This actually is the largest retail issue of bonds in nearly 8 years, if it gets totally subscribed, that is, and that's what markets are aiming at. Well, PFC will sell bonds maturing for 5 years, 10 years, 10 years and 1 month, and then 15 years as well. And we've seen support come in because of that as well. The NCDs will offer yields anywhere ranging between 6.8 to 7.3. 7.3 the highest, which is actually for 15 years there. This is payable per annum. This is across multiple tenors there. And markets are looking at this one with a lot of hope and excitement therein. Interestingly, it also is a statement that came in from SEBI chief in one of those events that he was attending, saying that they're examining trading in bond derivatives to deepen the corporate bond market. Well, remember, not too long back, Niti Aayog also came out with a very strong report suggesting a 7-fold way of going forward when it comes to corporate bonds. And that's what the SEBI chief also seems to be talking about in sense of bond derivatives to deepen those markets there. The other thing that the street will watch out for is the India CPI inflation data. Well, that comes in at 4 p.m. today. So ahead of that, that's something else also that the markets are factoring in sense of rupee and bonds, both of those markets. But with that, we'll go for a short break. When we return, we'll talk market technicals with Siddharth Rammangala on the other side.
CNBC TV 18 and India Bonds presents Bond Street.
Fly Emirates, fly better.
Welcome back. You're watching Trading Hour, and the markets continue to tread lower as we speak. The Nifty down 170 points and the Sensex trading with cuts of about 580 points. Let's go across to Mangalam for more cues on what we can pick up from the FNO space. Mangalam?
Well, there is no respite for bulls. We've been talking about that. And as we speak, even in the first half of trade so far, at any point, if one went short, they would be making money. This after the market having seen a big gash over the last 5 days. So the Nifty Bank, the Midcap index, all of them are at the low point of trade. And any data point that you look at is telling you that there is weakness. NSE declines. Now, 2,400 stocks are in the red for just about 500 stocks which are in the green. That line would look like parallel lines and now has widened with the red one being much above the green one. There's also, it's come along with the India VIX, which has seen a big spike too. Typically, when the India VIX spikes, the market falls. There is an element of fear which is underway. Two-wheeler players, the ones which actually did very well all of last year, they're coming in for some sell-off too. So Hero MotoCorp, Eicher, TVS, Bajaj, the ones you look at, all of them at the low point of trade as well. We're seeing some stocks buck the trend, but they've not been big movers on either side. So Coal India has done well, yes. IEX has been fairly volatile, continues to see some buying after the decline that we saw on Friday, and NTPC is mildly in the green as well. Rally continues for Hindustan Copper and Hindustan Zinc. These stocks are in a league, a story of their own right now, and those stocks are at the higher end of range. But even if you look at all the other data points that tell you that the points are moving towards an extreme, there is still no respite. The FI is there 7.5% long. This was 13% at the start of the last week, which is anyway lower. The FI has increased their short positions and they're still making money on them. So no case for immediate short covering. Typically, the market bottoms out at these panic levels, but the panic continues. The Nifty now down about 850, 860 points from its highs in just the last 6 sessions. If you look at the call selling, call sellers are active at 25,600, 25,700. Now, as we speak, increasingly 25,500 as well. So all these levels are crucial as bears are coming in and putting their stronghold at these levels. Put sellers at 25,550 were fairly active today. Now let's see whether they are unwinding their positions or not. And the 25,500 put writers, there is a fair amount of open interest. The Nifty on the verge of breaking that 25,500 mark. If it breaks below that and sustains around that 25,450 to 25,550, these put writers would be caught on the wrong side, and that would accelerate the selling for our frontline index. The put call ratio is at 0.7, again at the lower end of the range. But then when there is panic, there are no levels which are respected. A lot of shorts added on Hitachi and BHEL after these stocks having seen a big correction in the last 2 tradings itself and selling off for the 3rd trading session. And there is still a fair amount of short build-up. So the ammunition for the bears is a lot more than the ammunition for the bulls. The only thing that one needs to watch out for is whether the market stops falling, and then only we can look at any sort of reversal and short covering. The key point right now, the market should stop falling.
That is the key point, but as of now, it does not look like that because the Nifty is now down to the lows of the day. 25,505 is the new low that the index has now made. So now looking to defend that all important 25,500 mark, 504 now being the latest low for the index. Siddharth Rai Mangla from Stockbox Technologies is now joining in for a quick chart check. Siddharth, good morning. Thank you for joining in. It doesn't look a very pretty screen as of now. How important is 25,500, and if we go below that, what are the levels you're watching out for on the index and your stock recommendations for the morning?
Hi, Hormoz. Good morning, and thank you for having me on the show, first of all. See, again, 25,500 is very crucial, and now we can clearly see that there is a lot of panic on the street among the traders right now, at least also because this uncertainty of big heavyweight results have also added into the existing geopolitical uncertainty, which the index was already facing. So now 25,500 will be very, very important. In fact, today's closing is going to be very important for the index, and that will be setting the undertone for this remaining week. So if Nifty goes below 25,500 and spends some time there, the next important levels will be straight in the 25,250, 25,200 range. So a closing above 25,500 is very crucial, not for a rebound or a bounce back in the index, just in order to pause this very sharp fall, which is which will eventually, if Nifty spends some time above 25,500 and manages to close above 25,500 today, it will definitely be giving some confidence to the bulls. So today's closing is going to be very, very important for the index.
Today's closing will be very important for the index, but in a market which is falling like this, would it be more prudent to take short positions or long positions?
Yeah, hi, Manglam. See, it'll be better to keep a balanced approach in a market like this. So I have two stocks. One of them we have to buy and the other one we have to sell. The first one which we have to buy is HDFC Life. See, the stock has a very important base around 750, 745, these levels. And we are seeing some, attempt of a bounce back in today's session as well. So HDFC Life can be bought if there is some recovery, case of a recovery in the index. The stock will be, going up, moving up very sharply. HDFC Life can be bought right now. The spot is around 755-ish. We can buy it here. The stop loss will be at 745, and our targets being the first target 775 and the second target 785. The second stock, and this one we have to go short. This name is Tata Power. This whole space is kind of looking weak, and there was a very important base for this counter around 370 levels, and which this stock has broken yesterday, and today it has not fallen much, but I definitely think that this fall can definitely extend from here. So Tata Power Jan futures, we can go short. Right now the Jan futures are trading around 364, 365-ish. We'll go short. Our stop loss will be 375, and the targets being the first target 340, second target 335.
All right. Thanks a lot, Siddharth, for joining in. And just as we speak, the Nifty has broken the 100-day moving average of 25,540, closing in at 25,500 mark. So closing above that will be very crucial, as Siddharth pointed out, because now the next technical support will be 200 DMA, which is a little over that 25,000 level itself. So 25,500, the market holding that level by the skin of its teeth. Take a short break, come back. We'll discuss the market fundamentals with Manish Jain, who's the head fund management from Centrum PMS.
Still fighting to hold that 25,500 mark on the index. So 180 points lower now as we speak. 25,502 and counting is where the Nifty currently lies as the selling pressure continues to mount on the index. Well, one stock that had opened higher but now has given up all of those gains is DMart. The numbers were okay. There's an EBITDA surprise, Mangalam, but what's playing the stock now?
Valuations. That's the one thing that always plagues DMart. But for what it's worth, the EBITDA was definitely a positive because, especially coming after a 13% revenue growth, which the street was slightly disappointed by. We had an inkling that maybe it's because of lower realizations because of the GST cuts that were announced in September. So that would obviously lower the basket size of a purchase. Basis that, the analysts were expecting 8 to 10% EBITDA growth. The company has gone ahead and reported a 20% revenue growth. In fact, EBITDA growth rather. The margins also, as against expectations of a compression, have improved, and that was led by gross margin improvement. Now, there are two factors that explain the gross margin improvement. One would be lower discounts because the prices were anyway lower, and the second part is increasing share of revenue coming in from the personal or private label products, which typically tend to have slightly higher gross margins in the FMCG and staples categories. There was no major change in the product revenue mix for the company this time around. And the management confirmed that the revenue growth was partially impacted by deflation in staples. So overall, on a consolidated basis, 13% revenue growth, gross margins improving 60 basis points, EBITDA jumping 20%, and margins coming in at 8.1% as against expectations of a compression. The net profit increasing by 18% as well. Like-for-like growth in the third quarter was up around 5.6%, and sales per square foot was marginally lower, but nothing which is worth complaining this time around. The only problem, DMart trading at around 90 times 1 year forward earnings, and at the same time, it's never been cheap. Growth is picking up. The street would have liked a little more than just this marginal expansion in margins. This morning we had Abnish, the analyst at Nuvama, join us as well. He said for a significant re-rating, you have to see revenues growing between 18 to 20% as against just 13 to 15% that the company has been reporting. So that's about Avenue Supermarts. Opened fairly well, and now with the market has seen a bit of a decline. And as we speak, just don't lose sight of the Nifty. It's broken the 25,500 mark. It's the same stocks which have been dragging it lower, which are seeing extended cuts. The Nifty Bank is lower. We have a big decline that we've seen in a couple of these metal pack. Nifty IT, that index as well comes up for you currently at the low point of trade ahead of TCS's earnings. And ITC, that stock too, pressurizing the frontline index, now below that 25,500 mark. Let's see whether it sustains here or not, because if it does not, then all those 25,500 put writers will be caught on the wrong side and will have to panic mode, unwind those positions. Perfect time to actually then get in Manish Jain, who's the head fund management at Centrum. Manish, thank you so much for joining in. There is a serious, experience of panic on the streets right now, especially over the last 6 or 7 days, where the Nifty has fallen about 900 points from the peak. And a lot of the broader markets are a lot more lower. In this situation, are you finding any opportunities for purchase, or is it still you're awaiting a decline further to, stabilized levels for you to go ahead and start purchasing?
I think what the investors need to realize is that this volatility which has set in the last 5, 6, 7 days was a little unexpected. You expected with the advent of the Q3 results and the outlook being as good as it is, we are expecting a pickup in earnings, probably even a surprise in the Q3 as far as earnings versus actual delivery is concerned. The markets would have been far more stable than what they are right now. But I think it's got more to do with the global geopolitical situations than the factors here in India. Of course, there's one, which is the tariff bill, which has been proposed in the US, which takes the duties to about 500%. That should be a big cause of concern for India, effectively putting the entire US merchandise export basket in a jeopardy. And then the whole Venezuelan situation, right, that kind of continues to remain in a little bit of a flux. You don't know where it goes from here. So the problem with the market really for the last 4 or 5 years or has been that the domestic liquidity and the domestic economy continues to remain absolutely stable, absolutely strong. We've seen that in the real GDP growth rate numbers. We've seen that in the earnings growth everywhere. Whatever has been happening on the global front, and whenever you feel that it's about to end is when the new chapter again starts and something else or the other happens over there. So I think what the investors should do at this moment is not to wait for a further correction, because see, you can never really time the market to perfection. It's not going to be possible. And if you are a 2, maybe 3-year long horizon investor, then I think you identify sectors where you are materially looking at an earnings pickup to happen, where the environmental factors to the domestic economy are conducive to it, and start building up positions over there. So I would be buying banks, I would be buying autos, maybe even IT at this juncture doesn't look all that bad.
Okay, autos and IT is the 2 sectors you're picking, Manish. But like you said, the geopolitical stress, it continues to remain center stage from Venezuela to Iran. I mean, the focus keeps shifting. But domestically, what are the cues that you'd watch out for? And also, some of the themes like the capital goods space, these reports, although unconfirmed so far, on curbs being eased on Chinese goods. How do you expect that space to get impacted?
Yeah, so that has again already started reacting a little bit, right? I mean, you've seen that across different stocks in the last 1 week or so, that there has been a little bit of correction over there. But specifically speaking, as far as domestic markets are concerned, I think there are a couple of things that I would look out for. See, one is that, of course, that rate cut cycle, at least the way I believe it is far and behind us now. It's going to be more of a stable rate regime. So that expectation is completely out of the way. Rupee becomes an important factor in play over here. It should kind of stabilize at these levels where it is today. And the third and the most important factor, which is going to drive the market henceforth, is going to be the earnings growth. See, for the last 4 odd quarters, right, starting from September, October of 2024, the market has been in a little bit of a pressure, largely because earnings have been getting cut every quarter, quarter after quarter, right? So we've been expecting 12%, delivering 6-7% or thereabouts. This is a first quarter where, because of the GST rate cut, the pivot happens. We've seen the provisional numbers come from banks, and they have been very, very good across the board, right? Everybody's been reporting significantly higher numbers on a sequential basis. So I think this is where the sign is, and I would watch out very closely for the third quarter results to actually start taking positions across different sectors. And then, of course, the most important thing is to watch out for budget next month.
We'll watch out for the budget. Of course, we'll keep an eye out on that. But Manish, since you mentioned earnings, we start off with them in full earnest from today. From the IT space, you have the big names, TCS, HCL Tech, almost all of large cap IT reporting this time around. What are you anticipating from these companies? There has been no particular change in demand from the on-ground scenario, as you heard from earnings of Accenture as well. So what do you expect from these large cap IT, and do you expect mid-cap IT to outperform this time as well?
No, I would be a little more bullish on large cap IT as compared to mid cap IT. And really, I think my bullishness on IT stems from one factor, which is that it's going to be a good sector rotation play. And that's something that we've seen on and off. This is one sector that has been neglected, and quite rightfully so, for some time now. We've seen guidance getting cut. We've seen multiples getting cut. And I feel from a valuation as well as earnings expectation standpoint, this is very optimally poised at this juncture, where there are no real negative surprises at play over here. But if you have the patience for 1 year, I think this can be a good dark horse. That's where the bullishness stems in from.
All right, Manish, thanks a lot for that short but effective conversation out here. But panic continues in the market. The Nifty now at 25,485. We've seen a big cut come by in a couple of these PSUs also now. BEL for one, which was marginally in the green at the start of trade, has now moved into the red. In fact, it'll make more sense to pull up the advanced decline once again, or maybe one of the broader indices heat map, because when we started the show, we had about 2,100 stocks which were in the red, and now that number's swiftly moved to around 2,500 with just 400 stocks which are in the green right now. Power Grid, look at that one too, was marginally in the green and now has moved into the red. Devi's Labs continues to be under pressure. The two-wheeler space also continues to be under pressure. Some of these new age names as well. Eternal for one is currently at the low point. So across the board, there is selling. Where does it go from here? We'll probably keep a tab on that after this short break. Stay tuned. There you have it, the Nifty heat map, way more red than green.
Welcome back to Trading Hour, and it's time for the macro signal of the day. Let's start with the markets as always. It's been the sixth straight session of declines. The market's now at, near low points or new lows that we're seeing at the moment, trading with cuts of 201 points. The Bank Nifty also mirroring that sentiment now, trading with cuts of 351 points at 58,889. The Midcap and the Small Cap Index also in the red. Let's quickly also pull up the rupee, which is trading with caution because of what's happening on the oil prices on one front, and of course the continued pressure from FII selling, now at about 90.17 as we speak. In the 10-year GSEC, some interesting moves there in the money market. The 10-year actually opened at 6.60, but then it quickly dropped by about 14 basis points because to about 6.50%, and that's because traders say there was some erroneous trade, a fat finger error, so to speak. That was corrected, and now it's trading firm at about 6.63. The RBI OMO is very much in focus on that front. Crude prices, meanwhile, continuing to react to the geopolitical tensions, whether that was Venezuela oversupply concerns earlier and now the stress across Iran. But let's delve deeper into the US President Trump's 10% proposed credit card interest rate cap, what it means, who it hurts, and who it helps. Now, keep in mind, millions of Americans rely on credit card to manage their everyday expenses, and for many, that comes with a very steep interest rate, often more than 20%. Now, Donald Trump has proposed capping this rate at 10% for 1 year. Of course, it's still a proposal at this stage. Any nationwide cap will also require the Congress to pass legislation. Now, credit cards, if you look at them, are deeply embedded in the American financial system. In fact, data shows 74% of all adults in America have at least one credit card. There are more than 360 million active accounts nationwide, and the average person holds at least 3 to 4 cards on average. Now, Americans owe more debt than ever before as well. The current debt at $1.2 trillion for credit card dues. Just in 2024 alone, they paid roughly $160 billion in interest. So for people who are carrying balances, that is not clearing their entire credit card bills every month, a 10% cap could meaningfully reduce the interest cost by tens of billions of dollars. Now, here's how the math adds up for banks, though, if this is implemented. Now, if you look at the Federal Reserve data, the average US credit card annual percentage rate, or APR as they call it, is above 22%, and the average revolving balance that is, on the credit card is about $5,500 to $6,000. At 22% APR, the banks will earn about $13, $20 a year in interest from a customer. And with a 10% cap, that will drastically drop to $600, which is a loss of $720 per customer, or more than half of the interest income just foregone. Now, scale that up because a large card issuer, with 10 million revolving customers, for instance, could see interest income fall by roughly $7 billion a year. Now, could something like this happen in India? That's the question everyone's been asking. There's been opposition in the US, but in India, lenders typically charge you as high as 36 to 48% annually on credit cards, depending on the issuer. Now, while RBI can influence pricing indirectly, imposing a flat 10% cap at the moment is out of the question, because it would be unprecedented and almost certainly require legislative backing and wider consultation with bankers, and it is sure to see a pushback. So that's as far as the macro signal of the day is concerned. But let's continue with that theme, because the latest CRISIL report highlights how India's banking cycle is evolving. System credit growth is holding up at more than 12%, but deposits have been pointing out are lagging at 9.4%. The loan-to-deposit ratio, which we pointed out, is now at an all-time high. That gap explains why banks are becoming more selective, and the mix of lending is clearly shifting towards the secured part. To discuss that and more, we have Krishnan Sitaraman, the Chief Ratings Officer at CRISIL Ratings, joining us. Krishnan, thanks very much for your time here. From the third quarter updates we've got from banks so far, what was your biggest takeaway in the shift towards secured? Is this a temporary phenomena given the kind of stress we've seen in that segment, or the RBI action, or is there a structural shift that you're seeing take place?
Hey, good morning, everyone. Thanks for having me on the show. I think in the banking sector, I'd like to preface it by putting the fact that if I look at the balance sheets of banks today, they are perhaps at the strongest that I've seen in the last 15 years or so. If you look at metrics like gross non-performing assets, provisioning coverage ratios, capital adequacy ratios, as well as the liquidity coverage ratios, all of them are at a very healthy situation. So overall, banking sector balance sheets look healthy. Coming specifically to your questions in terms of the Q3 numbers, or in fact Q2, not all the banks have disclosed the Q3 results as yet. what we are seeing is an increase in the loan-to-deposit ratio. That's something that we are seeing, and we are seeing credit growth picking up. And we believe the reason for that, the LDR or the loan-to-deposit ratio going up, is that deposit growth is lagging credit growth, and that is a key monitorable for the banking system so far. Because if I look at the last quarter or so, credit growth has shown a meaningful pickup. And that is benefiting from the steps which is taken by both the regulator and the government in terms of aspects like GST rationalization, the income tax cuts, lower interest rates, and benign inflation. All of that is resulting in consumption demand picking up and translating into retail credit growth picking up. And also we are seeing MSME credit growth holding strong. So that is supporting credit growth, which at the end of November was 11.5%. In December, it has moved up to 12%. But deposit growth is lagging.
Yeah.
Let me take you back to the beginning of, say, FY24. That was a time when deposit growth lagged behind credit growth by around 500 basis points. From then on till Q1 of this fiscal, that is June of this fiscal, we have seen deposit growth catch up with credit growth and for a brief period even exceed credit growth. But that was when credit growth was anemic in the first quarter. But then credit growth has picked up, and we are seeing a deposit growth lagging. That difference is picking up. So that has resulted in a difference of more than 200 basis points between deposit growth and credit growth. And that is resulting in an increase in the LDR ratio levels. And while credit growth is, the demand is there because our economy is growing well, but banks will be cautious about the rising LDR ratio, and they would want to keep it within specific limits. And one of the ways in which they can do it is look at securitization transactions. Last fiscal, we had one large private bank looking at that. So I think that is a key monitorable, deposit growth and how that pans out. Otherwise, balance sheets look good. Credit growth, there is a good uptick in credit growth demand.
Got that. Krishnan, balance sheets look good. Bad loans are at decadal lows. But my question is, one of the standout trends has been this spurt in MSME lending. Now at almost 32.5% of the incremental credit. My question is, what is the risk, given the tariff, threat looming large still? And what is the kind of provisions that banks have already made, and which ones are more exposed?
Sure, I think the sector in terms of NPAs that we are monitoring is the MSME sector, because overall when the cycle turns and asset quality starts deteriorating, it is the MSME sector typically which gets impacted first because their financial resilience is relatively weaker as compared to large corporates. So while we are seeing an increased demand from MSMEs, and that is because of the overall improvement in the economy, there are certain pockets in the MSME sector which are facing headwinds, and those are sectors which are more export-oriented, which have an exposure to the US sectors like gems and jewelry, we have home textiles, we have the marine food segment. So some of these sectors are having a higher exposure to the US and the tariff scenario. And where we are cautiously monitoring the situation, there could be chance of NPAs going up. But if I look at the MSME sector as a whole, our projection of NPAs as of this current fiscal end is around 3.9 odd percent, which will be around 20 to 30 basis points higher over the course of the fiscal. So it is not a very sharp increase in NPA we are expecting, but some increase in NPA in certain pockets and sectors we are expecting. The other aspect
Krishnan, we've taken note of that. Yeah, we've taken note of that. Unfortunately, we have to get back to the markets. That's all the time we had. Thanks very much, Krishnan. MSME as a sector to keep an eye out on when it comes to stress for banks. That's a good takeaway for us to end this on. We'll slip into a short break. We thank you, Krishnan, for your time. We'll get back with more on the markets in just a bit.
Market continues to reel under pressure. Now 200 points lower for the frontline index, and the mid-caps have it even worse. 2,500 stocks which are in the red. Titagar Wagons, that's the one that comes up for, on the sellers list right now, currently at the low point. Delivery, which continue to see some fresh shorts, continues to see addition on the short side, extension of those losses. And Loris Labs, one of the big stars of 2025, now starting 2026 on the back foot with a cut of almost 6%. Just watch out for the 25,500 put, because the Nifty has broken that 25,500 mark. The 25,500 put still has 2 crore shares outstanding. The premium has spiked from 50 rupees to 72 rupees. So those writers will suddenly start feeling the heat. If the market sustains here, these guys will have to cover their positions. That will cause an accelerated decline. Hormaz.
Yeah, the top 3 losers on the mid-cap index now are capital goods names, as we were highlighting all through the show as well. BHEL, Hitachi, Cummins, all of them now trading with losses of anywhere between 5 to 6%. Paytm has now moved to the lows of the day as well, 3% lower on that stock. And of course, Tejas Networks, the earnings accident of the day, 11.5% lower now as we speak. So not good going for Tejas Networks as well. So not a pretty picture if you are a bull, Ritu.
Not at all. And in fact, it's the heavyweights that are dragging the Nifty down, from Reliance and HDFC. These are the big draggers. If we pull up the chart, L&T, M&M, Infosys are the other big draggers that are, sort of taking the markets down. And on the upside, there's some support coming in from ICICI Bank, Coal India, and then the likes of Trent, SBI Life, etc. But not a good day for the markets as we end trading hour. Thanks very much for tuning in. From Hormaz, Mangalam and me, it's a goodbye. But Halftime Report is going to take all the action forward, so stay tuned.
Markets under severe selling pressure once again as we start the week. Nifty breaks below the major support level of 20 weekly moving average. Mid-caps and small-cap indices trade down 1.5 to 2%. Declines outnumber advances at 5:1.
Fed Chair Jerome Powell reveals Department of Justice threats of a criminal indictment linked to Senate testimony on Fed renovation. Chair Powell calls it unprecedented and political. This raises concerns over Fed independence.
Life insurance industry total APE grew strong in December at 26%, led by private sector growing at 21% and continued recovery for LIC, which grew at 38%. For the third quarter, this means total industry APE grew at 23%. Traction in protection products since GST changes has helped companies post strong growth.
Vishal Mahadevia, Managing Director and Head of Asia Private Equity for Warburg Pincus, tells CNBC TV18 that the PE giant is very positive financial services businesses, consumer companies climbing the premiumization ladder, and thematically like import substitution and those firms solving for affordability across sectors. Warburg's latest bet has been into Lemon Tree Hotel, where it is putting 960 crore rupees as primary capital into Floor.
Hello and welcome to Halftime Report live from the CNBC TV18 Motilal Oswal studio. I'm Ekta Patra and with me is Sonal Bhutra as well as Vinny Motiwala. Well, it is turning out to be a Monday where we are seeing pressured markets on our hands. Last week we ended weak and we're continuing in terms of the losses that we are seeing at this point in time. As you can see on your screen, just a handful of stocks which are trading in the green within the Nifty space. Currently down around 0.6% currently for the Nifty, down around 170 odd points. We've slipped below the 20-day moving average of around 26,000 for the Nifty. In fact, broken 25,500 on an intraday basis. Mild recovery from those levels. And what also stands out is that the India VIX has spiked up around 7% in today's trading session, indicating the kind of volatility that the street is anticipating. The advanced decline ratio extremely dismal in today's trading session. So 1:3 is currently where the advanced decline ratio stands. As you can see, the gap has not widened as the day has gone on. So there's a huge difference in terms of the advances and the declines today. Overall, the fabric of the market looks extremely weak at this point, with the mid-caps under pressure, underperforming the Nifty at this point.
Hey girls, and you said a Monday, it's a manic Monday for the bulls for sure. We have only 11 stocks in the Nifty which are in the green, the rest are in the red. A wee bit of recovery from those levels, but again, we have seen all of those selling points seeing further pressure, or the dips which are bought into, seeing further pressure from the highs of the day as well. The sole sector in the green today is Nifty Metals, and so far this year itself, if we talk about the Nifty, it is already down 2.5%. We have the Nifty Midcap Index, which is down 2.5%, and we've been trading for just like 8 days this year. So already big fall coming in across segments. For now, again, mid-caps are also attempting some recovery, but whether that continues or not remains to be seen. Very crucial point for the markets. Advanced decline ratio has actually worsened from 1:5. Now it's closer to that 6 level. Big declines coming in.
Big declines coming in. Good afternoon, ladies. And obviously, out of those 8 trading days that you're talking about, 6 of them were in the red for the Nifty. So 6 consecutive day of fall that we're seeing coming in for the Nifty 50. And in terms of top drags today, look at the big names that have come in. We have Reliance that's seeing a big fall. We are seeing L&T. We have the IT names that are not doing well. So Infosys is also among the top drags that are there for the Nifty 50. HDFC Bank and M&M among the top drags there as well. And obviously, top pressure is coming in from realty, auto, pharma, as well as media names also under pressure today. But yes, that's the market setup for you all right now. But we have Vivek who's joining us to take us through all those big movers in today's trading session as well. Good afternoon, Vivek. Over to you.
Well, thank you so much for that. As you all encapsulated so well the kind of weakness that we're seeing in the broad end of the markets, we struggle to find any stocks that were moving. However, a few names, mainly on the back of news flow and some volume-backed action in terms of the stock that gained, but quite a lot of laggards, as you can imagine. Linde India, one of the stocks in the broad end of the market, the top NSE 500 gainer on decent volumes higher today. Coal India, that particular stock, the top Nifty gainer subsidiary, remember, is undergoing an IPO, and 3 other subsidiaries also on track for going ahead and seeing some amount of value unlocking. Manappuram Finance down almost 8.5% on Friday. A clarification to the exchanges, a bit of a bounce back, almost 3% higher. And BSE, the top mid-cap gainer, remember, exchange volumes have been quite strong, especially at the start of 2026. On the other hand, whole host of stocks, whole host of sectors under significant pressure. It's a muted set of numbers, especially when looking at the export data in the month gone by. And on the back of that, look at pharma. Most of the pharma names under significant pressure. Loris, Ipca, Granules, Natco, Divi's, PPL Pharma, all of these names under significant selling pressure today. Loris down over 5%. The entire realty pack, some amount of caution coming in from Signature Global led to a bit of a sell-off. Have a look at names like Signature, Prestige, Oberoi, all of these names under significant pressure. The entire capital goods space.
Okay.
All right.
All right, Vivek. Thank you. We will be coming back to you in just a bit, but those are some visuals coming in, important ones, because that's the US ambassador to India, Mr. Sergio Gore, who is addressing the press. And of course, we'll keep getting those visuals for you as well. Very important at this point in time when we are discussing so much about US-India trade deal, the possibility and the post coming in from the US president earlier this week or the last week that there could be 500% tariff on India if Russian crude oil imports continue. And there have been a lot of conversations as well, a lot of commentary coming in from the Commerce Minister or the Commerce Secretary of the US on what happened between India and the US as far as the trade talks are concerned. So we will be getting all those updates, and we are just awaiting any sort of press conference that will be taking place now.
Well, yes, it's going to be important, but all of the comments which have come in from the US ambassador as of now have been positive. He has said that there are incredible opportunities for both of the two nations going forward. So maybe there will be some amount of green in terms of the US-India relations. But nonetheless, as of now, we will wait by for more comments. First, the agenda seems to be that he will be addressing and meeting his embassy officials, the US embassy officials, before addressing the press as well as the embassy staff. So that's Sergio Gore right there, the visuals coming through of him taking office as the US ambassador to India. So those are the visuals which are coming in. Let's see what it holds. As of now, the comments have been pretty much positive in terms of...
Yep. Trump had also made a comment before him coming here for Sergio as well. Seems like his, work is already cut out, because Trump had said that, he's trusting Sergio to help strengthen both the countries' ties as well. He wants to focus on that as well. Okay, let's listen to it. He's going to be speaking now to the press.
Good morning, Mission India. Namaste to everyone who's watching from home. It is great to be here as the United States ambassador. I come to this remarkable nation with profound respect and with a clear mission to take the partnership between our two great nations to the next level. This is the intersection of the world's oldest democracy and the world's largest democracy. My first visit to India was in 2013, and it left an impression on me unlike any other place. I remember visiting some of the incredible places this nation has. Of course, the Taj Mahal, Jaipur, Ranthambore. We even went up to Punjab and many other places. The friendly people, the colors, the incredible history, the innovation, and the spirit that I met on that trip over a decade ago, I've never forgotten. And I've always wanted to come back. And what an incredible way to be back in this incredible nation as your next US ambassador. When President Trump asked me to come here, I was thrilled. I remember, President Trump remembers his last visit here. I was with the president last week, and as we had dinner right after New Year's, he recounted his incredible experience visiting here, and also his great friendship with the great Prime Minister of India, Prime Minister Modi. I also hope that the president will be visiting us soon, hopefully in the next year or two. I want to thank President Trump for once again putting his trust and confidence in me. I consider the president a dear friend. America has never had a commander-in-chief like President Trump. When I first got this position, somebody at the White House asked me, how are you going to keep in touch with the president? And the interesting thing is that a lot of people don't know is the president has a habit of calling you at 2 in the morning. And so with the time difference in New Delhi, it might actually work out pretty well. The president outworked all of us at the White House. and I hope that we'll be able to keep up with his pace and his expectations. When President Trump was elected in 2024, he asked me to be the director of the Office of Presidential Personnel. That meant hiring thousands of individuals across our entire federal government, from US attorneys to ambassadors, and every political hire across every department in the United States government, including the State Department. In our first year, we broke every record and filled over 95% of those positions. So in this new year, I once again thank President Donald Trump for putting his trust in me in what is a very important relationship for both of our nations. I spoke with President Trump just yesterday, and I bring his warm wishes to all the people of India, especially his dear friend, the incredible Prime Minister, His Excellency, Prime Minister Modi. As many of you might have heard, the President is quite busy, not only around the world, but also redecorating and renovating Washington, D.C. And when I spoke to the President, I shared with him that I had just driven past the beautiful India Gate. The President has embarked on building a ballroom at the White House, but one of the additional projects that's on his list is building something similar to the Arc de Triomphe in Paris. And no offense to the French, but I think what we have here in Delhi might have even surpassed that. I've traveled all over the world with President Trump, and I can attest that his friendship with Prime Minister Modi is real. The United States and India are bound not just by shared interest, but by a relationship anchored at the highest levels. Real friends can disagree, but always resolve their differences in the end. Last week, our great Secretary of State, Marco Rubio, powerfully stated that this year will be a year of reciprocity. We are raising the standard for diplomacy itself. That means fair trade, mutual respect, and shared security. Many of you have asked me for an update on the ongoing trade deal negotiations. Both sides continue to actively engage. In fact, the next call on trade will occur tomorrow. Remember, India is the world's largest nation, so it's not an easy task to get this across the finish line, but we are determined to get there. And while trade is very important for our relationship, we will continue to work closely together on other very important areas, such as security, counterterrorism, energy, technology, education, and health. I also want to share with you today a new initiative that the United States launched just last month called Pax Silica. Pax Silica is a US-led strategic initiative to build a secure, prosperous, and innovation-driven silicon supply chain, from critical minerals and energy inputs to advanced manufacturing, semiconductors, AI development, and logistics. Nations that joined last month include Japan, South Korea, the United Kingdom, and Israel. Today, I'm pleased to announce that India will be invited to join this group of nations as a full member next month. As the world adopts new technology, it is essential that India and the United States work hand in hand from the very start of this initiative. I thank the people of India for a very warm welcome. You are resilient people. You're innovative. You are spiritual. I look forward to meeting many of you as I travel across this incredible nation. To the staff here at the embassy, I'm excited to work with you. You and I have an incredible once-in-a-lifetime opportunity to redefine diplomacy, what it can accomplish. What it can accomplish could be the most consequential global partnership of this century. No partner is more essential than India. In the months and years ahead, it is my goal as ambassador to pursue a very ambitious agenda. We will do this as true strategic partners, each bringing strength, respect, and leadership to the table. Thank you, and may God bless the enduring friendship between our two nations. All right. Okay.
Okay, all right. Important comments coming in from Sergio Gore. A lot of them are making markets react to that as well. There's a big recovery on the Nifty from the lows of the day as well. And that is the most important thing because there is a call on trade talks tomorrow. He's spoken about how India and US continue to remain important partners, how President Trump and Prime Minister Modi are great friends. And he also adds that real friends can have differences, but they can be resolved later. And how India being a big country, so the trade talks are taking longer than what they had anticipated, or the fact that it would take longer. But at the end of the day, they would reach a deal or a number on the deal as well. The most important part, that there will be a call on trade deal tomorrow. And on the back of that, there's a sharp recovery in the markets from the lows of the day as well.
I think it is the comments which, you know, they have been engaging actively over many weeks and months in terms of what they could do with regards to the trade deal. So more than, yes, having that call tomorrow, it is the positive commentary which also came out from Sergio Gore in terms of the kind of relationship that India and the US share. So what he did indicate, and that's possibly when the market started recovering, is that both sides continue to actively engage, and the next call on the trade talks will take place tomorrow. That India is one of the biggest countries. It takes time to reach a conclusion, and that, you know, they do have this long-standing friendship. They do have a relationship which goes beyond the trade deal. They will be looking at other issues such as security, counterterrorism, education, health, and that is exactly what the markets have taken away from that. That yes, there will be a conclusion to a trade deal, that we do have a relationship with the US which is much stronger, and that we will come to a conclusion when it comes to the trade deal. As you can see, there is a significant recovery which has taken place in the markets. For example, the Nifty is now at around 25,607. It's recovered back to the 20-day moving average just in the past couple of minutes. And we have the Bank Nifty, which is just about lower by around 0.2%. The Midcap index, when we started the show, was down around 1.3%. To put it into perspective, it is down only 0.6% now. So there's a significant recovery which has taken place in terms of the mid-caps as well. The advanced decline ratio should come up for you because it's sub 1:3 now. Maybe there's a little bit of a narrowing which has taken place in terms of the advanced decline ratio, as you can see on your screen. So positive comments which have come in from Sergio Gore, the US ambassador to India, indicating that yes, there will be some amount of conversations. There is a trade conversation which will take place tomorrow, and there will be some amount of conclusion which will eventually be reached between the two nations. That is something that you can possibly, take away from the comments. Overall, his comments towards India and the relationship that the US and India share was extremely positive and strong, and spoke much beyond just the trade issues that the two countries are facing.
But they've been speaking about the relationship being strong always, but the point about trade is something that I think
trade, real friends, and all the comments that you all highlighted as well. Next call tomorrow, we'll keep an eye out on that. But on that note, we're going to slip into a very short break. A quick note for our viewers: get ready for CNBC TV 18's all-new lineup starting today. Incisive analysis, sharp commentary with CNBC TV 18's brand new offering. Watch our new segment, Cut the Balance Sheet, with Mangalam and Sonal Bhutra, as well as watch Macro Signals with Ritu Singh, that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV 18's most trusted in-house technical experts.
Welcome back. Well, it's a handsome recovery, you would have to say, for the market. So the Nifty is just about lower by around 40 odd points as we speak. The Bank Nifty is also recovered into the green, and you can see that spike up coming in through on an intraday basis, along with the advance decline ratio, with just about 1,130 stocks advancing to around 3,000 stocks declining. Now, to put that into perspective, when we started the show, there were around 950 stocks which were advancing only. So there has been a significant pickup which has taken place in the overall fabric of the markets. To talk more about, the Gore's comments, which just came through, the US ambassador's comments to India, Prashant joins in. Prashant, you were listening outside, and more interestingly, you've been having conversations with regards to how important Gore could be for India.
Yeah, I mean, the reason he's important, Ekta, is not because he's the ambassador designate to India, a US ambassador designate, but because he is part of President Trump's inner circle. I mean, he's not a career diplomat, so he doesn't come from that service line. He's someone who's seen as having President Trump's, ear on various matters. I mean, he's seen as someone who can cut through the bureaucracy and kind of sort of directly get President Trump. And I think, as we know, President Trump, and that's what matters, right? I mean, he's got his unique way of working. He posts on social media, and it's obviously been very, very volatile because of that. But I mean, that is essentially who President Trump has been. So when you have someone who's close to him, in India as the ambassador, who can get India's viewpoints across to President Trump, and I think it makes a world of a difference. I've been sort of highlighting Sergio Gore's arrival since last Thursday and why that could be important. Actually, I was highlighting two things. One was the US, the Supreme Court, and what they would do to tariffs. I mean, that was no news because nothing happened. The other one was, of course, Mr. Gore's arrival here in India, which, at least for now, is making a bit of a difference. I mean, he's, of course, saying the obvious things. He's come to India to take charge as the ambassador. So he's obviously going to say a lot of things which will be sort of, about repairing relationship between India and the US, about how India is very important strategically, etc. But he's also obviously taking charge at a time. I mean, just remember, he came to India on a flash visit. He met Prime Minister Modi, etc. I think it was in September or October. And he'd not take... So it was just like a in and out kind of a visit. Situation was very different. I mean, there was no... It has actually become worse since then. People have kind of lost hope in terms of when this deal will happen, etc., etc. So the timing of the visit, when sentiment is pretty bad, people are kind of sort of saying in serious long-term money managers. I mean, I spoke with someone who said, well, I'd be happy if we see a deal this year in 2026, calendar 2026. So when sentiment is so bad and you have someone like this who comes in and talks about the fact that, well, we want to, and the graphics in terms of what he said is all up there. I mean, if possible, we'll play out some sound bites, etc. as well. It makes a world of a difference. So we will, just want to, I know Parikshit, so I'll go across to Parikshit in just a bit. So yeah, that's the bit. I just want to quickly take a look at what the Sensex is doing. Nifty is down about 25 points. Sensex is down about 0.25. So it's a massive recovery. Yeah. If you look at I was just looking at the 26,000 weekly with the call option which expires tomorrow on the NSE. I think that has seen a swing of some 120 odd percent. So it's just quite incredible how. So it also tells you that sentiment is the problem point, right? Which has been very, very poor. Let's actually bring in Parikshit, who's with us, right? He was there listening to Mr. Gore. He was in that room when those comments were made. Parikshit, yes, what was the mood like? I mean, sentiment certainly perked up here in stock markets, I can tell you. But tell us, what was it like there?
Well, it is positive, isn't it? He is the envoy not just for India, but he will be the U.S. envoy for Southeast Asia and key countries here as well. So having an ambassador, a diplomat like that in New Delhi gives the government a lot of access to a person who's been actually directly selected by the U.S. president to head the mission in India. And he comes at a difficult time, and he knows that as well. He was clear to say that, yes, trade negotiations assume priority in talks. This government is all about seeking reciprocity in relationships. And the next set of trade talks will happen tomorrow. So he would like to deliver some sort of win for the president, is the sense that we get. They will be, of course, negotiating a trade deal very hard. Maybe they would ask for more market access in more issues, is something that we have been picking up from sources in Washington, D.C. A good point here and is the fact that the Pax Silica alliance, which many in India were taken aback when it was announced and India was not invited to it, Sergio Gore actually announced and said that India will be invited to join this alliance in the next few weeks. So it's a very important alliance for critical minerals, for supply chains, for artificial intelligence, critical components as well. So that will be something to look out for. He said that this relationship is anchored with the friendship and closeness between the leaders at the highest level. So he clearly tried to put the mood right. And you can imagine what he's bringing to the table, because when he arrived at the embassy, he arrived with much fanfare. We were told by the embassy staff that all the songs that played to welcome him, all of them had been personally chosen by him as well. In a break from past, he's already met the Prime Minister of India, even before presenting his credentials. Even the speech that he made, he spoke for about 10 minutes. He has not presented his credentials to the President of India so far. So even this is a break from past. So he's being treated very differently. We believe that his ceremony at Rashtrapati Bhavan, where he officially meets the President of India, presents his credentials and takes over as ambassador, that could happen any day now. It could happen this week itself. And usually such ceremonies take about a few weeks for ambassadors of other countries. So India would definitely like to speed up things for him to make sure that they can start discussing things with him, bring him to the table as fast as possible.
We're trying to get some reactions as well, but you should stay on the line. What we'll also do is play those sound bites out. Sergio Gore, listen.
The United States and India are bound not just by shared interest, but by a relationship anchored at the highest levels. Real friends can disagree, but always resolve their differences in the end. Last week, our great Secretary of State, Marco Rubio, powerfully stated that this year will be a year of reciprocity. We are raising the standard for diplomacy itself. That means fair trade, mutual respect, and shared security. Many of you have asked me for an update on the ongoing trade deal negotiations. Both sides continue to actively engage. In fact, the next call on trade will occur tomorrow. Remember, India is the world's largest nation, so it's not an easy task to get this across the finish line, but we are determined to get there.
Okay, those are some important comments coming in, and of course that is what the stock market has reacted to as well. Prashant, let me get you in again, because this is a conversation about a trade talk tomorrow, but that doesn't mean the deal is in place, and the markets are just reacting to that. So what do you make of that?
No, absolutely, and I think so no one is expecting a trade deal per se, but the point is that at least the 25% penal tariff, there's 25% reciprocal, 25% penal tariff because of the Russian oil. You can knock that off, right? That's the hope, and the point is, think about it. I mean, trade delegations, ministry to ministry kind of talks, bureaucrats talking to each other, and that goes up the regular channel. I mean, the Commerce Department in the US, the Commerce Ministry here, and eventually it'll rise up to the at a ministerial level, and then they talk. Cutting through all of that, you've got someone here who presumably, as we understand, and people like Ashok Malik, who are policy veterans, have told us, who has direct access, who can pick up the phone and talk to the president. I mean, if you heard Howard Lutnick, the Commerce Secretary,
That's
saying,
exactly,
right? What did he say? He said, well, he called me the greatest table setter. There was a bit of bombast there. But at the end of the day, he said, well, it's his deal. It's President Trump's deal, right? It's him. So if it is him who's got to sign off, and remember, guys, I mean, since September, October, this is around the time of the festive season, etc. Markets were seriously, anticipating this deal. I mean, it was almost as if it's coming, If you remember, I jokingly, but half jokingly called Gokuldas exports as this indicator, the India-US deal. I mean, that had gone to about 1,200. And there were serious, and Bihar elections, and then it became after Bihar elections. So the anticipation was that it's there. I mean, the document is there. And now it needs President Trump to come up and sign off on it. Now, if that is the case, now this is of course all what we gather by speaking with people across, and Parishad can come in as well. But if it's his deal, and you have someone here who can talk to this person directly and communicate what India, instead of going through the bureaucratic channels, which takes a much longer.
Maybe the pace will be faster than what.
Faster. I think he said somewhere, right? President Trump likes to call up people
2
at 2
a.m. Yeah.
That'll work well for us with the time difference, etc. Right?
But you know, that's exactly what I wanted to bring up. That the U.S. Commerce Secretary, that's what really shook sentiment a little bit as well. His comments on the All In podcast. You know, we probably missed the opportunity, or the timing wasn't correct in terms of making the call. So I think a lot of that, all of those concerns seem to be assuaged at this point in time.
Yeah, but you know, I heard that, right, and that gives some context, etc. in terms of that's their claim, first of all.
Yeah.
But what I took away from it is that if it is about a phone call, that what does he say? He says, well,
weeks later.
We didn't call. Well, you know, if you have, so now we're talking about another call, but this time from Gore to President Trump.
Yeah.
So it is about calling first or second or third. I mean, if that is the disagreement or whatever, right? I mean, it can be solved. It is not as if it can't be solved. I'm not saying that anything is imminent.
Yeah.
But the point
it's
is...
just that it gives a larger perspective that,
Yeah.
you know, the relationship is much stronger and that, you know, we'll probably get past this hurdle of the
No,
tariff.
he's saying all things which he's supposed to say. I mean, that is what we have to remember that,
Yeah.
right? I mean, he's in India, he's the US ambassador to India, and he's going to say all of that.
Yeah.
But as I said, he's also saying all of this at a time when relations are, which he well recognizes. I mean, I don't think he'll say any of it if his boss, President Trump, etc., he'd be careful about saying, I mean, if there is serious antagonism and, I mean, you know, no intention of doing a deal, etc., right? So he's obviously saying, and he's supposed to say it, but I think he's also, it becomes doubly important because of the time that he's saying it. And I think he's very well aware of what he's doing.
And I
Time is right because
markets are reacting to that as well. But of course, the point is that we still are in a wait and watch mode. We have to see how these deals progress or the talks progress going forward as well.
And
With that,
significant recovery, I want to point out in the Bank Nifty. In fact, it's up around 0.3% now. So we are significantly in the green when it comes to the Bank Nifty. The mid-caps have recovered. We have the Nifty, in fact, which is now trading in the green. So important comments which have come in.
I'll tell you, the 20s, I don't know if you can pull it up, the weekly 26,000 call, this is the Tuesday expiry, was at $4 when in the morning. It's at 14 now. Right?
Wow.
So there is, of course, I mean, because prices have moved and it's so close to expiry tomorrow, there was time erosion, etc. But this is significant. This is, I would say, positive that you have someone like that here in India. And he was very positive when he visited and met Prime Minister Modi, etc. He will meet the president, present his credentials, etc., as is, protocol. And so, yeah, all that will happen. But I think it's, I don't see a negative. I mean, you know, we've been from an extremely negative sort of state as far as market sentiment, etc. I think this is a step into the positive kind of direction. How much, etc., how much can you build on it? All of that, of course, will depend on this next call that he's talking about. So, next call does not mean trade deal, to say once again, obviously. But I think markets well recognize that. And they think that at least, I mean, you've got someone close to President Trump who's here and who'll be able to pick up the phone if needed and communicate India's side clearly and talk to and level with the president.
We have a friend in India.
Yeah, let's hope so. Absolutely.
Okay, that is all about what the comments came in, and in that much time we saw around Nifty from 25,500 to 25,000, almost 700 right now is what we're watching out for. On that note, we're going to sip into a very short break and more on stock-specific action after the break.
Fly Emirates, fly better.
Welcome back. Well, a big recovery is what we are tracking in the market. So let's understand the technicals now and what the outlook is going forward. Sudeep Shah, Head of Technical and Derivative Research at SBI Securities, is joining in now. Sudeep, a while back when the markets were lower, Manglam was just telling us how the put-call ratio is at 0.6. And suddenly after those comments, it has changed the way markets have moved. What are the charts suggesting now? Where do these ratios lie? And what is the next important point now? Because this has basically risen on a positive sentiment. Is this something which could continue in terms of the charts and the trends going forward?
Good afternoon, Sonal. Sonal, what we've seen in the last 4 or 5 days is that the markets have cracked specifically on those negative comments from the US side. And this is the first positive comment that has come after 7-8 sessions now. And after a big fall in the last few days, especially in the small and mid cap. So what I feel is that, yes, this could act as a positive trigger. There could be a lot of volatility even throughout the day today. So dips towards 25,630, 25,650. I feel it should be used as an opportunity to go long. Keep a stop at 25,530. That is where we feel that there could be a support. On the upside, the first level that indices could retest now is 25,800. And in case we close above that, then 26,000 zone can be a potential recovery zone. So 25,530, 25,550, I feel is an important support on Nifty. Similarly, on the bank Nifty, 58,900, 59,000 now remains an important support. And we feel that above 59,650, 59,700, bank Nifty could stage a faster recovery up to 60,300 levels.
Okay, all right. Specific stocks, what would you recommend, Sudeep, in such a market? Because it is volatile. We did start off weak. We've recovered. But what's your sense in terms of how you'd approach stocks?
Couple of them. One is BSC. Now, since opening today, the stock has shown good traction. It is now about 7-8 days highs. And what we're seeing is that 2720, 2700 now becomes an important support here. So this can be bought with a stop loss at 2720. The potential upside could be around 2900, 2930 in the coming weeks. The second stock that is on our radar is SAIL, Steel Authority of India Limited. So here we have seen last week there was a big move from 135 till 152. Then there was a throwback up to a support zone of 143. And today exactly from that support zone, there is a rebound. So the SAIL also can be bought with a stop loss at 144 for a target of 155 on the upside.
Okay, Sudeep, thank you so much for joining in this afternoon and talking to us about the markets as well as individual stock names. On that note, we're going to slip into a very short break. On the other side, Manisha Gupta will join us for a conversation on commodity, and with her will be Surendra Mehta, Secretary of Indian Bullion and Jewelers Association. Stay tuned in.
Welcome back, and joining us on the show now is Surendra Mehta. He's Secretary, India Bullion and Jewelers Association. Mr. Mehta, hi, thank you so much for joining in. First of all, your sense on prices itself. Almost everybody seems to be losing sense on what is happening into the markets, the way we really seem to be breaking levels on the higher side. And the global banks and brokerages revising their targets for 2026 all the time. Another day, another all-time high. What's your sense?
Well, Manisha, I've been continuously saying on your show that gold is heading for $4,900 and silver heading for $95. See why they are heading at such a higher level? Only because of geopolitical tension rising in Iran, Venezuela, Greenland, also the weak job data. Not only this, the higher tariff being planned by US government, and finally today's news, which was a politically motivated news regarding investigation on the Fed chairman. So all these news are leading to higher gold prices and higher silver prices, and I don't see this would stop at any time soon, because there is a lot to be done by the US to ensure that these prices do not go up and they actually recover through their equity markets or other markets.
Well, absolutely, Mr. Mehta. All the news reports that you mentioned is something that we've been talking since morning as well. But the price action, where do you see that coming from? Is it more about physical buying right now? Is it paper buying? The COMEX markets clearly seem to be running. China, not so much right now. So where do you see most of this buying coming from?
I think as far as gold is concerned, there is a lot of ETF buying happening. In India also, we have seen a big jump in ETF. And as far as silver is concerned, there is a physical buying of silver across the world, including China, Dubai. Today also, Dubai is quoting almost $3 premium on silver. Iran is quoting about $2 premium on silver. So where are we heading? In India also, if you convert MCX commodity prices, the gold is quoting higher by almost 1,200 rupees and silver is quoting higher by almost 6,000 rupees. So if converted to in dollar terms, the gold is almost higher by $40 and silver is almost higher by about $2.5 to $3. So I don't think that there would be any correction in near future. There can be a small correction, but not a great correction of say 10% or 20%. I do not see this correction initially.
And you would expect buying on all of these corrections?
Come again, I did not hear you.
I said you expect buying in all of these corrections?
I think every dip is a buying opportunity, because unless we get a clearer picture as to what US actually wants to do, and then only I think the gold and silver prices can go down. China comes out very clearly why they are restricting the export of silver. Russia come out very clearly about their oil holding and gold holding. And I don't think any of this country are currently negotiating with each other. India has always been the price taker for gold and silver also to some extent. So I don't see any role being played by India in respect of discovery of these prices. We are price takers, not price discoverers. And I think as long as China, Russia, and US don't agree on certain terms, the prices would continue to rise.
You mentioned 4,900 for gold. What's your sense on silver?
Silver, I feel that my first target for silver would be $95. And if we cross $95 in, say, next 60 days or maybe 90 days, then my next target for silver would be about $110.
All right. How are you looking at the Indian physical demand in the meanwhile? You talked about on what we are doing in China, in Russia, etc. For Indian markets, is it still a lot of physical buying? The import numbers, of course, would come in pretty soon for gold and silver, both in India for 2025. But what is your own sense?
Well, the imports are getting reduced. As far as gold is concerned, imports are getting reduced, and there is no physical demand of jewelry. The physical demand of jewelry is down by almost 35 to 40% now. The retailers are waiting to see the buyers. They are not coming unless they are the forced buyers because of marriages or some celebration in their house. Otherwise, there is no real demand. But as far as silver is concerned, there is a lot of demand, silver demand. The demand in terms of coins and bars and bullion, in terms of gold and silver, is pretty high. I think gold bullion demand is almost up by 18 to 20%, and silver bullion demand is rising day by day.
All right. So physical buying when it comes to investment in gold and silver is on a rise, but jewelry demand clearly slightly on a weaker note there. People are buying not for wearing it, but for investment with the way they are getting return on their investments there. Mr. Mehta, as always, thank you so much for joining in and making sense of the price moves therein. With that, let's slip into a short break. On the other side, we'll get you more on markets and stock specifics.
Welcome back. Well, good recovery for the market. So currently we have the Nifty at around 25,700. If you want to put it into perspective, we've recovered 247 odd points from the day's low. The low point of the day in today's trading session was 25,470. So it's been a smart and cool recovery post the comments which came in from the US ambassador to India, indicating that maybe there could be some amount of positivity when it comes to the trade agreements or maybe conversations around that. But nonetheless, we do have the Bank Nifty, which is actually speeding ahead. So we have the Bank Nifty, which is up around 0.4%, along with the mid-caps, which have recovered from the day's low, but still some way to go for the mid-caps to possibly push into the green. The advanced decline ratio, as you can see, has recovered from the get-go. So after those comments came in, and that advanced decline ratio graph should come up for you, and that should give you a sense in terms of what it's looking like at this point in time. Well, on that note, it is a wrap on Halftime Report, but stay tuned. Business Lunch will take all of the action ahead.
The market sees a sharp recovery triggered by comments on trade talks by the new US ambassador to India, Sergio. The Nifty recovers over 200 points from the lows of the day to turn positive, while the Nifty Bank recovers over 400 points. Important comments from the US ambassador to India, Sergio Gore. He says the next round of trade talks between the two nations will take place tomorrow. He also announces that India will be part of the US-led Pax Silica initiative, which is the US Department of State's flagship effort on AI and supply chain security. Vishal Mahadevia, the managing director and head of Asia private equity for Warburg Pincus, tells CNBC TV 18 that the PE giant is very positive on financial services businesses, consumer companies climbing the premiumization ladder, and thematically linked import substitution, and those firms solving for affordability across sectors. Warburg's latest bet has been into Lemon Tree Hotels, where it is putting in 960 crore as capital infusion into its unit Fleur Hotels. Reliance Industries denies a Bloomberg report that the company has paused plans to make lithium-ion battery cells in India. The company says that there is no change in plans for creating battery storage manufacturing ecosystem from cells to containered ESS. And Fed Chair Jerome Powell reveals that the Department of Justice threats of criminal indictment linked to Senate testimony on Fed renovation. Chair Powell calls it unprecedented and political. This raises concerns over the Fed's independence. President Trump denies involvement in the DOJ's Fed subpoenas. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia, and it is a completely different market from where we left off around 60 minutes ago. After trading hour, the Nifty has seen a recovery of over 200 points from the lows of the day, and it is now trading in positive territory. At one point, it also made an intraday high of 25,740. So it's a very, very sharp recovery that has come on the index. We'll get you more on the markets in just a bit. But the key trigger behind this recovery were remarks from the US ambassador to India, Sergio Gore. And he says that the next round of trade talks between the two nations will take place tomorrow. Parikshit is here with more on this. Parikshit, tell us more about what the new US envoy had to say on his arrival.
Well, US Ambassador designate to India, Sergio Gore, made quite an entry at the US Embassy in New Delhi. He was received with much fanfare. The moment he got down from his BMW SUV, he was greeted by songs that he had chosen himself for his arrival and welcome. So while he was taking the steps of the US Embassy, the song that was playing was Hold On, I'm Coming by Sam and Dave. You also had the iconic American song YMCA playing several times. Now that's a song that has played at Donald Trump's election campaigns as well. So he met the embassy staff briefly before taking stage and making remarks. So it is a 10-minute address, a brief address that he made, but some key takeaways. He said that this is a relationship which is very strong for the United States. In a way, he realizes that there has been tension in this relationship and he needs to bring a soothing touch. He said that he spoke to the President Trump, just yesterday, and he sends his warm greetings to the people of India. He said that he's had dinner with President Trump recently, and President Trump has emphasized that he has a very close relationship with India and Prime Minister Narendra Modi. Speaking about the trade deal, he said that many people have asked him about the status of the trade deal. He said that US has a strong ambition to be a close partner of India. The trade deals, of course, are a part of it. The negotiations have been going on. We are very determined to get there. So that, I think, was an important remark for the markets as well, something that they've picked up, that US is determined to get to a trade deal with India. They would want it fair, they would want it to be reciprocal, they would want to get more market access with India. At the same time, he said that the next round of talks will take place tomorrow. Let's see what happens. Perhaps the US is going to ask for something more at this stage, because previously the Indian government has said that talks from our side are absolutely over. We've given the best deal possible. it now remains to be seen what Donald Trump does. In fact, this deal, according to various sources, has gone to President Trump's table at least 4 to 5 times in the last 5 to 6 months, but he has not signed it because he felt possibly that it doesn't have the right amount of ambition. So here you have Sergio Gore, somebody who is close to the US president. He's going to be here in New Delhi. We'll have a lot of access to him. He's also said that India will be joining the Pax Silica alliance that saw the likes of UK, Japan, South Korea joining hands with America to come together on supply chains of critical minerals, AI, quantum computing. So India will also become a full-time member. Importantly, he said that real friends like India and US may disagree, but in the end, they always resolve differences. So he came with a healing touch. Will he be able to clinch the trade deal for Donald Trump and for India? That remains to be seen. But he will present his credentials to the President of India and formally take over this week itself, is what we're learning.
The United States and India are bound not just by shared interest, but by a relationship anchored at the highest levels. Real friends can disagree, but always resolve their differences in the end. Last week, our great Secretary of State, Marco Rubio, powerfully stated that this year will be a year of reciprocity. We are raising the standard for diplomacy itself. That means fair trade, mutual respect, and shared security. Many of you have asked me for an update on the ongoing trade deal negotiations. Both sides continue to actively engage. In fact, the next call on trade will occur tomorrow. Remember, India is the world's largest nation, so it's not an easy task to get this across the finish line, but we are determined to get there.
Sergio Gore, the US ambassador designate to India on his first day of his arrival, has sparked a significant recovery in the markets. The Nifty now in positive territory, still looking to hold on to that 25,700 mark, recovering from that intraday low of 25,474. So it's a 225-point recovery from the lows of the day is what the index has seen. We'll get you more on the index constituents in just a bit, but what are some of the other stocks that are reacting to the news flow? Upasana is here with more details on this. Upasana.
Well, firstly, let me start with some of the stocks that are in focus on the back of its Q3 numbers and Q3 updates as well. First up is Irida. The net profit has seen a growth of 37% on a one-year basis, and NII has also seen an uptick of 35%. So overall, good result for the company. Next up is Tejas Network. On the flip side, has reported a weak set of numbers. The Q3 revenue saw a downtick of 88% on a one-year basis and an uptick of 17% sequentially. The company has reported losses for the fourth consecutive quarter at 196 crores versus 307 crores sequentially. Next up is Signature Global. On the back of its Q3 updates, the pre-sales has seen a downtick of 27% on a year-on-year basis, and there's a flat sequential growth. Now, company has also said that it will not be able to meet its pre-sales guidance for the entire year. Hence, the stock is in pressure. Next up is Grow. On the back of the Kotak institutional report, the brokerage has given a constructive medium-term view on the stock and initiated with a buy rating of target price of 190 per share. Next up is capital goods stocks, that is BHEL and Hitachi. Now, Chinese imports issue continues despite the clarification from the companies. Next up is Manappuram Finance. It denies the router's report of RBI raising concern with respect to Bain Capital deal. And lastly, coming to Aurent Pro Solutions, the company has bagged order worth 150 crore from DMRC. This is for the implementation of AFC systems for the Bhopal and Indore metro rail projects. So all in all, we are looking out for all these stocks in today's trading session and certainly buzzing in trade.
Upasana, thank you for that update there. And to add to Upasana's list, is mentioning a couple of more names. GMDC is one such name that has recovered from the day's low after remarks from Sergio Gore. And along with GMDC, what has also seen a recovery is Nalco. Both of them have now are now into positive territory as we speak, and that is after Sergio Gore mentioned that India will become a full member of the Pax Silica Alliance from next month is what Parikshit also highlighted in his address. But the other big talking point has been Lemon Tree Hotels, the big deal that was announced over the weekend, the strategic reorganization of its business and a fresh investment by global private equity firm Warburg Pincus in its subsidiary Fleur Hotels. Mangalam is here with more on this. Mangalam.
Well, the company has done three things. One, it's announced a restructuring, a value unlocking and fundraising, all of them together. So what Lemon Tree has basically essentially decided to do is that own two companies, by and large listed companies. One of them will be Lemon Tree, which will be a pure play asset light model, which will earn management fees and earn money from the brand platform. The second one will be Fleur Hotels, which will be a hotel ownership platform with development capabilities. Currently, Lemon Tree holds about 58% stake in Fleur, and the rest is owned by APG. Warburg will go ahead and buy APG's stake and will have the option to further invest 960 crores in multiple tranches basis when the need arises. The scheme is a three-way scheme of arrangement. One, Lemon Tree will merge two of its wholly owned subsidiaries with itself. Point two, Lemon Tree will give 4 of its subsidiaries to Fleur, in return for which it will get Fleur shares. And the third part is where Lemon Tree will transfer 12 hotels, including the ones which are under construction, to Fleur Hotels, in lieu of which Lemon Tree shareholders directly will get Fleur shares. So what this basically does is gives you two companies. One is Lemon Tree, which will have up to 170 crores of revenues and 70% plus EBITDA margins, a debt-free, high ROCE business. And the other one will be Fleur, which will have access to over 4,000 hotel keys and roughly 41 hotels rather, and 1,189 crore revenue with 43% margins. So there'll be two distinct companies which will be listed in the next 12 to 15 months. More importantly, once this happens, the board for Lemon Tree will also meet to announce a dividend policy which will continue to reward shareholders.
Mangalam, thank you for that update there. 3.5% higher on Lemon Tree as well. So one of the other stocks that is reacting to their news flow. 40 points higher now on the index. 25,730 is where we stand. So it's been a very, very impressive recovery from the lows of the day. Make that 250 points now from the intraday low. Take a short break, but just as we do that, here's a quick note for our viewers. Get ready for CNBC TV 18's all-new lineup in this new year. Incisive analysis, sharp commentary with CNBC TV 18's brand new offerings. Watch our segment Cut the Balance Sheet with Mangalam and Sonal Bhutra. Watch Macro Signals with Ritu Singh that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV 18's most trusted in-house technical experts. Welcome back. Moving on to some other global updates. Then the U.S. Department of Justice has opened a criminal investigation into Federal Reserve Chair Jerome Powell. The move comes as an escalation by President Donald Trump of his attempt to pressure the central bank. The Fed chair called the action a pretext aimed at further pressuring him over a dispute with Trump over interest rates. Listen in.
On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people.
Meanwhile, President Trump says that he's unaware of the Justice Department's investigation into the Federal Reserve. In a brief interview with NBC, he said that he doesn't know anything about it, but Jerome Powell is certainly not very good at the Fed and is also not very good at building buildings. And news now from the ongoing protests in Iran. US President Donald Trump has claimed that Iran's leadership, led by Supreme Leader Khamenei, had called him to negotiate after his threats of military action amidst mass anti-government protests in the Islamic Republic. Speaking on board the Air Force One, Trump claimed a meeting is being set up for the negotiations. The US leader, however, said, and I quote, "We may have to act before a meeting," end of quote. His statement comes amidst rising death tolls and a near total internet blackout in Iran. Now, according to human rights groups, over 500 people have been killed so far, even as the internet blackout enters the 4th day. And in some more Trump news, the US president on his Truth Social account posted an image that appeared to designate him as acting president of Venezuela. Now, after a dramatic series of events in the country this month, the image is being circulated widely online. But the claim it purports is not reflected on the actual Wikipedia page or in verified public records. Take a short break, but just a quick heads up before that. If you're thinking about where the real opportunities for 2026 lie, Market Forum, the alpha generators for the year, is where that conversation begins. The alpha table awaits. Join CNBC TV 18 as we host the ultimate confluence of India's market movers. Tune in tomorrow at 4:30 p.m. only on CNBC TV 18.
Fly Emirates, fly better.
Welcome back. The CPI data for the month of December is expected later today. Lata Venkatesh is here to tell us what the street is expecting from the inflation data. Lata.
Yes, it's due at 4 p.m. today, and it's a bit historic because this is the last piece of data from the old series whose base year is 2011-12. Our poll sees the CPI coming in at 1.62%, and this compares with 0.7 in November and about 5.22 year ago, that is in December of 2024. The poll also sees food inflation at minus 1.3. This compares with minus 3.9 in November and 8.4, very high base, which is why it's negative now, 8.39 year ago. The core CPI, which is, excluding food and fuel, that figure comes in at 4.6. It's something the Reserve Bank watches very closely. 4.6 compared to 4.3 in November. And this, if you exclude gold, gold is for some reason in India counted in personal services. If you exclude that, then the core CPI falls below 3%. What I'm trying to drive home is that numbers are very weak in inflation. This is the 6th month that the CPI inflation is below the MPC's lower target of 2%. Which means it's been below 2% for 6 months, and for 7 months, it has been negative for food prices. Much of it is because of a high base and 2 good harvests, but nevertheless, there are some people who worry that it indicates poor demand because farmers are earning less. Now, will the Reserve Bank take notice? It is the last CPI data before they go into the February 6th policy, but it is unlikely to change RBI's long pause, which is what the market is expecting now after the rate cut in December. Nothing is expected. Also, the February 6th policy will have to concentrate on the budget. What is the fiscal deficit? What are the tax implications? What are the dividend implications that the budget has assumed? So they will not worry too much about this last CPI number. And this number will go into history because from February 12th, that is next month, the new CPI series, with 2023 as the base year, will start. So this really has only historic and historical value, not really so much policy-making value.
And keep an eye out on the historical significance of that. Lata, thank you for summarizing that for us. Take your leave on this edition of Business Lunch. The Nifty remains above the 25,700 mark, a 225-point recovery from the lows of the day. Midcap radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. A 240-point recovery from the lows. A lot of commentary coming in on US-India trade deals as well. The markets, as Mangla was stating in his FNO link as well, was oversold. There was a point for recovery as well. A lot of things happened together, and look at the move.
That's right, a perfect storm, but in a positive manner is what we saw, especially in the last half hour or so. Markets have recovered very sharply. Nifty as well as Nifty Bank trading with positive or trading with gains. But a lot lined up for the show, an important conversation as well. So let's start off with the top headlines. Market sees a sharp recovery triggered by comments on trade talks by the US ambassador to India. The Nifty recovers over 200 points from the lows of the day, while the Nifty Bank is up over 500 points from its intraday lows.
A CNBC TV 18 news break is confirmed. Lemon Tree Hotels in the green after it announced a major reconstruction plan to unlock value and split its asset-light management business from hotel ownership portfolio, and brings Warburg Pincus as a strategic investor in one of the hotels.
Capital goods stocks stumble for another session as the risk of more competition comes in if the government eases curbs on Chinese companies, and that continues to weigh on sentiment.
Manappuram Finance gains after the company issues a clarification regarding reports of the RBI delaying the firm's Bain deal to acquire a controlling stake.
Tejas Networks falls more than 10% in trade as Q3 revenue remains weak on a year-on-year basis. Weak sales and delay in major BSNL orders impact the company in the third quarter.
Okay, those are the top headlines. The biggest headline being the market recovery. The Nifty is up 50 points as we speak. At a point in time, it was only the metals index which was in the green, but we do have that recovery come by in bank, CPSE index, the FMCG, PAC, and the IT names as well. Of course, we have big IT names which will report results today, so we are watching out for that one. And other than that, the advanced decline ratio, which was actually in favor of declines, the ratio was 1:6. It's just 1:2.5 right now. So big moves.
That's right, and especially the materials pack, that's seen quite a bit of a sharp up move. The auto ancillary pack, remember, all of them were down anywhere between 3 to 5%. Names like Bharat Forge, Sona Comstar, all of them recovering quite smartly from the intraday lows. But these names and a whole host of other stocks is what Sudarshan has on his radar. He's standing by the wall. This is our special segment, Midcap Movers.
So while market has made a smart recovery in the last 1 hour after the comment that came in from US Ambassador to India, Sergio regarding the US-India trade talks next round is going to be held tomorrow. But there is one segment which remains under pressure is the realty space, and that comes after Signature Global's comment or basically raising concerns related to the guidance for FY26 that company had given. And you can take a look. Signature Global still down almost 6%. Prestige Estates, Godrej Properties, Oberoi Realty, all these stocks are trading with cuts of somewhere in the range of 2 to 3%. But in the last 1 hour, we have seen some unusual movers. So first name on the list is IEX. Remember, on the Friday, while the hearing was on in the Electricity Tribunal, that is APTEL, the stock had fallen as much as 10%. But today, despite till 12 p.m. market was weak. This stock was holding on to the gains, and still it's up more than 3%. And also, if you take a look from the high of 160, that day it had fallen to 137, and today it's back of 140. Now it's trading near very important levels of 50 DMA and 100 DMA. So till the time it holds above 140.65, it would be important for IEX. Second name comes to Central Electronics. Now this stock also has seen a big gain in the last 1 hour, and that came with healthy volumes. And from December of 26 till January of 9, it had seen a big fall. But what were the losses had seen in those trading sessions? It has recovered in a single day, and that is today. And volume currently is at more than 2 lakh versus 10-day average of just 20,000. Next name comes is JTL Industries. On Friday, stock had hit 52-week low of 51.39. And from that level, it has seen big buying. And today, currently, it's up more than 16%. And for this also, volume is at over 2 crore versus 10-day average of just 7 lakhs. Next one, LG Rubber. Like JTL Industries, this too has seen a big buying after hitting 52-week low. 52-week low was around 40, and from that level it has seen a big buying, and gains are coming with healthy volumes, and this too currently trading with gain of 4%.
Okay, some interesting names which are buzzing in the broader markets. We are not talking about them enough, considering no news flow, but it's a big move. So thank you for bringing us those names, Sudarshan. These are some mid-cap movers. But with that, let's move on and welcome Ruchit Jain, Equity Technical Research, Wealth Management from Motilal Oswal Financial Services. Ruchit, what a move. Do you think we could see further uptick from these levels?
Yeah, hi, very good afternoon. Well, we have seen 5 days of consistently selling, in last few trading sessions, and post the today's move that we saw in the morning, the RSI readings were a bit in the oversold zone. So I think this back move was warranted because of the oversold setups. But whether that would lead toward bottoming out of the markets and next leg of uptrend, I think that as of now does not seem would be that easy. So just because of that oversold setup, it seems to be a pullback move. Recently, we have breached that 50 DMA on the Nifty, which was important support. And until we reclaim that 50 DMA level again, I think this should be seen as no pullback move. So on the higher side, the resistance would come around 25,900. So one can expect another 150 odd points up move from current levels. But closing above that 25,900, 950 would be the most important thing to watch out for.
Okay, Ruchit, so 25,900 is the line or the level that you're watching for some sense that you probably believe that there is a significant reversal. Well, Ruchit, what are your individual trades for the day?
A couple of names on the long side. So one theme that we are looking out is looking for such stocks which have not seen that sharp corrections in last 5 trading sessions when the markets have corrected. So the relative outperformers, during corrective phases, two such names, one of them is ICICI Bank, where from the recent low, good price volume action has been seen. So ICICI Bank looks positive from current levels with a stop below 1380. One can buy for potential up move towards 1500 kind of levels. And Tata Steel is one of the metal name that technically looks positive. A high top, high bottom structure. Last few trading sessions in the dip, the 20 DMA has now acting as a support. So Tata Steel is one of the metal name that we like at current levels. One can go along with stop loss below 176 for potential targets around 190.
Okay, all right. Thank you so much, Ruchit, for joining in as always with your technical picks and moves on the index as well. That's a technical check coming in. But with that, we'll slip into a short break. A lot's happening in the realty space. So we'll get chatting with Pankaj Kapoor, the founder and MD at Liasis, for us to understand demand environment in the residential real estate sector. Stay tuned for that.
Welcome back to Midcap Radar. Well, one particular pocket of the market that has seen significant selling pressure has been the capital goods space, be it inverters, be it companies that make transformers, and be it BTG generators. Winnie joins in with more details as to what it means if Chinese players are allowed to enter the Indian capital goods space, especially in the power sector. Winnie, you've done some comprehensive research on this. Please share details.
Hi, thanks so much for that. Yes, so what happened actually for the capital goods industrial space? Last week, we had some reports that came in from Reuters that suggested that high-level government committee recommendations came in by the Finance Ministry, which is planning to scrap the 5-year-old restriction that was there on Chinese firms bidding for the government contracts. Now, obviously, this restriction came in place in 2020. After that, we saw a sharp fall that came in for all these capital good players. Whether you look at an L&T, BHEL, these are the companies which are in those boiler turbine generator suppliers, that is the BTG suppliers. Then we had Hitachi Energy, GE Vernova, T&D, Siemens, CG Power. All these are power equipment players, as well as other stocks like transformer rectifiers, ABB, Siemens, all of them also fell. Why? Because they're a part of this manufacturing supply chain. Then we had some clarification that came in, and this is according to cnbc TV 18 sources, that government has not yet made any decision on this front. There was nothing that has come in on this front. That is what we understood. But despite this also coming in as a clarification sorts that no decision is made as of now, these stocks continue to be under pressure. Almost 3 consecutive days that we've seen these stocks that are falling in the trading session. Now, today we spoke to IIFL's Renu Ved as well, and what she highlighted that, there's this one Chinese company, TBEA, that is likely to participate in power grids tenders for reactors. So what they understand, according to the channel check, high voltage reactors, maybe that restriction is likely to be lifted on that front. It's not a blanket rule that will come in across all these sectors, whether you look at railway, power, or other sensitive contracts for government bidding. So as of now, they've said that it only seems like it's only for this one particular maybe product that is being made on that. Now, even other brokerages have come out with their notes, and this came in last week, and they also highlighted, when they look at Bernstein, they said the industry channel checks are suggesting relaxation is for some of the firms is likely, not all. The relaxation may be segment-based with prior requirement on part of the Chinese firms. So they will require something as well in terms of a clarification, or maybe some requirement of approval that comes in before they actually start bidding. So as of now, obviously, we've seen negative impacts coming in from most of these players. We'll keep an eye out on that. Continuing for the 3rd consecutive day, pressure on these capital good names.
Oh yes, this space continues to be on our radar. Any more updates, any more clarifications is something that the markets are watching out for. For now, we'll slip into a short break and focus on the realty space up next. Stay tuned for that conversation. We'll just slip into a short break. Welcome back. Well, despite that massive recovery that we are seeing from the lows, real estate, the Nifty Realty Index is a top loser. In fact, it's down around 17% from the 52-week highs. We've been getting a lot of commentary coming in from real estate companies. Today, Signature Global highlighted that they will not be able to meet their pre-sales guidance of 12,700 crore rupees. They say that overall market sentiment has turned softer, which has impacted them. We've been talking about how there is some pressure on realty names or the real estate sector overall. But does it happen for all the markets? How far it could go? And what is the outlook going forward? We are now joined by Pankaj Kapoor, founder and MD Liasis for us for understanding the real estate market scenario. Mr. Kapoor, good afternoon. Thank you so much for joining in. I remember we had spoken in November. You did indicate that there could be some structural changes coming by in the realty industry overall. Have things worsened since then? We have one real estate player, listed one, which is now talking about some demand softness. I think that's the first one that we are hearing now. Do you think we will continue to see this commentary coming by from more players in the near future?
In fact, if you look at the market has actually slided down around 7 to 8% from its peak, which was early last year. And post that there is sales wise in terms of the unit, the market is down by 7%. But the major concern is the constructed supply, like the productions done by the developers. So even though the marketable supply has grown over the period of time because the builder launched the projects and also could generate the booking, but their execution is falling behind. So from 3 billion to 3.5 billion introductions of the marketable supply during last 3-4 years, the constructed supply has been holding at 2 billion, and sometimes it has gone down to 1.9 billion square feet. That means that builders are not able to keep in pace with the launch supply. The construction is not keeping pace with the launch supplies, and that is what is creating a structural issue. Builder will not be able to book the revenue, and there would be a default and execution delay in the projects, and which has a long-lasting impact on the overall real estate market projects viabilities, because if the construction slows down, then the interest cost and construction cost adds up, and then which impacts the margin of the developer. But in overall sense that the volume have gone down by 6 to 7%. But in terms of the value, it is not looking that bad because the market was still skewed towards the luxury and ultra luxury market. And I think the demand softening is also from the angle that the prices have peaked in most of the geography. The investor participation has reduced because most of the geography, the price rise has been in the range of 0 to 5%. Some of the North Indian market, which was showing a high price rises, are showing a plateauing situations because as the new launches is coming, the competition is coming, the price is not growing as much. So investor sentiment is a bit down, and luxury can't continue to actually support the market all along. The demand has to, or the supply has to meet the distributions of the demographic and demand segmentation. I think those corrections will be taking place going forward.
Mr. Kapoor, what you've highlighted is, from the peak, we've seen a 7% downtick in terms of volumes. Is there a particular geography where you've seen more stress compared to others? And you've also highlighted an important point in terms of real estate builders' balance sheet under a bit of stress due to not being able to launch on time. How worried are you?
I'm saying that there is not much of the worry, and mostly I see that like Delhi NCR already have a very limited supply because in comparison to MMR regions, if you see Delhi NCR, the total supply is 1/5 the size. MMR, if it has an unsold of close to 3 lakh unit, Delhi NCR is still holding at a level of around 60 to 67,000 units. So it is much limited and contracted supply as of date. But some market like Pune, we have seen a reductions big way. We have seen to some extent Delhi, Ahmedabad, Chennai, and to some extent in Hyderabad, there's a bit of a reductions in terms of the volumes. But overall market actually is holding up. In tier 2 cities also we have seen a growth getting arrested. And one more thing which I noticed during this particular quarter, we have seen prices of around 18% projects across out of 20,000 projects we cover have shown a reduction in the property prices to the extent of 0 to 5%. So clearly indicating there is a softening of the demand in the market, and builders are finding it difficult to entice the investors, and they are trying to make the deal more lucrative, and that's where they started giving offers and discounts.
So, Mr. Kapoor, we just have a minute. So, I just wanted to understand the pricing bit. Was the demand slowdown a lot to do with affordability as well? And if there are price cuts, do you think that could revive demand?
My own sense is the market is post-RERA has really been highly dependent upon the demand and supply. So the geographies where the price rise been very high, like Noida, Greater Noidas, Ghaziabad, and North Indian places, where there was a supply constraint because a lot of new supply was not coming in comparison to the rest of the geographies across India. The limited supply was giving an opportunity to the developers to really speculate and increase the prices because marketable supply was very limited. And my own sense is builder wants to really maintain certain cash flows, and so they have to maintain the velocity, and that's why they started offering discounts and offer. And it's more to do with the demand supply rather than other issues. And I'm not seeing too much of price correction risk because rental yield across most of the geographies are very good. Mumbai itself has touched close to 4% of the rental yield on an average. And that's kind of thing above 3% rental yield we are seeing in majority of this geography. And that's where I see that the prices have productivity. We don't see a big price correction risk, but one thing is that the price rise is moderate, and so as the discounts offer also been in the moderate range of 0 to 5.
Got it. Mr. Kapoor, apologies, we are completely out of time, but thank you so much for joining us with your insights on what's happening in the realty space. A lot to do with the demand-supply issue, not so much pricing. But with that, we'll take your leave on this edition of Midcap Radar. Quickly taking a look at what's happening with the Nifty, 50 points higher and around 30 to 32 stocks in the green versus what we are seeing in the red right now. So watch out for that. We'll take your leave now, but closing bell will come up on the other side.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Contrary to what the Dow futures are doing, the Asian markets are still relatively positive.
On Friday, you've got the S&P 500, which ended about 0.65% higher. Nasdaq was up 0.8.
But importantly, it's the restructuring, value unlocking and fundraising.
It's been a terrible last 1 week. 16 points lower, absolutely flat now on the Nifty.
So we do have a similar kind of a construct wherein we do think that larger companies have a far greater risk reward.
There's a high-level government committee that came in. They're recommending that, Chinese firms now could start bidding for these government contracts.
Very advanced stage of issuing the NOC for NSE IPO.
Because gold is now trading at $4,600 an ounce. We have seen prices gain up by 4% in the previous week.
If the market sustains here, these guys will have to cover their positions. That will cause an accelerated decline.
Well, it is turning out to be a Monday where we are seeing pressured markets on our hands.
Both sides continue to actively engage. In fact, the next call on trade will occur tomorrow.
It is now trading in positive territory. At one point, it also made an intraday high of 25,740.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And during the course of the show, some of our co-anchors as well will be joining in. Hey, Mangalam, who would have thought, right? The markets are looking for a bit of a trigger, and they got it midway through the trading session. Green is the color, but a couple of hours back, well, it was only red on the screen.
It was maroon on the screen, Nigel, if one could say that. All the data points were so much towards an extreme that it just needed one trigger for the market to move the way it did. And at one point, we went below the 100-day moving average. The put-call ratio moved to 0.6. We've been talking about how the FII longs are at the lowest levels that we've seen all the way since mid-October. So all these factors coming together, we've seen the markets move higher. The question now is that with that, oversoldness of the market coming off, are we in to see some bigger gains here or not? Because the broader market's still under pressure. The Nifty has recovered from the lows. The Midcap index is still in the red. And we still have about 2,000 stocks which are in the red for about 860 stocks which are in the green. Yes, those lines have come closer, but haven't kissed.
Well, that's right. Now, just to give our viewers a quick update, the US ambassador to India, Sergio, aided today's surge from the oversold levels. The Nifty, well, that currently has moved above that 100 DMA, protected that 100 DMA. And the Nifty Bank, more importantly, that's actually been the, the heavy lifter in this entire run that we have seen. That as well is trading mildly above that 20 DMA. So that's the important mark out there. The Nifty needs to defend that 100 DMA after breaching it intraday. And the Nifty Bank needs to defend that 20 DMA, which it also breached on the intraday basis. The PCR, as Mangalam said, it had gone down all the way to around 0.63, 0.62 as well. And then from there, in fact, it surged. Now it's at around 0.86 the last time I checked. Technically, the Nifty is still very much skittish, but the FI short positions could actually be a blessing in disguise, provide some kind of cushion to see a bit of a bounce. So if we give you a range, well, on the downside, the recent low, little below the 25,500 mark, that becomes the important mark on the downside, just in the near term. And on the upside, you have the 50 DMA, the 20 DMA, you have the options data as well. All of them are pointing to the 26,000 odd mark being a bit of a resistance zone. So 500-point range, let's see which way it'll swing. But with the FIs being net short and with the PCR at the lower end of the range, at the start of today's trading session from around 25,500, well, you would bet the Nifty to head more towards the 26,000 mark rather than head towards the 25,000 odd mark, Mangalam.
Take that point, Nigel. The risk reward was firmly in favor of a long if the panic was taken care of. For a brief period, the market did break that 25,500 mark as well, but thereafter it sustained above those levels and we saw the indices move higher. What's leading the rally right now? We are seeing some traction on the banks. A lot of these FMCG names are seeing some purchase as well. So HUL should come up for you, currently at the high point. In fact, the FMCG index by itself should, tell you how it's moved higher. We have Godrej Consumer from the broader markets as well doing well, but none a bigger contributor than Reliance. Just pull up the intraday chart of Reliance as well. Reliance was under pressure and the market was not doing particularly well. There was a fair amount of panic, and now from those lows, there's been a big move. Reliance is back in the green at the high point of trade, and that's reflecting in the kind of moves that we're seeing in the frontline index. But it is the story that came in from, the US ambassador in a shot of optimism for the market, which saw it recover from the day's low. The newly appointed US ambassador to India, Sergio Gore, said that the next call on the India-US trade will take place as early as tomorrow. Now, remember, a call does not entail a trade deal has happened, but it's a step in the right direction. With the market being oversold, the street took, the positive out of that comment, and as a result of which, the up move is what we saw. Let's hear out what he had to say, and then we discuss this further.
The United States and India are bound not just by shared interest, but by a relationship anchored at the highest levels. Real friends can disagree, but always resolve their differences in the end. Last week, our great Secretary of State, Marco Rubio, powerfully stated that this year will be a year of reciprocity. We are raising the standard for diplomacy itself. That means fair trade, mutual respect, and shared security. Many of you have asked me for an update on the ongoing trade deal negotiations. Both sides continue to actively engage. In fact, the next call on trade will occur tomorrow. Remember, India is the world's largest nation, so it's not an easy task to get this across the finish line, but we are determined to get there.
Well, the market chose to look at Sergio Gore's comments with optimism that maybe something's in the works. But as Manglam said, a call is fixed. Doesn't mean we're going on a date, but there's a hope, right? There's a chance in there.
There's a hope, and his name itself, Nigel, is Sergio. So obviously the market should search. Let's say that. But, that's on a lighter note. But let's take this conversation forward. We do have Sanjay Parekh with us.
Well, that's right. Let's welcome Sanjay Parekh, founder and CIO at Soham Asset Managers, who joins us on the show. Hi, Sanjay. Well, it was getting a little too tricky, right? I mean, last few trading sessions, we were down. Today, in the first 10 minutes itself, we were down close to 100 points in the Nifty, and plenty of stocks had already lost 4-5%. I was wondering what was going on. And when Manglam and myself were on at around 10:30 a.m., we were saying, where is the fresh negative trigger? Luckily, Sergio came to the rescue. And in fact, we did see the markets at least bounce in the near term from oversold levels. What is your take on the markets? We entered this year with plenty of optimism. We have started off a little bit softish. But do you think ultimately things will fall in place and this will be a far better year?
So the framework we have is, we go with the earnings of this year. Again, we're going to have weak numbers. There are minor downgrades after the preview. This quarter also, unfortunately, has been, from previews that we see is like more like 7-8% top line growth for Nifty, EBITDA growth of 4-5%, and profit growth of 3-4%. Now that clearly doesn't augur well, because we were looking at some recovery, maybe not more like 10, 12, 13%, and then Q4 looking far better. But, we still can wait, and because, November, December, some of the economic indicators have turned positive. So fourth quarter outlook will be important. We'll again, benefits of lower interest rates and all could percolate in the fourth quarter. And that is where we hope, because earnings recovery will be the major catalyst for the market movements upwards.
I take that point entirely. When we did that survey from a lot of the market intelligence here at the start of this year, everyone was given options as to which will be the biggest trigger for the market this year. And obviously, while in commentary, it was the US trade deal, etc. But when we asked them to put pen to paper, 66%, more than 60% of them, actually closer to 70%, said earnings will be the trigger for the market going forward. So far, from the updates that we've got, you said that it's going to be a 7 to 8% top line, Q4 looking like a better quarter than Q3. What sectors do you believe will lead earnings from here on? Because from the updates that we've gotten, FMCG, it's showing improvement, but not so much. Banks, yeah, there are signs of improvement, but not a big surge. On the other hand, metals, they look like they're on a cyclical uptrend. So would you bet on commodities to lead the earnings or the traditional ones?
I just broadly cover from the preview that we've seen. there are no major positive surprise. Some of it is known. So starting banks, we know that NII growth will be under pressure because of the repo rate cuts. Diversified financial in the Nifty mainly is Bajaj Finance, where it's in line with a little overgrowth, but in line. Coming to discretionary auto, X of Tata Motor, quarter on quarter there will be a recovery. Cement, quarter on quarter there will be a lower EBITDA per ton because realizations have been weak, and year on year they look okay because last year third quarter was weak, but nothing exciting in cement. Utilities also will be more like flattish. Pharma, because the high base of remdesivir, this certainly doesn't look great. So what will look better is ferrous will certainly be an okay quarter, but outlook for fourth quarter in ferrous will be good because the price have increased. Non-ferrous will certainly do well, and the outlook for non-ferrous will be very, very good ahead. And then capital goods should be broadly, in the larger cap, Larsen looks fine and in better numbers. Staples will be still weak. IT will be 6-7% growth. So that's where the overall growth is still quite tepid.
All right, Sanjay, since we're talking about the ones where you're overweight on, and I've always told you, that kudos to that gutsy call you had on the non-ferrous, namely stocks like Vedanta, that you played, and they've given you good returns. But the other, sector that was not really consensus, or if I compare the weightages that you have in your portfolio, which compares with the benchmark, is capital goods. Out there as well, I think you're still overweight. There is this talk about some kind of slowdown, capex spend as well slowing down, but there is some optimism that maybe private capex is actually picking up. How are you placed on this theme? L&T is one of your big holdings. I think Interarc is another one. Dilip Bilkon is another stock that you have in there. You continue to hold that optimistic stance on the capital goods space?
Yeah, I think all of them. I think, for the government to recover the economy, even in the budget, they will have to be progressive on capex. What was missing was the state government capex, which was diverted to all the popular schemes, and that did affect, the growth of maybe order books or delays in execution or payments not coming on time. But the opportunity is pretty large. And at least we believe very strongly that bottom-up, Larsen is, of course, the large conglomerate, but the rest of them on a bottom-up basis, there will be opportunities. And some of them are at very, very deep value, So we are positive on a bottom-up basis. We will look for that where there is valuation comfort, and we will increase our exposure. So we increase our exposure in the transformer segment recently. Interarc has been an old holding we've been holding. Dilip Bilkon is not work, but serious deep value. And Larsen and Toubro, it's worked very well for us, and we continue to hold on. We are positive on this theme.
And transformers and rectifiers, right? You're talking about transformers. That's another stock that you'll had. Still intact?
Yeah, after this fall, because they had a very bad Q2, so there was a very steep fall. And we thought that, there is clearly capabilities in the higher KV segment of 765 and eventually even HVDC, where there are only multinationals. So the capability of the company is phenomenal. Of course, the Q2, the way, in terms of the way they maybe guided the street and delivered badly, the stock really got hammered. And this we thought was a good opportunity, and hence we slowly were nimbling in it. And Q3 has been good, and the outlook for Q4 and ahead is definitely good. Overall, the demand supply in this space is clearly in favor of, the producers.
Okay.
And we don't see a threat from Chinese in this segment. We don't see that.
All right, Sanjay, I'm going to request you to stay with us. Good to hear that, in fact, you'll continue to nibble on into a stock that's actually fallen, transformers and rectifiers, and you're giving us good rationale for that. Request you to stay with us. We'll slip into a short break. On the other side, we'll continue the conversation with Sanjay. And to give him company, we'll also be joined by Rahul Sharma of JM Financial. He'll help us out with how the technicals and how some of those key data points are shaping up. Don't go anywhere.
Welcome back. The market continues to hold with a gain of 50 points on the frontline index. The Nifty just about 20 points away from the highs of today's trading session, holding on to those levels. A lot of stocks from the broader markets are doing a lot better right now, even as the advanced decline is firmly in favor of decliners. Look at Dredging Corp, 8% surge out there and decent volumes backing it. Over 1.5 times what we've usually seen on this stock. The other one is GMR Power. That too has seen a sharp surge, up almost 6.5%. And here too, the volumes are nearly 3 times what we've seen on an average day for GMR Power. So dredging is up 8%, GMR Power up 6.5%. Don't lose sight of Force Motors as well. One of the stocks of 2025 and driving in 2026 in good style as well. Big mover out here, very close to the 20,000 mark on that stock too, 6% higher.
Well, that's right. One more stock, Mangalam, Methane Alloys. NSE could probably be listing sooner rather than later. They have a large chunk of shares in NSE. I think more than 10 lakh shares, I think this is what they have in NSE.
Oh.
So explains why that stock is up 13%. But the core business is something that you should be focusing on as well. But it's become more like an investment company because of the kind of holding, the kind of cash as well that they've had.
Question then will be, once NSE comes out with an IPO, at what point do they, unlock value? We've seen these stories, Nigel, in the past as well. But, whether NSE's listing impacts Methane Alloys or not has definitely caused a lot of happiness to BSE on one side because the NSE IPO approval has come by, or rather, the possibility of an approval coming by has happened. And secondly, the SEBI chair himself has said that, there won't be any major change to the derivatives environment right now. The street was worried about that. And the BSE shareholders are heaving a sigh of relief with a 4% up move in an otherwise wobbly market. Metal stocks continue to do well.
Well, that's right, Mangalam. That was the stock of the day that we gave earlier this morning on our Bazaar chat as well, because of those two reasons itself, because of SEBI chairman's comments on NSE, as well as no risk probably in the near term to the derivative trading out there. We're talking about BSE right now. Let's welcome Rahul Sharma, Director and Head Technical and Derivatives, JM Financial Services, who joins us on the show. Hi, Rahul. Good afternoon. Good to see you in, and thanks for joining in. Well, when we had told our team, that I said I wanted Rahul on the show because you give us some interesting data points, particularly from oversold levels. But Mr. Sergio had a plan of his own. He made a couple of comments out there which the bulls liked. Given that we've seen a bit of a bounce from the lows that we saw literally of sub 25,500, tell me, what's the level you're looking at from here on? Do you think this rally can extend to the upside, maybe get to around the 20-day MA? Or do you think it's a bounce that, in fact, you look to short into?
See, there are two things to it. We've gone from being extremely overbought on previous Monday. The put call ratio hit a 1-year high on the previous Monday, and this Monday we were at the lowest point in the last 1 year. And coupled with that, we have this reason of the US ambassador coming on air and giving a positive view, at least uplift the sentiment. So bounce back has definitely started from the 500 panic low we saw in the Nifty. India VIX, which has shot up by 26% in the last 3 days, seems to be done its bid, at least for the short term. And what we are seeing in terms of sectoral participation is you have metals, which is leading the market, no cause of concern in this space. And you have banks which are not falling. So the bank Nifty index is still above its 50-day EMA, whereas the Nifty went below the 100-day EMA. You have PSU banks which are even stronger, trading above or rather close to the 20-day EMA. So essentially, these are the pockets of the market which are keeping the Nifty afloat. And this bounce back could very well head towards the 26,000 mark. We still have lots of shorts in the system, not only from a long short ratio perspective, which has always been below 10 since many weeks now, but now the absolute number of shorts as of Friday were close to 1.9 lakh contracts, which brings to the table that after this statement and seeing today's price action, a lot of those shorts would be running for cover. So now the view is bounce back until 26,000, and post that happens, take a review and see if there is more fuel left into the tank.
All right. So what kind of fuel are we looking at here? I mean, if you could put some numbers to that.
Yeah, so the focus post this Supreme Court outcome of the US will shift on earnings and secondly, the budget. Now, 500% tariff is more of a headline risk than an absolute threat. What essentially the market would be looking on is Is there any increment in the earnings numbers? And secondly, sectors like infra, sectors like banks and defense would be the ones could be preparing themselves for a pre-budget rally. So I think the best way to approach this market is start with large caps first. Possibly some bit of volatility maybe there around the 26,000 mark. But once Nifty has sort of stabilized above 26,000, I think then we could very well see these pre-budget names sort of, really taking their own. So be selective, start with the index first and then probably move on to these sectors. Something very actionable at this point in time. One is the biggest dragger of the Nifty, Reliance, is not bearish anymore, at least in today's session. The stock is looking for a recovery until 1550 on the upside. Then you have another telecom major, Bharti Airtel, seems to have formed a bottom today. So there are two stocks from the telecom space, looking pretty solid on the charts. Okay. And at the same time, you have a banking index, which is relatively outperforming the market even in this correction. So these are the key, some of the pockets of the market where focus can be drawn, and essentially, take this right now as a bounce back. Once 26,000 gets navigated, further clarity is expected to emerge.
All right, Rahul. So 26,000 on the cards for the Nifty. You'll be tilting more towards that. Focus shifts to budget as well as, the earnings. And you like sectors like banks, infra, as well as defense. And the two stocks that you've named is Reliance Industries as well as Bharti Airtel. Rahul, I know your love for two-wheelers as well as four-wheelers, and for the circuit as well. I believe you were doing some racing over this holiday. But the sector that you like is not autos. The top sectors, I believe, metals, you're saying, right that. And from the banking pack, PSUs is what you like. Could you tell us a little bit more?
Yeah, absolutely. Timing is everything, whether it is technicals or whether it is, these autos. The point is, go with strength first. They are the ones which have been the least hit. And there is, a good enough reason for them to rally once the market stabilizes from here.
Right. Didn't know that you were a biker, Rahul. Interesting one out there. So next time we'll not only talk to you about the charts, we'll ask you about, some of these trails as well. Though in my defense, I don't know how to ride a geared bike, but maybe one of these days.
Even Rahul likes the four-wheelers as well. I think he did. You did a drive on the circuit, I believe, right? Is that correct?
What circuit is this?
Yes, absolutely. So this was a small one, but quite an interesting one as well.
All right, interesting. Right now, the only circuit that the street wants is the upper circuit on the market. But be that as it may, let's wrap this with Sanjay. The last word, Sanjay. You did speak about the sectors you like. You did speak about all the things that can outperform from here on, or you're betting on. One state conspicuous by its absence was any of these consumption themes, be it autos, be it consumer discretionary, staples, retail. And especially at a time when the last 7 or 8 months, the government's tried to do everything it can to revive consumption. And then you have, the 8th pay commission coming as well.
Yes. So we are positioned on discretionary side on autos, and it's worked well for us. But, now they're not cheap. Maruti has moved up quite well. So while we are holding it, but we think near term, I think they're done for the time being. I said for a core holding, we will not tinker with them, but they're not cheap anymore now. So M&M and Maruti we own, and it's worked well for us. And we will continue to own. On the other piece of consumer staples, we still feel growth is quite weak. And, the moat in each of them is really getting attacked from multiple sources. And valuations are still not okay. So we would want to play consumption through, maybe financials, telecom, NBFCs, discretionary auto, where we feel at least, you have more clarity on growth and reasonable valuation.
Okay. Got it, Sanjay. Thanks a lot. I think Mangalam will be going through a lot of those FMCG names and their results and trying to dissect them. Maybe, in fact, one of those staple companies could come on your radar. For the time being, you're saying stay away from staples. You find plenty of other better opportunities in the market. Thanks a lot for joining in, Sanjay, as well as Rahul. Wishing you all a good remainder of the day. But we'll slip into a short break. On the other side, Mehboob Irani is waiting for us. We'll discuss some of the top stocks that are on the news. Welcome back. Normally we start closing bell at this hour, but we started half an hour early because of the kind of volatility that we saw in the markets. Nifty was down close to 200 points, and now as we speak, we're up around 50 points or thereabouts. Sergio Gore's comments clearly, giving the bulls something to hope about. He's saying that yes, they could discuss the trade deal, could discuss it. Not just going to have a chat with that, but the street is optimistic that there will be some kind of outcome. Well, let's find out first, how do you position yourself in the final hour of trade? Mitesh Thakkar is back with us. Mitesh, if you went ahead and bought at lower levels, I think today you were suggesting to buy at around 25,400 or thereabouts. I think we went down to around 25,480. And from there, we did see a good bounce. What do you think? Enough gas in the steam to push us higher? Or would you take some profits if you bought earlier today?
So Nigel, we didn't buy because, as I said, we were waiting for lower levels. Though we have some options positions on the bullish side in the Nifty, have some call options because we didn't kind of hit the lower level. So futures position did not get initiated. But I think it looks like, market which has fallen vertically is trying to bounce back a little bit from oversold levels. My sense still is that, it will be very difficult for this index in the short term to get past 25,950, 26,000 zone. So let's say if you bought anywhere close to about 25,500, 530 zones also, then I think just take some profits and trail your stop losses to about 25,630. I think on the upside, as you get closer to about 25,900, traders should be looking to exit long positions and then see if, there's weakness and we can reinitiate on the positions on the short side.
Got it. Okay. All right. So not sounding very optimistic that we can get past the 2050 DMA band, which is ballpark around 26,000 odd. Mitesh, give us a couple of trading calls though, because stocks are doing a thing of their own.
Yeah, they're good. A lot of stocks have reversed. The first one is Asian Paints from the buy side. Keep a stop below 28.54. Look for targets of 29.40. And HAL is a buy with a stop at 44.79 for targets of around 4,600.
Okay, all right. Thanks a lot for that, Mitesh. Well, good time to welcome Prashant as well. He's in. Mangalam's taking a bit of a break. And Rima will join us in a bit, I'm guessing. Hey, Prashant, green
Rima,
on the screen.
Rima's already at TCS. Nigel.
Oh, surely there.
I think. I don't know. But anyway, TCS later today will be interesting. Nigel, I mean, it's interesting. Markets have rebounded quite nicely. And of course, the Sergio Gore comments are helping.
Yeah.
But the one name we track, Gokuldas, which is the indicator, that is down 5.5%. There is no recovery in that one. So I kind of wonder whether, of course, I mean, I think those Gore comments were the trigger and the market took off vertically. But, you would have seen this one sort of come up. We should put up Gokuldas, basically, is what I'm talking about. You should have seen some interest, some comeback here. So the question to ponder, to wonder is essentially this. Even without Sergio Gore comments, and maybe we would not have had a vertical rally, but are we getting to levels where on a F5 28 basis, things are looking slightly more reasonable, etc., after the sharp fall that we've had recently across the board? Opinion, of course, is divided. There are many seasoned investors who believe maybe a little bit more is required and prices need to grow into earnings, etc. But I mean, I think into valuations rather. But it's a debate which we will keep having here on the channel. Capital goods stocks is the other area. I think Hitachi's recovered from the lows. GE, T&D is the other one. Transformers, CG, etc. They all actually in the morning, along with the market, were down sharply. We had IIFL Institutional Equities' Renu Baid, who told us that her industry checks indicate that a large Chinese company which has got manufacturing facilities in India, will be allowed into to participate in tenders on the power transmission side. Vinny's here with details and what she's put together. Vinny, afternoon.
Hi, thank you so much for that. Yes, so firstly, let's just take a flashback in terms of what happened last week and why these stocks had fallen. Now, according to a Reuters story that came in, that Finance Ministry was planning to scrap the 5-year-old restrictions that were there on Chinese firms. These restrictions came into place in 2020 on some of the power, railway and other sensitive government contracts. Then, obviously, CNBC confirmed with some government sources as well. They said that no decision was made as yet. But before that, the stocks were beaten down already. And then, despite this notification coming in or the clarification from sources that came in that, there's no decision yet taken on this front, still the stocks are falling. Even today, we saw the stocks falling in trade. Now, Renu, where the IFR, what did she say? She said that no government notification is there as of now, even till date, in terms of lifting these restrictions. Channel checks are suggesting that TBEA, which is a big Chinese company, they have been approved maybe for participating in high voltage reactors. So only a specific product, maybe where they can start participating in these government contracts. She also highlighted that, you know, even if this comes through and TBEA is there and participating in this contract, she's not expecting a lot of impact in terms of the performances of our Indian companies. So not much of a worry. She doesn't expect much of a change or fluctuation in terms of pricing as well, at least in the near term. Now, apart from that, what we also had is a lot of other brokerages wrote about this. They said that the relaxation may be more segment-based with prior requirements, part that they want to participate in a government contract by these Chinese firms. It's not going to be a blanket rule that the restriction is lifted for all Chinese firms or even across the board in terms of transformers or in terms of reactors, not across a blanket rule. So maybe negative impact could come in for something like an L&T, BHEL, GE, Vernova, TND, Hitachi Energy, Siemens Energy. And that is why we've seen a bit of a fall coming in these stocks in the last 3 trading sessions. But that is something that we'll be keeping an eye out on, whether this actually comes in terms of any notification.
Okay, all right. Thanks, Vinny, for explaining that to us. Mehrbon Irani as well joins us on the show. Hi, Mehrbon. Good afternoon. Good to see you in. First time we're speaking in 2026. So wishing you a cracker of a year and look forward to interact with you as the year does progress. Give us your view on capital goods. They thought it was going well for it. Unfortunately, the last few days, they've been very, very nervous for the reasons that Vinny put on the table. After this kind of decline, would you be interested or will you stay away?
Happy New Year, Nigel. Happy New Year to all the viewers. And I hope that the New Year, though, has not started very well for the markets, hopefully will end the year on a much, much, much better note. Keep fingers crossed. As far as capital goods goes, as far as Chinese companies will be allowed and this and that and all, I think there was a report from a otherwise very respectable agency about Chinese companies, government will ease restrictions for them for bidding for government infra as well as power sector projects. I think the same evening, the government statement, whatever format it came, they denied it. Unfortunately, many accidents are taking place off late in the markets based on such information which is floating around from respectable agencies. Many times it gets denied. Now, even I think on Friday it was Manappuram Finance, Bain Capital, RBI restrictions. Manappuram comes up with a statement. The stock comes around 310 to 278. I think all this is just not fair. When we come on television and give some recommendations here and there, we have to be very, very discreet in what we are stating because the regulator is looking at us. It's as simple as that. So why are these agencies not being questioned? It's a simple thing, I'll put it. Anyway, let me come back to the question which you asked. The report surfacing that government may ease restrictions on Chinese companies suddenly was a big negative as far as sentiment goes for virtually all capital goods stocks. Fear of renewed competition from Chinese OEMs for project orders, pressure on margins, visibility of projects going ahead, all this became a little bit of a question mark in the minds of the market, which even otherwise, the market has become very suspect of things around because people are virtually seeing blood on their portfolios for the last maybe 1 to 3 months now. So any negative news, people are extrapolating it. Now, stating that it will be only for reactors or some products here and there is a different issue. In some cases, the weak or delayed orders for the capital goods sector is also starting to happen. And I'll give a simple example. I think on Thursday last, Elecon Engineering, a company which I'm owning the shares, otherwise a good company, announced numbers which were definitely not great, but were not so bad also. And the stock was down 18%. And what was visible in those numbers was the execution problem and somewhere the feeling that they are not getting the collections or the money or the receivables on time from the companies from which they have got the orders. So this is definitely unnerving the market. And let's accept one thing, capital goods over the last 3, 4, 5 years has been one of the most preferred sectors of the market. The companies are doing well, growth is happening, the stocks somewhere are a little bit expensively valued. And with this type of news floating in the market, plus the Elecon results, which I am singling it out right now, I think couple of reasons here and there, and you may see the stocks correcting 5-10%, and that is exactly what is happening at the moment. As far as the Chinese things goes, I personally hope that there will be a little bit more clearer clarification coming from the authorities.
Okay, all right, got that. But Merbun, you know, when you were talking about responsibility and various networks reporting this and that, you also briefly mentioned gold financiers. You know, it could be actually a very, very good scenario for them that plays out because the world has gone into a bit of a funk and that gold price could get protected at these levels, if not go up. And the cost of borrowing could come down because, you know, there are still some cuts that are in the works. That means the cost of borrowing could actually come down. How would you view the gold financiers? And we have namely, you know, a few names, Manappuram, Muthoot, IFL Finance. I don't know whether you want to throw in Capri Global in there, but your view?
I am personally holding Manappuram and Muthoot. So with a clear disclosure that I'm holding them and I intend to keep on holding them. As far as my view on precious metals goes, I've been quite vocal to whoever has asked me over the last 6-7 months that I'm very bullish on silver as well as gold. Can they correct by 10, 15, 20% also? The answer is yes. Will they be higher from here? Answer is yes. The world is becoming a very dirty place. We all know geopolitical problems virtually are surfacing every now and then. There could be pressure on dollar here and there. Going ahead, certainly. So I think precious metals is a good place to be in. Now, what has that got to do with gold finance? Gold finance, I think you rightly mentioned it. And Nigel, I keep hearing you about gold finance and about metals in general. I think your comments are very direct, very straight, and very clear, and very apt. So I think Manappuram and Muthoot are, I don't know much about the other two which you mentioned, and I don't own them, but as a space, I think this should continue to do well. As far as Muthoot goes, I think the company has clearly refused to, as clearly stated that they will not go in for financing against silver ornaments. But as far as gold ornaments goes, I think they are doing gold financing goes, they're virtually doing a great job. Manappuram had its own problems, the microfinance business, and they have been working on this deal with Bain Capital from March 2025, if I'm not mistaken. Most clearances are in place. They are stating the RBI clearance will also come into place. And if all this happens, I don't see the stock not going up by at least 10-15% more from here. As I mentioned earlier, any sort of news coming here and there, there could be a sharp retreat for the stock. This happened for Manappuram, but I think this continues to be honestly a good place to be in. So Manappuram, Muthoot are in my portfolios, intend to hold it, and I would advise that people who are holding it can continue to hold it. As you rightly mentioned, this is a good space to be in.
Okay, all right, Merbun, stay with us. I want to highlight what's happening with Tejas Networks as well. It's a complete collapse. So it's not as if it's a stock which has done well, bombed out name, and further selling pressure here after second quarter. Numbers numbers from the company. Vinny is here with details. Vinny, take it away.
Hi, so numbers were not a good one this time in Q3 FY26. Year-on-year basis, the revenue was down by around 88%. The EBITDA has seen, actually it's an EBITDA loss this time of 134 crores versus an EBITDA profit. So clearly, obviously, the company is reporting a loss this time as well of 196 crores. Now, this is an indication that one, there were weak sales. There's deferment or delay in terms of the major BSNL order that impacted the top line as well. And seems like, you know, that peak that one saw in coming for reflecting in the numbers for the execution of BSNL, that seems to be done for the company. Now, apart from that, when you look at it, the delays that has been continuing for a while and seems like it's worsened a bit as well. Fourth consecutive quarter that the company is actually reporting a loss this time. And overall, when you look at it, the cash position for the company at the end of the quarter was at 537 crores and net debt stood at around 3,349 crores and versus 3,738 crores. So obviously this is mainly a bit lowering in terms of the net debt because of the lower capital working that's coming. But all in all, not a good set of numbers, and that is why we're seeing the stock fall in trade as well.
And I'll ask Merbun about Tejas in a bit from now. But Nigel has walked across to the wall to the F&O positioning and F&O desk. Nigel, take it away. What's happening?
Well, you know, Prashant, at the start of today, we had hired two key factors that we were looking at. One was the FI net short positions, which had reached the extreme level on the upside. And the other factor was the Nifty PCR that had reached the extreme level on the downside. Now, the PCR, the last time I checked, has moved to around 0.85 from around 0.6. And when we did see that bounce post Sergio Gore's comments, well, the PCR was actually at around 0.62 odd, which tells you that historically we have bounced from there and today was no different. However, the reason can be different each time around. Now pull up a couple of strikes today. Some of those put buyers, they were well in the money. They were dancing away to the bank. The 25,600 put, the premium at its peak today was 145 rupees. That's come down to around 21 rupees. So now that we are seeing that there is writing, from the lows of the day, there was actually writing being seen out there. And some of those put buyers will be actually repenting that they didn't square off those positions because they were very, very well in the money. If you pull up the 25,700 put, the premium right now is around 42 rupees. At the peak of today, what it was at? 225 rupees. So a sharp downtick is what we're seeing, but there are signs of writing at both those two strikes. So if we give you a broad range on the Nifty, it'll be around 25,500 to around 26,000. Why do I say that? The low of today is ballpark around 24,800, 25,480 or thereabouts. And on the upside, you have the 20 and the 50 DMA, that's at around the 26,000 odd mark. So yes, we're seeing a pullback in today's trading session, but it will require a bigger effort to get past the 26,000 odd mark. Individual stocks, mines, metals, they continue to remain in focus. So there are signs of fresh buying that we're seeing on Tata Steel. Big uptick is what we are seeing on the stock, and as well as open interest built up. Coal India, that's come in for a short covering bounce. After not doing much for multiple months, they have this BCCL IPO that's currently underway. It's seeing massive subscription out there. And there's hope that maybe valuations as well are pretty much in line. That one, in fact, is coming for a bit of a short covering bounce. And SAIL, I think you should keep an eye out on this stock. There was some shedding that we're seeing on this particular counter the last time I checked. And I think possibly in the next 2 to around 3 trading sessions, it could possibly come out of the F&O band. So the market's at the high point of the day. A couple of those technical parameters did get stretched. And that could be some of the reasons that we saw a bit of a bounce. Back to you, Prashant.
All right, Nigel, thanks very much for that. So that's an interesting state of play. Mehrabun Irani is with us. Mehrabun, we were talking about Tejas Networks earlier. Any thoughts on this one? Tata Group company, one of the few companies, I guess, in that segment and across where it's got very, very strong IPs, is involved in 6G. I mean, technology-wise, right up there. Share price-wise, right down there. What's the call?
Tejas always had the credibility, still has the credibility. It's ultimately a Tata Group company. Quite a few funds, I remember, was speaking very positively about it. They became the Pied Pipers and everybody else followed. There was momentum in the stock. Stock went to DC levels and people were justifying it. But they all ultimately fall and they become a victim to something called the growth which is projected, which is factored in, and ultimately what the company delivers. Look at other names also, like say a Trent, a Tata Elxsi, a Protean, Keynes, Dixon, Sterling and Wilson, Blue Jet. Look at the valuations they were commanding, and they're all fallen to earth right now. Are they bad companies? Certainly not. Are they in decent businesses? Answer is yes. But you can't be going on chasing such stocks. So Tejas was a stock which people went on chasing. And for the reasons that you rightly mentioned, telecom equipment maker, BSNL, progressing to 5G, 6G, routers for broadband and for other things, I think it's a good company otherwise. But a year ago, when I heard the conference call, I became convinced that the numbers going ahead are not going to be good. The management went on defending itself, stating that things will improve without having a very clear explanation as to how and when the things will improve. So one fine day it will improve, but for the moment, I think the numbers are dismal, to say the least. I think with a loss of 200 crores for 3 months period, and with the turnover dropping by 80% over what it was last year, the writing is on the wall. So people who are not yet sold into it have nothing else to do but to keep on holding on to it. It's a good company. One fine day it will recover, but in the near future, honestly, I don't see it happening. So this could be a stock which will have a sharp bounce back as and when, because it's fallen so much, but there are no triggers as such possibly to go ahead and recommend the stock just because the stock is 1/3 or 1/4 of what it was, say, a year and a half ago.
Okay. All right, Mehrabun, thanks a lot for joining in. Look forward to chatting up with you soon. We appreciate you joining in. By the way, the markets are being down 200 points. A big reversal is what we're seeing. Now we're up a good 100 points with the Nifty Bank holding above the 20 DMA. Slip into a short break. You come back. Rahul Vera of Nippon India AIF is waiting for us with his commentary on the markets.
Welcome back. Just coming up to the 3 o'clock mark, let's go across to Hormuz, who's now standing by with what's moving in the broader market with volumes and with price action. Hormuz, take it away.
Boy, what a turnaround this has been in the second half of the trading session. And one name, though, that still continues to remain an underperformer is Laurus Labs. And it's been underperforming after the record year that it had in 2025. The third straight day of losses now for the stock, almost 4% lower as we speak. Profit booking now seen from record high levels. The last 3 sessions, the stock has declined almost 8%. And so far in the year of 2026, today's volumes are the highest that you have seen. 20 lakh shares have been traded, double the 20-day average, which is 10 lakh shares. And the stock is now trading around its 50-day moving average of 1,028. It's looking to take support at those levels and rebound from there. And the 2025 was the best year that the stock had since 2020. The stock had gone up almost 65% last year. JTL Industries is an outperformer in today's session, among the top gainers on the small cap index, almost 20% higher now, the biggest single day gain on record. Snapped a 5-day losing streak today. Volumes are the highest since December of 23. And before today's session, the stock had gained only in 5 out of the last 24 trading sessions. In today's session itself, we have had 4 crore shares that have been traded on the stock. The 20-day average is only 4.5 lakh shares. But despite this, the stock remains below its key moving averages. Now it is heading towards one major level, which is the 50-day moving average, that is at around 61.5. And the year gone by was a forgettable one for the stock, was down almost 40%. Back then was the second straight year of negative returns. Kernex Microsystems is another name that's not doing well today. It is a 9% lower, the biggest single day fall since April of last year. 5th straight day of losses for the stock. Volumes are the highest since May of last year. We'll have 13 lakh shares that have been traded already, 20-day average of just 2 lakh shares. And the stock is now trading at its 200-day moving average, a very important level of 1,093, and it's already below the other key moving averages. And from its 52-week high, which was close to 1,500 rupees, the stock has corrected almost 25% from those levels. And lastly, a segment that has not participated in this recovery is the real estate stocks. Well, Signature Global, Prestige Estates, Godrej Properties, all of them still trading 3 to 5% lower, and significant volumes as well. With Signature Global almost 3x of its 20-day average, Prestige Estates also 3x its 20-day average, Godrej Properties almost 4x its 20-day average. So significant volumes. Real estate is one sector that continues to remain under pressure despite the market recovery.
All right, thanks very much for that, Hormuz. Rahul Veera is with us, Fund Manager, Equity Investments, Nippon India AIF. Rahul, good to have you with us here. Good afternoon. Thanks very much for joining in. You know, the last bit, which is real estate as a pack, I mean, it's been the underperforming space of 2025. Just, I mean, point to point, in the 1 year period. Of course, before that, it had a couple of years, a great run. Where does it leave us, Rahul? You think in this space as well, prices are off 30-40% from the highs, depending on what you look at. Prices are attractive, or you think one needs to be careful?
Yeah, one needs to still trade cautiously in these names. If you see as a valuation metric, right, percentage of NAV, usually these stocks were trading at 60 to 80% of NAV prices on a normal cycle. In the last 3 or 4 years, when the market cycles or the wealth effect was very good, these were trading at 120%. So this kind of an offbeat valuations was a little bit too expensive for us to look at the sector. We believe still 1 or 2 years we are still away, even though EMI, rate cut cycle, plus your affordability index will see some kind of an uptick there. But again, on the luxury end, we'll see some kind of a pressure there. So again, real estate stocks on a broader basis is still a word for us.
Okay. Hi, Rahul. Good afternoon. Good to see you, Ben. First time we're speaking this year. Wishing you a cracker ahead. Rahul, if I'm not mistaken, the fund is approximately, 3,500 crores or thereabouts. You could correct me if I'm off the mark. But give us a breakdown, actually, because you'll do both equity as well as debt. So tell us, what is the mix right now? And also, how much of cash are you sitting on? Because some are saying they're sitting on cash. They believe there's further pain in the markets. And that time, they'll be buyers.
Right. Yeah. So you're broadly correct. We are managing close to 3,300 crores of AUM as of now in the AIF space, and plus the other is in the PMS format. In terms of cash, we are closer to double-digit cash in our portfolio as of now.
Okay. And the split between the two, the mix, I think it is 70-30 normally at extremes. Equity and
so as of now, the equity is 88%, 12% cash.
All right. 88% and 12% cash. Got that. Rahul, I just was looking at the recent entries that were made, and one large trade that stood out was a hotel company, the Taj GVK deal. If I'm not mistaken, I think it's this fund itself, the Nippon India AIF, that was a buyer. 10-20 lakh shares, I think, is what you picked up. Tell us about this particular investment, and do you like the theme? Because, the ARRs were moving up and occupancies were moving out. Then one believed one of the two will have to give. That didn't happen. So your take.
Yeah, sure. So at an industry level, right, I'll speak at the industry level, even RevPAR, as you rightly mentioned, are up by 15%, even on a high base of last year. So your occupancies at the industry level is 64-65%, which continues to improve as of now. Even though the room addition is very high, we're still seeing the RevPARs to continue in the positive direction on a high base. We believe the valuations for a lot of these names, right, will have to be a little bit selective there. Wherever you are able to find a bottom-up idea in the sector, you'll have to pick up those. Hence, our view is that some of the names can do really well over the next 1 to 2 years.
Interesting. Explains why, in fact, one of those companies probably in your portfolio from this space, Taj GVK, has valuation comfort. And this block, I think, was a bit of an overhang of the stock. Got that. Let's talk about some of these new age themes. Paytm, that's a stock I think I got in early. Delivery has been actually a bit of an underperformer. Do you continue to remain positive on these names? Paytm, I think it would be up 70-80% from the time you started entering the stock. And delivery actually has been a relative underperformer. So how do you approach both of them?
Right. You're absolutely correct. So we've been entering the overall platform space since last 1 year when there was extreme pessimism or the negativity around the stocks. We saw the regulatory overhang in some of the names lasting for too long. And the management was correcting the strategy in terms of their cost base, in terms of their regulatory approvals. They were broadly in line. Hence, we started taking a call on some of the names that we were discussing. Other than that, some of the other platform names also we are positive. We believe they are the industry leaders.
Good to see, right?
Yeah.
Triple-digit gains. Otherwise, it's been a story of triple-digit losses, 100, 200. Take your pick, at least for the last 5-6 trading sessions. So 25,800 nearly now on the index as things stand right now. The low, by the way, is today's been made at about 25,473. And let me just see if the Nifty Bank, which of course has been much stronger, it didn't fall as much as the Nifty did. Nifty Bank is also up about 1/3%. That's about 180 odd points. The broader market seen a fair bit of pain. Small cap index, though, is still down 0.5%. But it's also recovered a lot from the day's lowest point. And maybe just a quick look at the Midcap index as well. Midcap index has come back into the green. So here as well is a big, not a green candle, but a candle nevertheless from where the lows made far, far away from where we are at right now. Rahul, you have Edelweiss Financial Services as part of your portfolio, right?
Yes.
The alternates businesses coming to the any timelines on that one? That was the trigger being watched out for.
So as per the presentation by the management, which has been uploaded on the exchanges, they have given a timeline of April 2026. So that is where we expect them to come.
Is that a big part of it? Why you own Edelweiss?
So approximately 30-35% of the valuation is driven by the EEE business from that company.
I see. Okay. Now, Reliance is the other one, right? Is the number one holding for you. Again, here there are a bunch of triggers, etc. What's the just run us through your thinking here across various businesses.
Sure. So now SOTP basis, right? There are 7 lakh crores for retail if you consider the valuation. Plus OMC, your GRMs are at close to $6 to $8 on an average, where they are increasing the GRMs consistently. Plus all the new themes, investments, if you do the approximate valuation that you give to them at a book value, or probably some of them new age businesses that they're investing. We see decent upside risk reward on this at this point of time now.
Okay, all right, Rahul, thanks a lot for joining in, giving us the themes that you like. Wishing you all the best, and we catch up soon as the course of the year does progress. By the way, Hormuz mentioned a few stocks on the broader markets, and some of them are really buzzing. JTL, that's a rank underperformer. It's actually locked circuit up And volumes are very high. Wondering whether we're going to get some names coming in the large trades today, but that's one stock that I'm looking at. IFCI, I'm not too sure about how much of holding they have in NSE in terms of shares. Normally there's that debate. You compare IFCI's holdings in NSE with their market cap and the likes. I'm not too sure about how much they still have, but that stock is up 13%. Jaiswal Nico, a stock that's doubled in the last 1 year. We had explained the stock at around 45 rupees or thereabouts. It went to 90 rupees, it corrected around 80 rupees. But that's perked up a little bit as well. And Raj Ratan Wires, another stock, last week I saw the stock at one point of time was down 5-8% as well. Today, in fact, the stock has suddenly seen a bit of a surge, particularly in the last 1 hour or so. But I think Nimesh is ready. Nimesh is with us. He's here to take us through Deep Street Chatter. Nimesh, what are you picking up? The shorts are running for cover and the bulls are thanking Sergio.
Well, Nigel, this is exactly what we've been explaining. You've been highlighting as well in your links that around 0.64, 0.6, 0.65 market tends to see a bit of a pullback. And that's exactly what's played out today. A sharp short covering rally, and that's led to a big surge. So intraday, we've seen almost a 300-point move in the Nifty, largely on short covering. Having said that, there's a bit of recovery in the broader markets as well. And the extremely short positions by the FIs in the Nifty, the PCR were all indicating that a bounce was on the cards, and that's what it is. It's a pure bounce back from an extremely oversold levels. Thankfully, the flows are not that bad or that negative in today's market. So small buying is what I understand from larger FIs as well in today's market. I guess from a technical point of view, 25,450 is a level to watch on the downside. That's a crucial support level. If that gets taken out, then maybe you'll see further panic selling in broader markets and in the Nifty. So that's hopefully that holds on at least in the very near term. Having said that, given the fall we saw last week, the sentiment is very, very weak. The positions are quite light, and I don't think there is enough courage for HNIs and retail investors to buy. Over the weekend, I spoke to a lot of investors, and they all seem to be a bit dejected given the fall we saw last week. So a short covering pullback rally is what you're seeing right now, but doesn't look like the sentiment is quite strong in the broader markets.
Indeed, we're still on thin ice, actually. We'll still be a little bit jittery. But what about individual stocks, Nimesh? What are you picking up?
Well, some stocks where there's a bit of flow or some bit of reaction. So SBI Life stands out in today's market. It's gained 1%. There is buying interest, is what I understand from larger FIs. And also there was a Morgan Stanley tactical buy on SBI Life today morning. And they expect a very strong Q3. And hence you've seen a bit of an up move in SBI Life today. So that's the first name. The second stock is ICICI Bank. Over the last few days, there seems to be a flow back into ICICI Bank from larger FIs. So there is a bit of churn happening within the private banks, and money is moving back to ICICI Bank. The results are on 17, but beyond results, I guess any clarity on Sandeep Bakshi will be a big trigger to watch out for. So that's a trigger, and maybe that's the reason why you're seeing a bit of uptake in ICICI Bank in terms of flows. And the last one is Yatharth Hospital. For the last many days, there is a constant feedback of selling pressure from larger FIs in Yatharth. The stock has corrected from the recent highs, but still the supply from larger institutions continue in Yatharth hospitals.
Okay, all right, Nimesh, thanks a lot for that. And by the way, we have some news flow that's actually trickling in with regard to JTL. The stock was as is up close to 18-19% or thereabouts, and now what's hitting the exchanges, which my ticker team just alerts us, is that there's a significant order win is what they're talking about from the Punjab State Transmission Corporation Limited for the manufacture, fabrication and galvanization of a 220 kV transmission tower material and substation structures. However, I couldn't come across the value of this particular order, but going by the wordings, it appears it's pretty large. The stock was already up, and now that order has hit the exchanges as well. Slip into a short break, come back, we'll continue our focus on markets. We'll also get in our technical experts. Welcome back. Well, Mitesh Thakur is back with us. Mitesh, pretty okay trading session as we discussed earlier, but you've got a couple of trading ideas. Help us out with them.
BTST on SBI, the stop at about 1,006 for targets of 1,030. And Laurus Labs in a recovering market is remaining weak. So we'll take a activity there with the stop at 1,054 for targets of around 1,025.
Got it. Okay. All right. Thanks a lot for that, Mitesh. But, there are plenty of stocks that are moving around and we've been analyzing it through the day. But Vivek joins us now to give us a nice roundup of all those stocks that are buzzing on the back of news. Vivek, take it away.
Well, that's right. We've taken 3 stocks on the radar today, stocks that are buzzing on the back of news flow. Some relief coming in. First on the list is BSE, quite a sharp up move. Important comments coming in from SEBI chairman where they said that no action or no change in derivatives market, at least for the time being. And along with that, some positive commentary coming in terms of the NSE IPO, giving a sentiment positive as well. The other stock on the radar is Manappuram. The company has gone ahead and denied the report of another agency that said that RBI has raised concerns with respect to the Bain Capital deal. They say the report has been denied, factually incorrect as well as speculative in nature. And the last stock on the radar is Shakti Pumps. The company went ahead and told the exchanges that they've received orders worth over 650 crore from the Karnataka Renewable Energy Development Authority. Remember, the order book at the end of Q2 was 1,300 crores, and the company has announced orders worth almost 1,900 crore just in the last month. So positive news flow coming in for these names.
Oh, thanks a lot for that, Vivek. And Shakti, yes, that one's really showing some strength, up close to around 5% as we speak. But the frontline names, there are a few stocks that are really bouncing back. Reliance Industries is one that we pointed out even last week. We said if the bulls need to fight back, then Reliance needs to defend that 200 DMA. It's done it quite well, and it's moving now with some strength. Let's see whether or not it can get to the recent peak. And Asian Paints as well is the worst in the price. Is that under ownership theme going to play out here? That one as well at the day's high. Amrish Palika, independent market expert, joins us on the show. Hi, Amrish. Let's talk about Asian Paints first up. You think it'll paint a greener color this year? It's set to give up its underperformance, or would you stay away? There's too much of uncertainty.
No, not at all. In fact, I've been a buyer in Asian Paints for a while. And I think what's going in favor of Asian Paints right now is 2025, we saw a major underperformance from Asian Paints because of the possible competition. And now we are seeing that the competition is not really eating much into Asian Paints market share. So that's one positive. And number two, as far as the major input is concerned, that depends on oil. And with whatever has happened in Venezuela, I think should keep the oil prices more or less stable. So I think that's the other positive which is there for Asian Paints. So I think 2026, we should see Asian Paints outperforming. I'll not be surprised if we see levels of about 3,400 plus.
Got it. All right.
Right. Amrish, run us through your pick of the day, which is Canes, I believe, right?
Yeah.
Again, a stock which has quoted some controversy recently.
Right.
What's the call?
That's a contrarian call again on Canes. It's an integrated electronics manufacturing company, and they supply to multiple industry verticals such as automotive, aerospace and defense, industrial, railways, medical, and IT IoT. And they have around 500 plus customers, including MNCs across 30 countries, and diversified into OSAT, which means outsourced semiconductor assembly and test. And the pilot plant is already operational. They have about 22 advanced manufacturing and design facilities. 3 of them are overseas. And the customer concentration risk is also decently low. And like you rightly said, the stock had corrected well post the recent research report, questioning its accounting policies as well as related party transactions. Post that, we've seen a major correction, but I expect the management to give clarity during the Q3 earnings call. On the positive side, I would say recently they have signed a definitive agreement with the SEAL for a JV for sovereign Indian post-quantum semiconductor. So this, I think, is positive. In Q2, EBITDA margins had increased to about 16.3% due to richer product mix and higher value add. And the order book position also is quite robust at about 8,099 crores last quarter. So I'm expecting an EPS of for FY28 of 165. So the target price is about 5,000.
Okay. All right. Got that. Amrish, request you to stay with us. You're positive on Canes. You've been a buyer at Asian Paints. We'll discuss more stocks with Amrish for the time being. We'll take a short break. More market talk lined up on the other side.
111 points and counting, 25,800 for the Nifty, and it's the IT stocks which have done well so far. TCS is in focus ahead of earnings, as is HCL Tech. In fact, Rima's moved to the TCS headquarters to tell us what the street is expecting this time around. Rima, stock's seen a massive recovery from the lows, just the way the market has. All right, we'll just try and go across to Rima in just a bit. Meanwhile, I remember Rahul at the start of the show was saying that he likes Reliance and he likes Bharti Airtel, two of the stock picks that he had given. And Bharti Airtel, as on Q, has moved higher. It's currently about 1% higher. And we're also seeing some traction on Jindal Stainless. So the metal stocks which have been doing well, but broader market, Jindal Stainless is one which has spiked. GAIL is the other one which too has moved higher. Meanwhile, we do have Amrish Balika joining us as well. Amrish, in a market like this, which has been fairly volatile and grossly oversold until noon today, was there any idea that you liked and you picked?
In fact, the one which I just suggested, Keynes Technology, that's one stock which I've been positive on, especially after the sort of a correction which I've seen. I think most of the bad news is already priced in. And possibly once we have clarification from the management post the earnings, I think we should see the upward movement in that stock.
Lemon Tree after the deal that was made?
Lemon Tree, I think this deal is quite positive for the company because clearly it is going towards being asset light, and this would really help in that form. So I think we should see an upside from here, maybe of about 15 to 18% again over the next 6 to 8 months.
15 to 18% over the next 6 to 8 months. What about BSE and GMR Power? BSE is zooming now up around 5%, and GMR Power, when we started the show, it was about 6% higher. Now it's moved about 9%. So there is some traction. Do you have a view on either of them?
BSE, I think it's a rub off one, whatever clarification has come now. And number two, because of the possible NSE IPO. And generally, whenever such large IPOs are in the offing, the stocks in the same sector do really see a decent move. And there are basically just two stocks in this, MCX and BSE. So I think both of them should see some more upside from here. Assuming that the markets hold on, then we should see a decent upside from there.
All right, we take that point. Thank you so much, Amrish, for joining in. What we'll do is we'll take your leave. Actually, don't go anywhere, though. 3:30 onwards at Markets Forward, we will hear Amrish's view on a whole host of stocks. Let's go back to Rima now. Rima, TCS, ahead of numbers, the stocks moved to the high point of trade. What's the street working with?
So let me start with TCS, where we're expecting a fairly lackluster, muted sort of a quarter. Constant currency revenue growth seen up 0.3%, 0.5%, margins flat at 25.2%, a modest 5-6% increase in the company's profitability, the bottom line, PAT. But what the street will watch is the body language, because the company's aspiration is to become the world's largest AI-led technology services, and they're backing it. They've made investments in data center, they've been aggressive in terms of the acquisitions, and for the first time in the December analyst meet, the company even quantified the AI revenues, $1.5 billion, growing faster than the company average, and accounting for 5% of the overall top line. So that's one. Secondly, will the company be able to achieve its guidance of FY26 international revenues being higher than last year? Ambit thinks it's going to be a bit challenging. And thirdly, will there be any exceptional items, one-time hit to the company's profitability on account of the $194 million payout due to the IP infringement case or the employee restructuring? Now, when it comes to HCL Tech, we're actually expecting a very strong quarter. Dollar revenue growth is seen up constant at 2.7%, constant currency revenue growth closer to 3%. But generally, Q3 is a stronger quarter for HCL Tech on account of its products business, where seasonally the company does well, and it's also higher margins. So margins are going to inch up for the company to 18.3%, and this is despite a wage hike impact, which could hurt the margins at 70 to 80 basis points. Now, with respect to the overall guidance, now HCL Tech has guided for 3 to 5%, but analysts believe the company may narrow it, which means raise the lower end. So maybe 3.5 to 5% or 4 to 5%. Margins will remain unchanged. Two parts to watch. One, the ramp up of the AI revenues. In Q2, they had about $100 million of advanced AI. What does that number stand at? And two, again, any employee restructuring related costs that the company will undertake.
Okay, all right, Rima, thanks a lot for that. The stock clearly excited, getting into the numbers. Let's see whether or not they deliver what the street is sniffing. But the markets, it was what a volatile day. We recovered closer on 300 points from the lows of the day. Fired up by Sergio Gore's comments that potentially there could be a deal in the works. It may not be announced soon, but at least giving some hope. What did well? Metals and metal-related names. Coal India, Tata Steel, both of them bursting away. 2.5 to 3.5% higher. Under-owned Asian Paints. Is it going to paint a better color this year? Well, that stock was up 2.5%. From the Ferris back, Hindalco as well did bounce back. And Trent, after getting hammered out of shape and down close to around 50% or half of what it was at its peak, that as well ended in the green. TCS comes out with its numbers. Infosys was under the weather. That was down close to 100%. And big boy Reliance Industries as well technically did protect some lower levels. From the broader market, stocks that did well were JTL, Autowin coming in there. IFCI potentially having some stake in NSE. That stock was up. The silver ETFs did well because silver hit a fresh all-time high. And copper as well hit an all-time high. So you had Hindustan Copper as well that did do well. ADA reacting to its numbers was up close to around 4%. And Hindustan Zinc participating in the big uptick that we saw, Mangla.
All those stocks did well, Nigel. The Nifty Bank was the star of the show, up nearly 700 points from the lows, along with the Nifty as well. But one pack that really stood out in terms of a decline was the real estate pack, because Signature's warning on the guidance, on not meeting their guidance, took not only Signature Global lower by about 6.5%, but all the other realty stocks, be it something like an Oberoi Realty, or if you look at Prestige Estates, or Godrej Properties, or Lodha Developers, all of them were notable underperformers in today's trading session. By and large, the Midcap index ended with a flattish sort of move, with more stocks declining than the number of stocks which were advancing. But it was a lot better than the picture that the market showed at noon. With that, we'll wrap up on this edition of Closing Bell. You don't go anywhere. Markets Forward comes up next.
Market stage, a smart intraday recovery. All major indices rebounded more than 1% from the day's lows, with the Nifty closing above 25,750. Nearly 40 Nifty stocks ended the day in green.
Lemon Tree Hotels unveils a restructuring plan. It will separate its asset-light management business from its hotel ownership portfolio. PE giant Warburg Pincus to invest 960 crores for 4% stake in Flora Hotels, an arm of Lemon Hotels.
Sergio Gore takes charge as the US ambassador to India, says the next call on trade talks will take place as early as tomorrow, terms India an essential partner. Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear up for the next trading day. I'm Ritu Singh, and joining me from the Mumbai newsroom, studio is my colleague Ekta Batra. Hi Ekta, what a day it's been, starting from the kind of lows that we saw and then the Sergio-led surge in the markets.
Hi, Ritu. Yes, absolutely. It was, a fantastic day for the markets. What a recovery we did see post that speech which came in from Sergio Gore about the India-US relations. So we did have the market, so we did have the Nifty recover to a gain of around 106 points. Remember that we were 300 points off the day's low in today's trading session. Overall, we did have the mid-caps which lagged a little bit, but they did catch up by the close of trade. But overall, we had the Nifty, the Sensex and the Bank Nifty, which ended in the green quite smartly. But let's tell you what we have lined up and in store for you today with the top movers and shakers. We're going to start the show with that. Vivek will be here to tell us more on that. We'll get you details of the Lemon Tree Hotels restructuring plans, export data of CDMO players, and a slew of news-based stock reactions. But that's not the least. We will delve into the key market events to watch out for in tomorrow's trading session as well. Well, it was a great day for the markets, and we did have a lot of stocks which are moving in today's trading session, especially post-noon. We have Vivek joining in from the Big Wall to tell us about all the top movers and shakers today. Vivek.
Well, thank you so much for that. What an intraday recovery that we saw, after seeing a significant deterioration as far as the advanced decline ratio was concerned. Post those comments, you actually saw a very sharp improvement. Ended the day sharply higher with a sharp recovery across all of the key indices. In terms of individual stocks, what is it that we are tracking? Well, from the broader end of the markets, IFCI, after a while, this particular stock on very strong volumes up over 15%. Coal India has been in focus, has been an outperformer in the last few trading weeks, and this on the back of the fact that a few of its subsidiaries, one already has an IPO underway, and a few other subsidiaries too are going the IPO route, leading to value unlocking. Manappuram Finance, a very sharp fall that the company saw, or the stock saw on Friday, post the management commentary and clarification. This particular stock recovered quite smartly today, almost 3% higher. BSE, it has been a significant overhang, the fact that there could be some amount of curbs as far as expiry trading is concerned, but the SEBI chief's commentary is something that assuaged investor concerns among the top mid-cap gainer today and saw a spurt, especially in the last half hour of the session. Premier Energies, one particular name from the solar PV module as well as cell space. Remember, over the weekend, you did get news coming in from China that said that they are going to go ahead and cancel value-added tax export rebates. Premier Energy, with certain amount of export exposure, one of the key beneficiaries from that particular move. On the other hand, quite a few laggards, weak commentary coming in from a Delhi-based or North India-based real estate player, led to quite a bit of a sell-off across most of the realty names, Godrej Properties, Prestige, GLF, all of them under pressure today. Capital goods stocks, significant selling pressure. Quite a few of these names have witnessed de-rating. Look at names like BHEL, GVT, and D, Siemens Energy. Most of the capital goods names are under significant pressure today. And lastly, Tejas Networks, a very muted Q3, and that particular stock too saw quite a bit of a sell-off.
All right, Vivek, thanks very much for taking us through that exhaustive list. But one share in focus has been Lemon Tree Hotels that rallied after unveiling a restructuring plan to unlock value and to raise capital. And this also includes the creation of two separate entities and the induction of Warburg Pincus as a strategic investor. Mangla Malu joins us now with more details on this deal that has transpired that we told you about on CNBC TV 18 first. Mangla?
Well, the company has done three things. One, it's announced a restructuring, a value unlocking and fundraising, all of them together. So what Lemon Tree has basically essentially decided to do is that own two companies, by and large listed companies. One of them will be Lemon Tree, which will be a pure play asset light model, which will earn management fees and earn money from the brand platform. The second one will be Fleur Hotels, which will be a hotel ownership platform with development capabilities. Currently, Lemon Tree holds about 58% stake in Fleur, and the rest is owned by APG. Warburg will go ahead and buy APG's stake and will have the option to further invest 960 crores in multiple tranches basis when the need arises. The scheme is a three-way scheme of arrangement. One, Lemon Tree will merge two of its wholly owned subsidiaries with itself. Point two, Lemon Tree will give 4 of its subsidiaries to Fleur, in return for which it will get Fleur shares. And the third part is where Lemon Tree will transfer 12 hotels, including the ones which are under construction, to Fleur Hotels, in lieu of which Lemon Tree shareholders directly will get Fleur shares. So what this basically does is gives you two companies. One is Lemon Tree, which will have up to 170 crores of revenues and 70% plus EBITDA margins, a debt-free, high ROCE business. And the other one will be Fleur, which will have access to over 4,000 hotel keys and roughly 41 hotels rather, and 1,189 crore revenue with 43% margins. So there'll be two distinct companies which will be listed in the next 12 to 15 months. More importantly, once this happens, the board for Lemon Tree will also meet to announce a dividend policy which will continue to reward shareholders.
Okay, all right, Mangalab, thanks very much for that. Speaking to CNBC TV 18, in fact, Vishal Mahadevia, the Asia head of Warburg Pincus, has said that the company wants to cater to every Indian consumer who aspires to buy premium products with good value.
I think there will be two distinct entities because two have very different capital needs. And really someone with our capital and the scale of our capital should be in the asset-heavy entity to help them continue to grow where capital is required and us to come in. And there is a asset-light business at Lemon Tree that will continue. And both will really continue to thrive side by side as they become public companies in India.
All right. On that note, let's go across to our guests who are standing by. We have Ambrish Baliga, who's an independent market expert, and we also have Jay Thakkar, who is the head of derivative and quant research at ICICI Securities. Gentlemen, thanks very much for joining us here. Ambrish, to begin with, any view on Lemon Tree Hotels and this deal, and what kind of opportunity you see here going ahead?
No, I think this deal is quite positive for the Lemon Tree shareholders because finally you'll have two entities. Typically, the hospitality companies with an asset-light model normally get a much better valuation. So, that's one positive. And number two, the asset-heavy entity clearly has strategic investors with deep pockets, which is what is required. So I think overall it should be positive for the shareholders. And like I was saying sometime earlier in the earlier show, I think the upside could be either 15 to 18% from here.
Okay, all right. We do have Nagraj Shetty joining into this conversation. Nagraj, have you looked at the technicals of Lemon Tree and what would you assume the charts would do now?
Hi, Ekta, good afternoon. Yes, rightly said, we have seen some bounce back. The chart pattern is not that convincing at this point of time, though it has bounced back from the lows of around 145, 147 levels. There is a strong resistance placed around 160, 162 levels. Bounce back till 160, 162 is likely. After that, we could see the stock prices coming down towards 150, 155 levels in the near term.
Well, Nagraj, very quickly, just a view on, how you train the indices going forward. I mean, with the kind of sentimental up move we saw in the second half of the trade today, how do you expect that to hold up, say, your targets for the near term?
Yes, the way market has recovered from the lows of around 25,500 after a sharp decline is indicating a formation of important bottom reversal, at least for the short term. We have seen some sharp decline from the new all-time highs, and the way the market recovered, I'm expecting we could see some similar kind of upside on the higher levels in the near term. So 26,000 is going to be the immediate resistance for now, and I'm expecting this resistance to be taken out, and 26,200 to 300 is going to be the next target once the 26,000 takes away on the upper side.
Okay, all right. Well, let's move on to the other big story we're tracking. The Indian government is considering scrapping restrictions that bar Chinese companies from bidding for government contracts, according to a Reuters report. However, sources say no final decision has been taken. Vinny joins in with details. Vinny, which Indian companies do you think could be impacted if in case the restrictions are done away with?
Hi, thank you so much for that. Yes, so firstly, let's just take a flashback in terms of what happened last week and why these stocks had fallen. Now, according to a Reuters story that came in, that Finance Ministry was planning to scrap the 5-year-old restrictions that were there on Chinese firms. These restrictions came into place in 2020 on some of the power, railway and other sensitive government contracts. Then, obviously, CNBC confirmed with some government sources as well. They said that no decision was made as yet. But before that, the stocks were beaten down already. And then, despite this notification coming in or the clarification from sources that came in that, there's no decision yet taken on this front, still the stocks were falling. Even today, we saw the stocks falling in trade. Now, Renu Baer, the firefighter, what did she say? She said that no government notification is there as of now, even till date, in terms of lifting these restrictions. Channel checks are suggesting that TBEA, which is a big Chinese company, they have been approved maybe for participating in high voltage reactors. So only a specific product, maybe where they can start participating in these government contracts. She also highlighted that, even if this comes through and TBEA is there and participating in this contract, she's not expecting a lot of impact in terms of the performances of our Indian companies. So not much of a worry. She doesn't expect much of a change or fluctuation in terms of pricing as well, at least in the near term. Now, apart from that, what we also had is a lot of other brokerages wrote about this. They said that the relaxation may be more segment-based with prior requirements, part that they want to participate in a government contract by these Chinese firms. It's not going to be a blanket rule that the restriction is lifted for all Chinese firms or even across the board in terms of transformers or in terms of reactors, not across a blanket rule. So maybe negative impact could come in for something like an L&T, BHEL, GE, Vernova, TND, Hitachi Energy, Siemens Energy, and that is why we've seen a bit of a fall coming in these stocks in the last 3 trading sessions. But that is something that we'll be keeping an eye out on, whether this actually comes in terms of any notification.
Okay, all right, Vinny, thanks very much for that. Maybe we can just get a quick comment in from Ambrish about these capital goods stocks. And Ambrish, how would you approach the likes of L&T, BHEL? Do you think that it's going to be factored into earnings soon enough?
No, I mean, the way I see it is it should be an opportunity because, again, the reason these stocks are falling is because investors are assuming that there can't be any smoke without fire. So something could be brewing. But like you're just discussing, I think it could be just be a very narrow window for these Chinese companies, may not be across the board. So I believe that it should not really affect the sector too much. And in case we see a further correction from here, maybe another 5-10%, I think that's a buying opportunity.
Okay, all right. So that's on all of these capital goods stocks. But one space that I've been watching is Divi's Labs and Loris Labs and a lot of these CDMO companies. They did release data for exports. Now, the Q-on-Q export data for Q3 of FY26 looked a little weak, or it didn't really mention Loris Labs as well as Divi's Labs. So Concord Biotech, for example, was up 25% on a Q-on-Q basis. Piramal Pharma up 11%. Blue Jet Healthcare was up around 5% Year on year, Blue Jet was down around 19% in terms of exports when it comes to CDMO. Piramal was down 15%. Loris Labs was up 41%, so strong growth there. Gland Pharma was up around 24%, and Concord Biotech was down 27% in terms of export was up 27% in terms of export data. Now, 9-month FY26, Loris Labs looked good again, so it was up 71%. Divi's Labs and Blue Jet, their export data was strong at around 15% Concord Biotech was flattish. So December 2025 overall, however, witnessed a mixed performance. Divi's saw a good rebound. It was up 55%. The likes of Gland was higher. Newlin Labs also gained, and Piramal Pharma was also higher. So overall, I think the street was a little worried about the Q-on-Q export data, which looked maybe a little sluggish for the likes of a couple of these companies, whereas it looked good for the likes of Concord Biotech, Piramal Pharma, and Blue Jet Healthcare. But nonetheless, wanted your thoughts, Ambrish, on a couple of these CDMO companies, because Q3 is expected to be a little challenging for them. in terms of earnings simply because of the lack of innovation spend in the US. What's your sense?
No, I don't think there should be an issue longer term. I think just 1 or 2 quarters, there could be a bit of an issue. And in case we see correction, then should be a buying opportunity. But something like a Laurus Lab, which, where we've seen a very good move in the last 6 months to a year, I think it's a good time to at least book some profits and possibly buy into stocks like Divi's or Gland, where Gland Pharma I still see at least in the 400, 500 rupee further move from here.
Well, Nagraj, any view on these IT companies? We're going to see them report numbers soon. TCS is one, HCL Tech later, and then later in the week, Infosys.
Yeah, I think chartically, all the three stocks are placed very well at the lower levels. We have seen some moderate downward correction in the TCS from near the hurdle of 200-day EMA, somewhere around 3,300. I think nothing has changed significantly over the last couple of weeks, placed at the consolidation mode. And I'm expecting further upside from here on out. Chartically, the overall trend of these stocks are looking positive, and I'm expecting more upside in the near term.
All right, that's a sector we'll keep an eye out on. But stocks such as Manappuram Finance and Shakti Pumps were also buzzing in trade today on the back of some stock-specific news flow that came in. Vivek Iyer is joining us now to break down what's driving the action in these counters. Vivek.
Well, that's right. We've taken 3 stocks on the radar today, stocks that are buzzing on the back of news flow. Some relief coming in. First on the list is BSE, quite a sharp up move. Important comments coming in from SEBI chairman where they said that no action or no change in derivatives market, at least for the time being. And along with that, some positive commentary coming in terms of the NSE IPO, giving a sentiment positive as well. The other stock on the radar is Manappuram. The company has gone ahead and denied the report of another agency that said that RBI has raised concerns with respect to the Bain Capital deal. They say the report has been denied, factually incorrect, as well as speculative in nature. And the last stock on the radar is Shakti Pumps. The company went ahead and told the exchanges that they've received orders worth over 650 crore from the Karnataka Renewable Energy Development Authority. Remember, the order book at the end of Q2 was 1,300 crores, and the company has announced orders worth almost 1,900 crore just in the last month. So positive news flow coming in for these names.
Okay, all right, Vivek. Thanks very much for that. So lots of stocks buzzing around in what was a good session for us by the close of trade. Ambrish as well as Nagraj, thank you very much for joining in and taking us through all of your opinion for today's trading session. We're going to take a short break, but up next we'll get you all of the top corporate voices along with key market events to watch out for. Stay tuned.
Welcome back. TCS Q3 numbers breaking for you on the screen. On the bottom line, the company has delivered 10,657 crore. That is a decline of 11.5%, almost 12% on a quarter-on-quarter basis, coming in lower than street expectations. But here, the miss appears to be on the back of an exceptional one-time loss. There are three key, just prima facie, it looks like an exceptional loss of nearly 3,400 crore rupees, which is courtesy one, restructuring expenses of 253 crore. I can see a statutory impact of the new labor codes of about 2,100 crore. And finally, there was a provision towards a legal claim. Perhaps this is to do with an IP infringement case, and that has impacted the bottom line by nearly 1,000 crore rupees. So there is an exceptional item which appears to have dented the company's bottom line. On the revenue, revenues of the company have gone up by 2% on a sequential basis. That seems to be slightly ahead of street expectations. Bottom line, lower, declining 12% on a sequential basis, but there is an exceptional impact. The company has said there are three key reasons. A small one is a restructuring expense of about 253 crore. Statutory impact of the new labor codes is a big one, 2,100 crore, and a provision towards a legal claim. Even in the last quarter, there was an exceptional loss of 1,135 crore, and that was on account of restructuring of the employees. Remember, TCS about 6 months back had announced that they're letting go of a few employees, and that had resulted in the restructuring loss in the previous quarter, and this time it's the new labor code. We have with us Sandeep now joining in. Sandeep, you want to quickly comment on this exceptional? Will it take the street by surprise?
No, I think, this was known that, because of this new labor code, many of the companies in IT and bank will have some kind of provision, which will have an impact of one time and also a recurring piece. So I don't think this is a negative surprise. I think at the EBIT level, the company has delivered broadly in line with estimate, and even on the revenue terms, as far as we can see the rupee revenue, it is broadly in line. So we need to see the dollar and constant currency numbers, number one, and number two, the deal wins. So these two numbers probably will be very important. And also if they can, they are going to declare anything on the AI revenues. I think that is going to be critical.
Okay, on expected lines, the legal claim is on account of the IP infringement case, which is related to Computer Sciences Corporation, CSC. This was also a known that the street, that the company is likely to take an exceptional one-time hit at the bottom line. That the company has accounted for about 1,000 crore. The EBIT margins have come bang in line with street expectations at 25.2%, unchanged on a sequential basis. We still don't have the constant currency revenue growth, but it's likely to be a fairly muted quarter. In the prior quarter, the company's top line had gone up by 0.8%, and currently consensus expectations are for a growth of about 0.3, 0.5%. So it's going to be a slow quarter on the back of seasonality. But as we begin, Sandeep, 2026, the geopolitical noise has gone up so much, whether it's to do with Venezuela, whether it's to do with Greenland. So the question is that with this kind of geopolitical headlines that we're dealing with every single day, January, February is the time when clients typically set their budgets for the full year. Now with so much uncertainty looming, do you think discretionary spending further takes a hit?
No, so I think, it is the beginning of the year, and generally, it is just a few days of the month. And many of the clients would not have finalized their budgets, or even if finalized, they would not have communicated to the company. So I don't think any company will be able to give a clear guidance on how much client is going to spend. But broadly, because of AI and reduction in efforts, I don't see a big jump in budgets will be there for any of the software service providers this year. That broadly is, I think a known fact. So I would not be expecting a big positive commentary on that side. This year CY26 will be broadly, flattish kind of year, maybe 2-3% growth here and there. That's it.
Okay. The company's total contract value stands at $9.3 billion. This compares with $10 billion on a quarter-on-quarter basis. The company's sequential revenue growth in Q3 is at 0.8% on a quarter-on-quarter basis, same as the September quarter and ahead of street expectations. K. Krithivasan, the CEO of the company, reads in his statement, the growth momentum we witnessed in Q2 continued in Q3. We remain steadfast in our ambition to become the world's largest AI-led services company, guided by our 5-pillar strategy. AI services now generate $1.8 billion in annualized revenue. Now, this, as of the last quarter, was at $1.5 billion. In December, when the company held an analyst meet, they had quantified the AI revenues for the first time, and they had said that AI revenues, this was as per what they shared in December, was $1.5 billion. Now, that has accelerated to $1.8 billion. So that is the key headline. So some numbers important: constant currency revenue growth of 0.8% sequentially, ahead of the CNBC TV 18 poll of 0.5%. EBIT margins 25.2%, unchanged sequentially, but the company has absorbed the wage hike. Wage hike for TCS this time was pushed forward to December. So in the current quarter, the company has taken a 2-month impact of the wage hike. They've absorbed it and managed to maintain margins on expected lines. The AI-led revenue on an annualized basis, not on a quarter-on-quarter basis, but on an annualized basis, stands at $1.8 billion, and that is up 17.3% in constant currency terms. So it's growing much faster than the company average, which is 0.8%. That also brings you to the question that maybe the core services revenue, X of AI, perhaps is degrowing, because this AI revenue is growing at 17.3%, but the balance is just up 0.3%. And the company says that the momentum they saw in Q2 has extended into Q3. The other one important number that we want to just check is the headcount, because last time, on the back of the natural attrition and the restructuring of employees, their headcount had declined by nearly 20,000 on a quarter-on-quarter basis. We have with us Anshul also joining in. Anshul, you want to comment on Q3? What was your big takeaway? And when we speak to the management, what should be top of mind?
Yeah, so the results have been, in line with the expectations. I think the street has already factored in that Q3, as it is, it's a seasonally soft quarter for IT industry as a whole, all on account of furloughs, leaves, lower utilizations. So the revenue, I think, sequentially 0.8%, it is a bit flat. And so we can say that from a big uptick in this quarter, I think, can be annualized AI services revenue has been, at almost $1.8 billion right now. That's a uptick of almost 17.3% sequentially, largely pivoting the Indian IT space from a pure labor perspective to pivoting towards more AI generating products and strategies. So that is a big uptick. Rest, I think, total contract value, I think it's about 9.3 billion, sequentially a little less. Last quarter, they clocked in around about $10 billion. So the demand uptick, I think, has not yet taken recovery, still to come. But the total contract value momentum is still strong.
Is there an investable case in TCS based on the numbers, Anshul?
Sorry, didn't get you. Hello?
I mean, based on the numbers. Hello, can you hear us, Anshul? I'm saying based on the numbers, should one invest in TCS?
Yeah. TCS, I think it has been a cash cow. The whole IT industry, the tier 1 players, I think they have been a cash cow, playing on a conservative strategy year-on-year basis. And now, finally, from last quarter, they took a big pivot towards AI, releasing their strategy towards AI data centers, investing around about $7 billion in the coming 5 to 7 years. They have their company Hypervault has tied up with TPG as well. I think many more exciting surprises to come from TCS. One can surely invest in TCS.
Okay. Just some sectoral color. BFSI has seen a decline this time of 0.4% on a sequential basis. BFSI last quarter was up 1.1%, so that has seen a bit of a decline. And the other pocket where there is a revenue degrowth is technology and services, which is basically all of your hyperscaler kind of companies come in this bracket, and that has seen a drop of 1.3%. The other markets have seen a modest growth. India continues to be a big driver. India, as a percentage of the overall revenues for TCS, is close to about 10%. And this quarter, India revenues are up 8% on a sequential basis. Though we still don't know too much about the BSNL phase 2 order, which is expected. Sandeep, on AI, if AI is going up 17.3% on a quarter-on-quarter basis, I mean, that's a pretty good number, right? I know as an overall percentage, it's still in single digits of its overall revenues. But what would you make of this number, AI, and what does it tell you about the balance business?
So see, there are two challenges structurally which has happened in the large cap. One is that, now every company of any size, because of the quick execution cycle which has happened, the companies which were never allowed to participate in large deals, everyone is now participating. So the win to right of large companies has gone away to large extent. So that is a big challenge which companies are facing. Second, all these contracts are for 5 to 7 years. So by the time, this AI becomes material number, that time another disruption comes and it again goes into the same log of 5 to 7 years. We saw this challenge in digital also, because digital, it started from 10-15% exposure for Indian IT. By the time it reached 80-85%, AI came in. And again, now digital is looking like, traditional IT services. So this is the challenge which we are facing. It is not a one-time disruption because of the way the contracts are, structured. It takes 5-6 years for the revenue to decline. And again, 5-6 years for a new technology to come and contribute meaningfully. So that is the reason the large companies in the sector entered a low growth phase structurally, in my opinion.
Gentlemen, Sandeep and Anshul, thank you very much for joining in. So that is TCS numbers for you. Operationally, it's a pretty decent set of numbers, considering that Q3 is a weak quarter seasonally. There are shutdowns which take place, furloughs. Despite that, the company has seen a top-line growth of 0.8% on a quarter-on-quarter basis. They've maintained their margins at 25.2%, but there are exceptional items in excess of 3,000 crore rupees which have impacted the company's bottom line, and chunk of it is to do with the new labor code. The new labor code has resulted in an increase in the gratuity expenses. There is an increase in the wage bill for their employees. So that's the reason why the bottom line is seeing a decline of 12% on a sequential basis. So the company's pivot towards AI is, continues with very strong momentum. AI-led revenues up 17% sequentially and now at $1.8 billion in terms of annualized revenues. We will take your leave. We will, try and get you more on TCS and get in touch with the management.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The Sensex and the Nifty recover sharply after an early decline, gain over 1% from the day's low point, but mid-caps remain under pressure. The rupee ends flat but above the 90 mark against the dollar.
Both sides continue to actively engage. In fact, the next call on trade will occur tomorrow.
Sergio takes charge as the U.S. ambassador to India, says the next call on trade will take place tomorrow, terms India an essential partner for the United States. Earnings season kicks off. TCS meets estimates in Q3. Rupee revenue up 3%, margin steady at over 25%, but profits take a hit of over 3,000 crore rupees due to the new labour code and legal expenses, all falling under the exceptional items. The U.S. Justice Department launches a criminal investigation against Fed Chair Jerome Powell over renovation of the central bank's headquarters. Powell calls the probe unprecedented and a consequence of refusing to cut interest rates quickly despite pressure from President Trump. Powell asserts he will not bow to intimidation. More than 500 people killed as protests intensify in Iran. U.S. President Trump says he's considering very strong military options. Iran's president says the situation is under total control and claims more than 100 security personnel have been killed. President Trump also wants Cuba to make a deal or face consequences, says oil and money from Venezuela to Cuba will be cut off. Trump also threatens to block oil giant ExxonMobil from Venezuela after its CEO called the country uninvestable. Shares of Lemon Tree Hotels rise after Warburg Pincus invests 960 crore rupees into a subsidiary. Lemon Tree also announces a corporate restructuring to unlock value. Warburg's Vishal Mahadevia says affordability and import substitution will be the key focus areas for Warburg in India. Real estate stocks continue to struggle amidst concerns over a demand slowdown. Sales in the Delhi NCR down 9% in 2025. Growth in Mumbai is just 1%. The Nifty Real Estate Index is down 18% from its 52-week high. Electronic and IT Ministry denies reports of the government proposing to force smartphone makers like Apple and Samsung to share their source code. The centre says structured consultations are taking place to develop a robust framework for mobile security. Reliance Industries says battery manufacturing plans are on track, denies a Bloomberg report that claimed that plans have been put on hold. Reliance categorically affirms the plans are progressing well with the target timelines in place. President Trump proposes to limit the interest rate on credit cards at 10% for a year. The decision will need to be ratified by the U.S. Congress. Banks oppose the move, saying it will devastate the poor by reducing the availability of financing. Well, there's plenty of data to contend with. Let's go straight to the big macro data of the month. India's retail inflation inching up to 1.3% in December, remains below the RBI's target range of 2 to 6% for the fourth consecutive month. Lata's here to take us through the inflation analysis. Lata.
Well, it is a lower than expected number. The CNBC TV 18 poll threw up an expectation of 1.6% inflation. It's come in at 1.33. Likewise, the food inflation number, which our poll said would be minus 1.7, has come in at minus 2.7. So clearly, strong deflation in food continues. The core inflation calculated number has come in at 4.6, largely in line with our poll expectation. The important point to note is that the inflation number, the headline that is at 1.33, is below the Reserve Bank's mandate for the sixth consecutive month. Was expected to be. It's a little weaker than expected. As well, if you only took October, November, December, the RBI's earlier forecast was an average of 0.8. Well, the average now that we have the December number works out to 0.76. So lower than the very low number forecast by the Reserve Bank. The food inflation number at minus 2.7 is abated by food falling on practically all major categories, both month on month and even year on year. Month on month, cereals, fruit, vegetables, pulses, sugar are all down. And year on year, there is some seminal fall in vegetable, fruit and pulses prices, all heavyweights in the food index. Likewise, sugar and spice also down. The important point is housing is also down month on month. From November to December, we are seeing a fall in housing numbers. Though, of course, year on year, it is a minor increase of about 2.7. Again, that's a heavyweight in the index. Only the 4.6% core inflation is boosted by the personal services category, which is up by 6%. Now, that includes gold, and that's why you have such a high number of 6%. X of gold, the core inflation falls to below 3%. So it's really a very weak number. In fact, for the 6th consecutive month, a number below 2% is flagging in some areas a fear of demand deflation, a fear that there is not enough demand in the system. But a large part of the economists will simply put it to a very high base effect. The analysis of this number is to some extent just historical, because this is the last month for which you have CPI data from the old series, where the base year was 2012-13. From February 12th, when we will get the Jan 2026 number, the base year changes to 2023. So it will be a new series, not comparable, though the MOSPI will give us 1 year's previous number. So we can compare it to last year, but we can't really get a historical comparison. It will take a long time for the history to give us, for the MOSPI to give us a time series. So to some extent, this is a bit of a historical number, will not really impact the Reserve Bank's monetary policy on Feb 6th, which of course will entirely concentrate on the February 1st budget, the fiscal deficit, the assumed GDP growth, the assumed tax growth, etc. So this is really of historical import, not much policy import.
All right, Lata, many thanks. The end as far as this particular inflation series is concerned, as Lata pointed out, we will be moving to a new series starting the 12th of February. But let's talk about the market action. Very volatile day. In fact, US Ambassador Sergio Gore's comments on trade talks between India and the US lifted the market intraday. All major indices recovered over 1% from their intraday lows, with the Nifty closing above the 25,790 is where it finally closed, higher by about 0.5%. Similar story playing out for the Sensex. The Nifty Midcap, however, still in the red, closing absolutely flat, 200-point gain there on the Nifty Bank. So a very volatile session, but a recovery intraday on the back of those statements that came in from the US Ambassador to India on his arrival to India. We'll get you that in just a moment. But let's talk about the commodity market. Gold prices crossing the $4,600 level for the first time. Silver jumping to a new record high, no stopping either. This as escalating unrest in Iran and weaker US jobs data boosted demand for safe haven assets. The dollar's retreat from its strongest level in a month also supported the rally across precious metals. The big date. Lok Sabha Speaker's office has now confirmed that the union budget will be presented at 11 a.m. on the 1st of February. Remember, it is a Sunday. The 2026 budget will mark Finance Minister Nirmala Sitharaman's 9th consecutive budget presentation. She already holds a record for the most consecutive union budget speeches. So, 9th budget speech from the Finance Minister on Sunday, the 1st of February. The big global story moving the markets worldwide. The US Justice Department has launched a criminal investigation against the sitting Fed chair, Jerome Powell, over renovation of the central bank's headquarters. In a video address, Powell called the probe unprecedented and a consequence of refusing to cut interest rates as quickly as the Trump administration wanted the Fed to. The Fed chair also asserted he will not bow to intimidation. Powell's tenure ends in May this year, and President Trump is expected to name his successor by the end of this month. President Trump has repeatedly criticized the Fed chair since he returned to the White House for not cutting interest rates sooner. He also sparred with Powell on camera last year over the renovation costs of the Fed headquarters. The central bank is renovating its buildings for the first time since its construction in the 1930s. Here's the Fed chair, Jerome Powell, responding to the DOJ investigation.
No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
Well, that is the Fed Chief Jerome Powell, and it's important to note that we've got opposition coming in from the Republican side, the Republican senator saying that he will not nominate a new Fed chief till this matter is resolved. So perhaps the uncertainty over the next Fed chief is likely to continue. Now, the new U.S. ambassador to India, Sergio, took charge at the American embassy in New Delhi today. Addressing a press conference, Gore said the next round of trade talks will take place tomorrow, and he's called India an essential partner. The U.S. ambassador also announced that India will include the U.S.-led Pac Silica initiative, which aims to build a secure silicon supply chain. The announcement pushed stocks of critical mineral companies like GMDC and Nalco higher. Gore also said that apart from the trade deal, both India and the U.S. will continue to work closely on areas like counterterrorism and technology.
The United States and India are bound not just by shared interest, but by a relationship anchored at the highest levels. Real friends can disagree, but always resolve their differences in the end. Last week, our great Secretary of State, Marco Rubio, powerfully stated that this year will be a year of reciprocity. We are raising the standard for diplomacy itself. That means fair trade, mutual respect, and shared security. Many of you have asked me for an update on the ongoing trade deal negotiations. Both sides continue to actively engage. In fact, the next call on trade will occur tomorrow. Remember, India is the world's largest nation, so it's not an easy task to get this across the finish line, but we are determined to get there.
Well, that is the new U.S. ambassador to India, Sergio Gore. We are still ascertaining who those talks are going to be held between. Up next, the CNBC TV 18 Access Special, coming up right after this break. Well, let's go back to the big story. The Sensex is off to the worst start in any year that we've seen in the past decade. Stocks listed on the Bombay Stock Exchange have lost 13 lakh crore rupees in market cap in just the last 9 sessions. However, global investors are not dumping Indian stocks. There's a quiet exit from Wall Street as well. Sriram joins us now with more details. Sriram, what does the data find in terms of fund flows and outflows?
Thank you, Shireen. Those of our viewers who are also Access members, the community that we have, they would remember, a piece written in October titled "Global Risk Appetite is Disappearing Fast." The sum of that article was that the global uncertainty, which was already there, was likely to get worse in the coming weeks, and it has. Smart money is moving out of Wall Street too, not just India. Global investors have redeemed $28 billion from US funds in the last 3 weeks alone, according to EPFR data cited by a report released by Elara Capital today, on Friday. In the first 9 days of this year, since Jan 2nd, US investors, small investors in the US have bought $10 billion worth of US equities via exchange-traded funds mostly. And that's almost twice the $6.5 billion, which was the average for the whole of last 12 months. Which essentially means that small investors in the US are piling onto the stocks, while the smart money, the big investors, are moving out. Now, nearly 30% of the wealth in any US household is tied to equities, according to a Barclays estimate. Now, Shireen, you remember we've been talking about a bubble in the stocks, particularly driven by AI, and all of that, how it may lead to a broader crash, and that has dominated our conversations for an entire year, but the crash hasn't happened yet. And this trend of small investors piling on to make a quick buck just when the big money is moving out is arguably a necessary element for bubbles to burst.
Well, that is, of course, the big question, the bubble, and whether or not we're likely to be on the precipice of any kind of capitulation. But Sriram, the question is, if the money is moving out of the US, where is the money headed?
Mostly into emerging markets, gold, industrial metals, all of which gain from a weaker dollar. Ideally, some of that money betting on a dollar decline should have reached India as well, but it hasn't. The good news is that the redemption pressure on India-focused funds has paused. That is according to the EPFR data. But the fresh money inflow has not picked up. The one word why it hasn't is uncertainty. And it's not just the uncertainty that we have seen around whether there will be a tariff truce between Prime Minister Modi and President Trump. That's just one of the factors. If you look at the 3 engines of economic growth, investments, exports, consumptions, CEOs, policymakers, market experts have all been pointing out to green shoots for a long time now. However, net FDI is 0.1% of GDP now at the end of October. Domestic investments has been slow. Some recovery in the last couple of months, it remains. Global trade itself is slow. So Indian exports aren't going to be immune to it. And then we have tariffs. Consumption has gotten a bit of a bump up from tax cuts, etc. But then again, we've seen these green shoots before, and we don't know if they are going to grow into a tree at all. And I'm going to quote Morgan Stanley's Ruchir Sharma's piece today in the FT. India is still reporting world-beating economic growth, but no longer getting any love for it. It's essentially that, everyone's waiting to see India realize its potential. Now they want to see some evidence. And, beyond the GDP data, the headline number is obviously very exciting, but the details matter just as much.
Well, that they certainly do, Sriram. Many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a moment with more.
Hello and welcome to this special State of the Economy show. I'm Lata Venkatesh. The immediate news that's hit us is the CPI inflation for the month of December. It has inched up to 1.33%. This compares with 1.6% which the CNBC TV 18 poll threw up. The food deflation is the major factor. That's come in at minus 2.7, which is, a trend that we've been seeing for the last 7 months. Negative or rather falling food prices. This compares to a minus 1.7, which is the CNBC TV 18 poll threw up. The CPI data is the last number we are getting before the February 6th RBI policy decision. And therefore, let's decode the numbers with our guests. We are joined by Suwadhi Prakshit, Chief Economist at Kotak Institutional Equities, Aditi Nair, Chief Economist at ICRA, Devang Shah, the Head of Fixed Income at Axis AMC. Also from another mutual fund, Srijit Balasubramanian, the Senior Economist, Fixed Income at Bandhan AMC. Gentlemen and Aditi, thank you very much indeed for joining me. Aditi, the inflation has again surprised a little lower. Our poll threw up 1.6 and there were quite a few people between 1.6 to 1.7. So should we expect further falls in the coming months too?
Thanks, Lata. Actually, we are not that surprised. Our number had come in at 1.4%. That's where our forecast was. So it's only marginally lower than what we had expected. And I think now the food deflation trend should slowly be easing off. And we are expecting the next print to be somewhere above 2%. So at least it'll come back to within the 2 to 6% range of the MPC. And then gradually continue its upward trend. Of course, all these forecasts are based on the current series, and we'll be moving to the new series very soon.
Oh, yes. I immediately after asking you, I realized it was an unfair question because the Reserve Bank's forecast of Jan, Feb, March is for the old series, and we do not know what the new series will hold. Suwadip, anything surprising in the numbers? Is food inflation lower than you thought? And do you think that we will be in for a lower surprise if the old series continues?
Sorry.
Okay,
I think the first point to note is that if you look at the high frequency numbers in terms of the food prices, etc., I think it was pointing slightly on the higher side. So we were expecting a slightly higher print on food. However, the actual is much lower. And I think this is a good print to go into the February policy, fully acknowledging the fact that the series will change when the next inflation print comes in. But having said that, the RBI will be going into the policy with this particular number, with this particular series. So from that perspective, I think this is a print which continues to be, from the RBI's policy perspective, it will be taken that the print remains below the lower bound of the inflation target.
Okay. Well, Srijit, welcome to our show. This has it had any impact on the bond market at all? In fact, today we saw the bond yields going down after a long gap. We are seeing a sub 6.6% on the 10-year. How is the bond market likely to react to this number, if at all?
I think the number is definitely favorable. It's lower than what we had expected. So we had, like Sudeep mentioned, we had looked for a slightly higher food number. So our headline number was around 1.7. So this is a positive surprise. But that said, if you look at the internals, it's primarily the vegetables and fruits and cereals that have probably undershot a bit. And again, it's on gold. So it's a favorable number. But I think that's it. Given the move the bond market is and what has been happening of late, I think it will be the BOP and the fiscal dynamics that would really shape the trajectory of the bond market. While incrementally, this is definitely a good reading going into the policy. So it basically, sort of backs our call for lower for longer policy rates. That's definitely there. But I think the incremental dynamics would come from fiscal and BOP. And there we are watching, how, for instance, the flows are headed up. What sort of fiscal numbers we are looking ahead, what are the demand supply dynamics shaping up. So we'd probably be looking at, let's say, the union budget. We'll be not just looking at the fiscal deficit numbers, but also what share of fiscal deficit is getting funded through GSEC borrowings and things like that, and where we are headed in the debt to GDP trajectory. I think incrementally that would probably matter more along with BOP.
Okay. No, I take your point entirely. Not only is this series going to change with a new base year. The February 6 budget, February 6 policy will crucially look at the February 1 budget and the deficit numbers, the nominal GDP forecasts on which the budget rests, the tax growth forecasts on which it rests, the dividend expectations from the Reserve Bank. So, there will be too many variables for the February 6 policy to speak about inflation. Devang, what's niggling the bond market? I mean, there isn't even an expectation of a rate cut. In spite of 5 rate cuts today at 6.6%, the 10-year is higher than what it was a year ago. Is inflation becoming, immaterial to the bond market?
Yeah, Tata, so I think I agree with you largely that somewhere down the line, people are not looking at the near-term prints. Everyone starts looking at it from a central bank perspective. Also, we look at 1 year forward inflation. I think people should start getting worried about the rise in commodity prices. We have seen across, and I'm not talking about precious metals, I'm talking about base metals like copper, aluminum, all of them have started increasing. So the impact of that going ahead on inflation. Secondly, I think, as Srijit highlighted, I think the more important focus for all bond markets investors would be on what's happening in the budget side. The trade deal is not happening. There can be an additional fiscal impulse possible. So that's worrying bond markets today. And the demand supply dynamics is started getting skewed. We have just seen the last couple of weeks back, the announcement on the SDLs for this quarter. It's 5 lakh crores. Now, somewhere down the line, the entire demand supply dynamics for bond markets has been taken care of to a larger extent through open market operations. But because there was a lot of front loading of open market operations, even in this year, we've seen an announcement of 3 lakh crores in the month of December. I think the bond market investors are starting getting worried that possibly we are entering into a phase where there can be a demand supply mismatch, open market operations, the best of the time for the near term quarter is done. And somewhere down the line, the inflation can start inching up. So with a forward looking view, the long bond yields are not actually happy with the lower inflation print.
Wasn't the state bond announcement a little less than what the market expected? I thought that was keeping the markets at least 2 basis points lower in the last few days.
Our assessment was, Lata, that the bond markets expected SDL announcements to be the tune of around 4.5 lakh to 4.7 lakh crores for this quarter. Internally, our view was also about 4.5, 4.6 lakh crores. And the number was slightly on the higher side.
Higher side.
Yeah.
Okay, fair enough. So no joy over there, especially when the SDLs, state loans, are as much sovereign. And they're giving you a good 20, 30 basis points more than central government securities. So clearly, that's keeping the bond yields higher for central government bonds. I'm going to ask the economists an unfair question, perhaps. But you all have been attending all the MOSPI conferences on the new series. So, Aditi, what's the expectation going into the new series? We are going to get only 1 year previous numbers, comparable numbers. The MOSPI will adjust the 2025 numbers for us. Maybe they will only give us the 1 month number. That is Jan versus Jan 2025. But what is the expectation? Will it be higher or lower than expected? Lower than the current series?
So, Lata, what I've understood is we will get 13 CPI index prints and 1 YOY inflation print. So, we will get the full series from January of 2025. I don't think, at least I have not taken away any indication of whether it's going to be higher or lower than the current series. The conference I attended in Delhi, certainly I was not able to take that away, whether we should expect the number to be higher or lower.
Okay. Well, I'm going to ask those questions to the other economists as well. But a mandatory break in order coming back in a jiffy with questions on the new series, as well on whether this worryingly low inflation is indicating any worries of lower demand and therefore a pain in the growth element as well. Back in a minute. Welcome back to the special State of the Economy edition. We just got the December inflation numbers, which have come in lower than the CNBC TV 18 poll. The headline inflation has come in at 1.33% versus the poll number of 1.62%. Of course, both slightly higher than the November inflation of 0.7%. The food inflation number has come in at minus 2.7 compared to the poll number of minus 1.7. So all told, a lower than expected inflation number. I've been speaking with economists Aditi Nair of ICRA, Subhojit Rakshit of Kotak, Srijit Balasubramanian of Bandhan AMC, and Devang Shah of Axis AMC. Gentlemen and Aditi, thank you very much for your patience. Subhadip, before going to the break, I was wondering whether the ultra-low inflation numbers that we have been getting is, giving any doubts about growth. After all, persistent deflation is also a sign of low demand. Any such fears?
Well, yes. I mean, I would not take the deflation part since it's the food prices, and food prices typically has a seasonality to it. It has a base to it. But I think even if you take the core inflation and strip out gold, you would arrive at somewhere around 2.5% odd, anywhere between 2.3, 2.6. Yes. That in itself is low. And it certainly kind of indicates that there is a demand deficit in the economy. That, if you want to corroborate with the nominal GDP growth, that also is relatively low. And I think there is the indication is that there is a certain slack in the economy. Part of it will reverse when, Devang talked about commodity prices starting to move up. So that will move up. But sustainably, if you are seeing 2%, 3% kind of inflation, I take the indication that there is a slack in the economy. And there are certain indicators beyond the near term, certain prints from the high frequency indicators that we track, which shows that the economy is in a mixed bag. It's not all good, it's not all bad, but certainly some slack is visible in the economy.
Okay. Srijit, the other reason why the bond yields probably fell is because of this expectation that on Jan 14th, we could be included in the Bloomberg index. Any talk, is this a major consideration for the bond market?
I think so. If you see the numbers, we are probably looking at 15 to 20 billion worth of flows in a full year. But that would probably be low if you look at the amount of OMOs that the RBI has already done. So 20 billion, if you sort of translates to around 1.8 lakh crore of INR. But the RBI has already done so much of OMO, so that would probably be one of the factors, definitely. But like I said, there are probably bigger aspects related to supply demand, what sort of replacement demand is coming in with the OMOs, etc., which sort of continues to remain a little lackluster. The high credit deposit ratio, which is sort of probably not helping investments on the margin. And even global concerns, like geopolitics, commodity prices that we just discussed. And what's happening with the US growth, and therefore, for instance, the labor market data that we had recently, and the upside surprise on the US growth data. With respect to that, and even the tariff concerns. So I think that would probably be the major factors. But yes, it's marginally one of the factors that we would look at, and it's probably around 15 to 20 billion a year.
Yeah, 15 to 20 billion, at least it takes away the kind of selling, that, at least counters the kind of selling that we are seeing in equities. And I heard a loud buzz about that from 6.63, the fact that the 10-year bond yield has come down to 6.59 is perhaps sparked by this expectation that we could be included in the Bloomberg index. And the expectation is the evening of Jan 14. So we should perhaps know in the morning of Jan 15. Important date. 20 billion is no laughing matter. That's the amount of money, or a little less than that, 18 billion, that FPIs took away from equity markets last year. Well, Devang, what is the minimum math expected from the budget? Are you all expecting a much larger demand, a much larger supply of G-Sex? Just broad math, and whether that is also keeping the bond market subdued.
So, Lata, as per us, probably we are going across now. We all know that from
time in 2026 if growth disappoints, but let's hope that's not the reason. Thank you very much, Swadeep, Aditi, Devang and Srijit for joining us and help understand the inflation numbers that have just been announced. Important number because it's the last of the old series, so it won't impact policy. We bid goodbye to the series, and from February 12th, we will inaugurate a new inflation series. Thank you very much for joining us on this special edition of State of the Economy. After a break, there'll be more news and updates.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the Electronics Ministry has rejected claims that it is seeking source code details from phone makers such as Apple, Samsung, Xiaomi and Google. The ministry has clarified that no such mandate is under consideration and said that it is only conducting a routine stakeholder consultation on security standards. It added that it has been engaging with industry representatives to better understand technical challenges, compliance burdens and international best practices adopted by smartphone manufacturers. This clarification comes after a Reuters report stated that the Indian government was mulling over new smartphone security rules related to source code. Now, sources say it was proposed by National Centre for Communication Security, and MeitY has just proposed it during the latest round of stakeholder consultations. Meanwhile, the Indian Cellular and Electronics Association said that it is, in its statement, said that the issue is not new and that discussions on this matter have been ongoing for several years now and warrants no special attention. Secondly, the association said that it is completely normal for the government to engage with the industry in such discussions, ask technical and compliance-related questions, and for the industry to respond with international practices and clarify what may or may not be possible. The body added that it is confident of reaching a consensus on the best way forward. And well, joining us now to discuss this with us Mr. Pankaj Mohindru, Chairman of India Cellular and Electronics Association, as well as Mr. Ashok Chandak, President of ISA. He'll be joining us shortly as well. Mr. Mohindru, thank you so much for taking our time speaking to us. Let's first address the elephant in the room. One issue based on which this story has gone viral has been is the Indian government asking for source code details from the likes of Apple, from the likes of Samsung. Is that true? Is that what falls from the government as expected from the industry, Mr. Mohindru?
Ashmit, these discussions have been going on since 2020. There was a paper put out by DOT, which is the ITSAR. And I think the confusion is that there is telecom equipment and there is handsets and there are other consumer premises equipment. So all of that is there. And the mobile devices are being discussed in the MeitY, not in the DOT. And I think the hue and cry has been created because of some irresponsible media reports. You remember many years back, there was the SAR, specific absorption rate, where there were many conspiracy theories. And in the end, a very light touch regulation came out that ILAC, which is the International Laboratory Accreditation Council, a self-certification by giving a report from the ILAC is good enough for the industry to complete the compliance. So these reports are unsubstantiated. We've come out with a very robust clarification. The discussions, mobile phones is under the jurisdiction of MeitY, and the discussions are going on. They are very harmonious, very positive, and I think the industry understands.
Right, Mr. Mohindru. So the discussion is underway. You're, of course, hoping for some form of consensus with MeitY, with the government on this. The government, of course, on its account, clarifying its position as well. But given that there are consultations currently underway between the industry and between MeitY, what is it that the government is seeking clarity on? Is it essentially on the source code details? Is it on security parameters like certain data logs that have to be maintained for 12 months? What are these parameters on which the clarity has been sought from the industry?
See, a new framework, a security framework is being envisaged, which will be, which will protect the industry. Now, the handset, the smartphone is so elaborate and it's such a evolved this thing that, there are, for example, financial apps on the smartphones, which is not the responsibility of the smartphone brand. These are the responsibilities of where the financial apps have to get cleared by the appropriate authority or Reserve Bank of India, etc. So that this whole sieving is happening, that what all is on the smartphone, what will be whose jurisdiction, what all has to be tested and put forward by the smartphone owner. But let me clearly advise that there is the prospect of sharing source code, etc., is not in these discussions at all.
Fair enough. Which, in fact, was my very next question, that while MeitY is doing these consultations with you, source code, of course, being one of them that seems to have sparked a lot of interest in these developments, what I want to ask is that, has there been prima facie any expression of view from MeitY, whether it's standing firm on this issue of source code, or if there is flexibility to accommodate the concerns that phone makers like Samsung, like Apple may have?
No, there is, I confirm that there is no requirement of sharing the source code. How can a source code be shared? That is the entire proprietary technology of a brand. I mean, if no government,
from your conversations,
no government would like to have the source code, because it's such a humongous responsibility, and it is not shared anywhere else in the world. So I don't know
an
what
important clarification.
No, in Kanpur, these are called Chandu Khane ki khabrein. So I think the particular whichever report you were talking about,
right?
I am out of the country, so I have not seen it. But this is very irresponsible, very irresponsible reporting.
Let's go beyond the source code as well. There are, as a part of this NCCS proposal, which came out, like you said, way back around 3 years back, there are other parameters such as informing the government of updates, security testing and certification by designated labs of these devices, pre-installation apps have to be removable, security audit logs for about 12 months. These are some of the parameters, some of the suggestions that were put forth. Are any of these aspects on which you have, or the industry has expressed a view, whether or not these can be agreed to, complied with?
So at the moment, these discussions are in sort of in confidentiality. And we will come out with I think the MeitY will come out with a final regulation on this to the satisfaction of the industry. Nobody in the industry has a feeling that we are being pushed around or elbowed or anything. The discussions are very harmonious, and the industry has a very peaceful existence with MeitY and Government of India. Industry has been growing very rapidly and has delivered fantastic results. And it's just not proper to just cry wolf all the time. We need to be in a positive frame of mind.
Right. Mr. Mohindru, since these discussions have only just begun, any timeline that the government has shared as to by when it is looking to come out and formalize some of these security parameters? They will all have, depending on what criteria are agreed upon, will have far-reaching consequences, not just for the smartphone manufacturing industry, but for the larger civil society, mobile users as well. So any timeline that they've expressed by when they're looking to formalize these security parameters?
No, there is no hard, stop on this. And the discussions, as I said, are very harmonious and are going on. There is a discussion on 13th also. So my feeling is that by the end of March or April, we should be see the final outcome of these discussions.
Another similar issue, which in fact grabbed headlines just a few weeks back, had been the proposal from the DoT for pre-installing Sanchar Sathi and having it non-deletable as far as the smartphone devices were concerned. That had come from the DoT. These latest security parameters, I'm given to understand 83 of them, as put out by an arm of the DoT, again coming out from the Department of Telecom. Does this indicate to you that there is closer coordination that is needed for the DoT to actually take MeitY into confidence before proposing such parameters, such conditions for the smartphone industry?
I won't like to be prescriptive about how DoT should go about doing its business. I'm sure there is superintendents on DoT in the Government of India structure, and they are a responsible department. If they put out something which is not acceptable or they have very gracefully withdrawn that also. So I won't take a cue from Sanchar Sathi and think that, they are proposing irresponsible things. Even if something is a little, something is proposed, which is a bit of a stretch, there are always consultations possible, and that's what is going on. So, Ashmit, I'm not getting drawn into this trap, please.
And one final question for you, Mr. Mohindru, that, and this I ask you not just as an association of smartphone manufacturers, but also as a smartphone user yourself. Is there a need for perhaps opening up this discussion to a larger gamut of stakeholders beyond just the industry, to perhaps also bring in members of civil society, consumer groups, think tanks? Is that something that is required for a broader-based consensus on the way forward?
No, if there are concerns which other groups have, civil society or whatever, they should put forward these to the mighty and also to us. I have not heard of any such concerns, or at least we have not been informed of any such concerns, and I think even mighty has not been informed of any such concerns.
Right, Mr. Mohindru, thank you so much for being a part of this. I'm given to understand that Mr. Chandak is also logged in. Mr. Chandak, thank you so much for taking our time for this discussion. Quick question to you. Just your reaction to some of these reports which suggested that there are sensitive details like source code being sought. Mr. Mohindru there clarifying that there is no such demand, but that the industry is in fact in conversation with the government on security protocols. Mr. Chandak.
So my views, as I understand, I also reading some of the reports. Mighty themselves have declined that they have asked for a source code. I am also not aware of any source code demand which is being made here actually. But I would say that we have to look at this also from a balanced view, that this is some routine structured consultation with the industry stakeholders, and the security obviously remains the important point. I want to add here that the central government and particularly MIT have been very consistently, they have demonstrated strong support and growth of India's technology industries, electronics, semiconductors, and all those. At the same time, it is well understood that the security topics are paramount and they are quite important. And going by the past...
Mr. Chandak, we're running out of time. I'll just quickly ask you, is there a view that ISA has formalized that it will be conveying to MeitY in the days, weeks to come?
We haven't made a final conclusion yet, but our view is very simple. It's a balanced view in terms of India's security is also quite important. And whatever is required for that to prevent the protection of the user data, prevent the cybercrime, and global benchmark of the practices is important. So the narrative has to be straight, upfront, transparent, and a close cooperation and a trust with the industry stakeholders is quite important. Not only the mobile phone makers, but also the software, the operating system developers, because it goes through multiple layers of the softwares and also the hardware-related security, that everything comes in picture. So I don't think source code is the only topic here actually, but it's more of the broader aspect.
Right, Mr. Chandak. Right, Mr. Chandak, we're completely out of time. I'd like to thank both of our panelists for sharing their thoughts. Mr. Mohindru, Mr. Chandak, on the way forward, saying that there is no demand from MeitY, from the government, asking for the source code from smartphone makers, but that there is a discussion ongoing on security parameters. That discussion, of course, will unfold in the weeks and months to come. But with that, it's time now for heading into a very short break. But coming up on the other side, after years of safety lapses and intense regulatory scrutiny, Boeing says it has overhauled its manufacturing and quality processes. A special coverage from Boeing's factory in the United States. Stay tuned.
American aircraft manufacturer Boeing has spent the last few years battling one of the deepest crises in its history. Repeated safety lapses, production quality failures, and intense regulatory scrutiny, particularly around the 737 MAX program. So, what has changed since then? To find out, CNBC TV 18 traveled to Boeing's manufacturing facilities in the United States, from Seattle to South Carolina, to see how these aircraft are built today and how Boeing says it is strengthening safety oversight and quality controls across its final assembly lines. Seattle is Boeing's global home and the starting point of this story. It is here that Boeing builds the world's most widely used commercial aircraft, even as it works to restore customer confidence after a series of incidents. The 737 MAX has been at the center of Boeing's troubles, from fatal crashes to manufacturing defects that triggered production slowdowns and regulatory action. Today, Boeing says this factory operates under tighter controls, slower production rates, and increased safety oversight. This is the place where the world's most popular narrow-body plane, the 737 MAX, comes to life. I'm inside Boeing's Renton, Seattle facility, and what you see around me are the 737 planes getting assembled, taking shape, moving each position every step. In a day, there are 10 positions, and they're moving each position every day while the mechanics put together each part, the fuselage, the wings, the landing gears, until they're delivered to the respective airlines. While this facility can produce up to 63 aircraft a month, Boeing is currently building around 42. A slower pace, the company says, allows for additional quality checks and regulatory oversight. Boeing says a safety and quality plan introduced in March 2024 is already showing results, with defects on the line down by about 40% and pending jobs that once travelled to the final position reduced by nearly 60%, suggesting problems are being caught earlier. From Renton, we moved north to Everett, home to Boeing's wide-body programs. This facility is known as the largest manufacturing building in the world, so vast it is often described as being visible even from space. Everett is where Boeing builds the 777 family, including the 777 freighter, some of which were on the assembly line during our visit. The scale here underscores the extraordinary complexity of modern aircraft manufacturing. A single wide-body aircraft contains millions of parts sourced from suppliers across the globe. In such a system, even small lapses in coordination or quality can have far-reaching consequences, something Boeing says it is now addressing through stricter oversight, tighter process control, and deeper checks across the line. The final stop on this tour is South Carolina, where Boeing puts together the 787 Dreamliner end to end. So from Renton and Everett, we are now in Charleston, where the 787 Dreamliner is manufactured. So let's go in and see how the Dreamliner is built. The 787 Dreamliner is built very differently. Large sections of the aircraft are made from composite materials lighter than metal, but they also require higher precision.
Here in Charleston, Boeing fabricates major fuselage sections, including the aft and the mid-body. The carbon fiber used in a single 787, if laid out, would stretch nearly 2,200 miles, roughly the distance from Charleston to Los Angeles.
We are in the final assembly facility of the 787 Dreamliner, and where I'm standing right now is the aft part of the fuselage, the tail end of the fuselage, and on the right is the mid part of the fuselage, and on the extreme front is the front part of the fuselage, and all these three pieces come together to form a 787 Dreamliner plane. And all the planes that you see here are in the final stages of the assembly. There are 8 aircraft here, and each aircraft spends about 5 days on one position. There are 4 positions, and each aircraft spends about 5 days on a single position, and the facility delivers or assembles 7 to 8 Dreamliners every month.
More than 2.3 million parts come together to make one Dreamliner as the aircraft moves through parallel final assembly lines before delivery. Across Boeing's factories, the company says lessons from past failures are reshaping how aircraft are built, from worker training to how quality issues are being flagged and fixed on the line. Boeing has increased investment in training and encouraged employees to raise concerns without fear. Whether that cultural reset delivers lasting results will ultimately be judged not by intent but by what rolls out of these assembly lines, one airplane at a time.
Hello and welcome to Budget Countdown, our special broadcast. I'm Timsi Jaipuria. With less than 3 weeks to go for the Union Budget, Corporate India has been submitting its recommendations to the Finance Ministry. Industry body CII has urged the government to lay more emphasis on capex, support consumption demand, boost affordable housing, among others. It has also batted for a national policy on artificial intelligence. I'm now joined by Vinayak Chatterjee, Chairman CII National Committee on Public-Private Partnership in Infrastructure and co-founder of the InfraVision Foundation. Also on the show with us is Piruz Kambata, Chairman of CII National Committee on Taxation. He is also the Group Chairman of Rasna. Gentlemen, thank you for joining us on this show today. Let me come straight to first Vinayak Chatterjee. When we talk about infra and capex, a lot has been done. We've seen in the past few years government doing the capex push. But how much of a emphasis do you think will continue when it comes to the expectations on the outlay? What could be the budget outlay according to you? What could be the expectations on terms of the infrastructure?
Thank you, Tinzi. The maths, to answer the question, will require a few seconds of maths, which is very simple. There is a national consensus that infra spend as a percentage of GDP should be about 7% of GDP. Please note that historically, half of this comes from the union budget, which is about 3.5%, and the balance 3.5% comes from the combination of states, extra budgetary resources, which is public sector enterprises outside the budget, and private investment. So we are talking about the union budget, which should be doing 3.5% of GDP. The nominal GDP next year is expected to be 400 lakh crores. And very simple maths, 3.5% of 400 is about 14 lakh crores. So I am expecting an outlay of 14 lakh crores across the entire infrastructure sectors in this budget announcement. And this would mark about a 27% increase over last year when the union budget had allocated 11 lakh crores. So that's a straight answer to your question. 11 lakh crores last year, 14 lakh crores expectation this year, which should be equal to 3.5% of the nominal GDP for the coming year. Back to you.
So you see 27% growth there, getting in Piruz in the conversation. CII is also pitching for supporting consumption demand, and they've asked for cutting fuel taxes. What is the idea, and how do you really think the government will be able to bite this bullet? Is there scope? Because, again, fuel taxes, both state and center play a role.
See, this bite the bullet thing now is, I think, understood. You see the latest GST reform, though it's a federal structure, I think everybody agreed. Recently, you see the labor codes and everybody has agreed. So I think if you ask me, in the last few months, I have seen this government has an appetite for reform, and the states are also more or less in agreement with that, because that is important, because they understand that is important for the country. So I definitely believe that there is some reasoning in the fact that either you bring fuel under the ambit of the overall GST laws, or you reduce the taxes on fuel, because otherwise how can industry survive? Because fuel is a major input. Let us say in a food processing plant which is doing, let us say, frozen peas, after the cost of the peas, the second biggest input is the cost of the electricity which goes, and the fuel which goes in the transportation of the peas and the frozen products. So I do believe that they will be definitely looking at considering something like that. But I think to boost consumption, I somehow believe that we need to not only look at reducing tax on fuel, but on a lot of other products also. We need a budget which is really what I call pro-manufacturing. And when I say pro-manufacturing, I am looking at a budget which gives you, let us say, benefits for putting more money into new machinery. It gives you some benefit for getting new technology, buying new technology, developing R&D infrastructure, reducing the taxes to ensure that I become competitive in India and abroad. So I am looking at, if you ask me the budget with that point of view, that how do we support manufacturing at one end? Second, how do you put more money in the people's hands so the people buy more? And if they buy more, overall the economy increases, like what we are seeing.
I'll come back to you, Piruz, on that note.
The custom duty structure needs rationalization.
Piruz, I'll come back to you on this in a bit. Let me get back to Vinayak also, because when it comes to the infra side, do you think the focus, what will be the focus area? What will be the emphasis? Like Piruz is saying, manufacturing should be the focus. The other arm to boost manufacturing in the country is also the infrastructure availability, the kind of infra that is required in the country. So what could be the emphasis areas, Vinayak?
Look, obviously the first emphasis area is PPP, public-private partnerships. Interestingly, just a few days ago, the Finance Ministry announced a PPP pipeline of 283 projects of worth 17 lakh crores to be implemented over 3 years. So as you can see, even pre-budget, the ministry is grappling with a long list of 17 lakh crores of fresh PPP projects. And this is, I would have expected this to come in the budget announcement, but it came last week. So obviously PPP is a priority. And along with it is another issue that is doing the rounds, I understand, in the centers of power and discussion of the budget, which is to allow pension funds to directly invest in infrastructure. Pension funds till now have not been allowed, and they're sitting on assets under management of over 16 lakh crores. So when you allow pension funds to invest directly into infrastructure, you're opening up a very important long-term source of infra financing, which once again addresses the asset liability mismatch problem of lending from commercial banks. So these are the two areas of emphasis. The last and third point which I wish to say is that over the last 25 years, India has seen strong emphasis on building the roads and highways network. That is there for the nation and for the world to see what India has achieved. That has reached a certain level of maturity now. And increasing private funds are coming in there, whether it's InvITs or HAM-related projects. I personally think, and this is a hunch, that this time the emphasis on the budget sectorally will move away from roads and highways into railways. And in railways, I think there is going to be a slew of items mentioned in the budget, chief among which should be and probably will be announcement of a new generation of high-speed rail corridors. But back to you.
So two key areas that I picked up from here. Firstly, there could be the cap on pension funds from investing in infra projects. That could go away is what your hunch is. And secondly, enough has been done on the road side. A lot of push will be seen on the railways to connect and electrification and many other areas on the railway side. So that could give another boost on the infra, but in a different way because the rail network needs
and Timsi, the third point
to be accelerated.
Once again, a re-emphasis on PPP, also which is the third point I made.
Definitely.
Which is also to support the announcement made in last year's budget of looking at a renewed thrust on PPP and creating an India Infra Project Development Fund to aid states and cities to create PPP. This was announced in the last budget, and therefore I think PPP is also going to get renewed emphasis in this budget. But back to you.
Recently, we saw that intent also from the government with that statement on PPP. Getting Piruz in the conversation again, CII has also pitched for creating investment demand, and it is of a view that that a new Ministry of Investment may be thought of. Can you give some details on that side, and also considering that a lot needs to be done on the manufacturing side, as you said, that there is another demand of a new policy on AI. Should that be developed? What should be, what is the idea that CII is pitching on that? So on these two aspects, especially the new investment ministry and what should be done with the new AI policy?
Good question. See, if we are competing with very novel small states like, say, Vietnam, Taiwan, Israel also. Now, if you see, they have, if you go there, 48 hours, you can get all the permissions. You ask any Indian businessman, they have a board of investment, they have one minister taking all decisions, and it is gone. Done. You put money and everything comes. Of course, you follow the regulations. India, it is a known fact that ultimately, I'm not saying it is wrong, but because the way we have laid our policies over the years, central government, state government, municipalities, this board, that board, and for every time you have to go to pillar to post. So the problem what happens is that somehow you feel that the investor feels that I'm tired, by main kahan bhagunga. So somehow he needs a handholding. And we are not talking of some Indian who knows the system here, who has been born here. I'm talking of a foreigner. For him, this is quite new. So a Ministry of Investment, which is like a nodal body to promote investment, in my mind, both Indian and foreign, but mostly to help foreign investment, ensure that it sort of incubates very fast, and the government is able to ensure that all the support it can all give through that one ministry, so he doesn't have to go to various bodies. Very welcome. And I think it will be very important that even the state government powers, the local body powers, the municipality powers, whatever, are also enshrined in this ministry, and whatever approval he needs from other regulatory ministries like, say, pollution or food or pharma or whatever the case may be, are also channeled through this ministry, so this becomes much faster and time-bound manner. I think this is our expectation. And I definitely see if there can be a ministry of disinvestment, there can definitely be a ministry of investment. That's how I like to put it that way. On the second
and on the AI policy,
I'm coming to that. I'll take all the three. The AI policy is something which has to happen because the AI is reshaping the whole world order. And I do believe that it requires a policy support from the government. And there's a lot of appetite in bigger companies, smaller companies, medium companies to absorb AI. But there's regulatory framework needed. And I think something like that will help this whole AI absorption. And I'm a firm believer that AI is not an option. You have to compete in the world, you have to adopt AI. And I have also a firm believer that AI will definitely help creating better and better employment opportunities. Some people say AI will
I would like to interrupt you there.
That's the third question.
I would like to interrupt you there because we are short of time. And as we heard the two experts from CII actually talking about reviving PPP to more funds towards railways to boosting the consumption and investment demand, well, a whole host of wish list on CII's table right now. And let's see what actually comes through in the budget on 1st of February. But time for a short break. Coming up next, India Inc. expects the government to provide a complete overhaul of customs. A special discussion with Price Waterhouse partners Bhavin Shah and Prateek Jain when we return. Welcome back. You are watching our special broadcast. India Inc. expects the government to provide a complete overhaul of customs. Pricewaterhouse & Co. hopes that the government will work on digitization of custom processes in a bid to focus on reducing clearance time, improve competitiveness and ease of doing business. The company expects a customs amnesty scheme to help ease working capital. To take this discussion forward, I am now joined by Pricewaterhouse co-partners Bhavin Shah and Prateek Jain. Gentlemen, thank you for joining us on this show today. Let me begin with Prateek Jain on this particular thing, especially when it comes to customs overhaul. We heard Finance Minister of late saying that that is going to be her priority in this budget. What sort of an overhaul are you looking at? Because we saw some tariff lines going last budget itself, and again a customs overhaul. Where are we, especially given the geopolitical scenario?
Timsi, thanks a lot for inviting us. 2-3 parts of this overall. One is slab rationalization. So today you have 8 slabs. We're expecting it to become 5 or 6. And more importantly, you will have different slabs for raw materials, different for intermediary and different for finished products. And the duties for raw material will be lesser, intermediate will be slightly higher, and finished product will be highest. That's how the intention is. So we are expecting substantial overhaul in the slab structure, much like what happened in GST 2.0. The second is, as you pointed out, the exemptions review. Last year, a lot of exemptions went away. This year, a lot of exemptions are supposed to expire. We are expecting government to look at those exemptions carefully and maybe continue with the exemptions which are for priority sector. For example, there is an exemption for manufacture of parts for lithium-ion batteries and packs. So maybe those kind of exemptions will continue. Second is because of the geopolitical issues and also the number of free trade agreements that India has signed, you may see some calibration on duty rates, right? In the last budget, you would have seen on bourbon, whiskey, and bikes and so on. This year, you might see some other products as well. The last is the digitization part of it. There are a lot of things which have happened in Indian customs, which are in the positive direction over the last few years. We expect more digitization to come in processes like MOVER, which is manufacture under bond, or AEO, which is authorized economic operator, which is a scheme for large importers, which gives them certain benefits and concessions on imports. So these collectively, all of that is really the overall part of it, in addition to the customs amnesty scheme that you spoke about.
Getting in Bhavin into the conversation, Bhavin, India needs a lot of private capital to continue with the growth momentum. What are the top suggestions from the tax and regulatory standpoint to attract private capital in the country?
Yeah, so India is on a growth momentum journey. A lot of private capital is required. Several years back, India introduced Press Note 3, which required government approval for making investments from neighboring countries. Now, while investment from neighboring countries were supposed to be restricted at that point in time, the geopolitical situations have changed and that requires a relook. Several private equity funds have very small investment from say, China or Hong Kong or countries like that. And that requires government approval, which delays the timeline significantly. So that's one area which government can review. The time is apt again, where a lot of capital can come in from an ease of doing business standpoint. That is one suggestion that we have. Couple of other areas. One is that there is lots of listed companies in last couple of years. Many companies have gone listed. There will be a lot of private capital again, which will come in to buy these listed companies, take them private, grow them again. And for that, delisting process in India is something which can be simplified. So that's another area which government can look at. Third thing is when a listed company is bought, there is a tax on the buyer. If the buyer buys the listed company at a price which is less than the current market ruling price, that's something which was introduced by the government earlier to avoid transactions where people exchange money at discount. So that is again a change which is something government can look at. Lastly, credit funds, right? Debt investment in India is something which which is expected with Indian bonds being included in global indices. The tax rate on interest is 20%. It was 10% earlier. Many tax treaties, the withholding tax is only 10%. The Indian domestic law has 20%, which is very steep. So that's the fourth thing that government can consider.
Getting in, Prateek, back into this, well, not just the rates, custom processes have been bothering the industry. And as you were mentioning, that digitization could be one of the way forward to further simplify the regime, further bring in ease of doing business. We've seen some sort of an intent earlier also. What are the challenges that the industry is facing currently, and what needs to be corrected according to you, which is likely to make it in the budget this time?
I think the broad point is that increased use of technology in customs administration, this end-to-end digitization. So today, if you look at GST, in GST, you have pretty much end-to-end digitization, right? Right from the registration processes to reporting, to filing of return. Pretty much the GST system is integrated to large companies' ERP, and you can pretty much do all the filings there. Maybe I'm not expecting a complete digitization to happen now, but maybe a stepwise process to be announced as to how custom digitization will take shape, just like GST. There are some specific processes that I spoke about, like mover scheme, where digitization is required more urgently, and I think therefore I'm saying stepwise process. The other thing which I like to highlight is, and this part of the process only, is how do you reduce the dispute, right? So you have a lot of customs legacy cases which is pending before court. The collective value of these amounts is more than 40,000 crores, and that amount was a couple of years ago. And how do you come up with a scheme so that industry can settle those past disputes, just like you did it for excise and service tax earlier when GST came in, or now for GST as well. So therefore, a need of the hour is to come up with a comprehensive amnesty scheme so that I can settle my dispute and move on from it.
Well, I don't know how much will the finance minister actually look into this, because when it comes to digitization, definitely the government has expressed that intent many a times, and they themselves want digitization to happen because it clears up a lot of compliances in a much easier way. But when it comes to amnesty scheme, every industry body, every industry chamber, every person that I'm talking on this side is actually talking about an amnesty scheme. And it's not the first time, well, let me tell you that. Earlier also in the past 2 years, there have been a demand and a push for a customs amnesty scheme so that it eases a lot of legacy cases, as you rightly mentioned, and it opens up revenues for the government also, and clears up the working capital issues. But I don't know whether government will actually bring it in this time or not, because already we've seen in the past 2 years the demand has been ignored, is what I would say. Getting Bhavin back into this conversation, well, this again is an interesting area and is on your wish list. Well, emergence of India's data center hub. Government has been talking about it, and government has been doing a lot. So what is it that Pricewaterhouse is now looking at on their wish list for data centers?
So current installed capacity, the MC of data center is about 1.5 gigawatts. That's going to grow up 10 times, like 10x in next 10 years. By 2035, we expect that to go up to 14 gigawatts. Requires a lot of capital, like $70 billion. I've seen tax or regulatory ease can really spur the activity in a particular sector. The two significant issues in data center sector. One is the GST credit. Okay, so the construction and any spend, the GST liability that on development and construction of data center, whatever is spent is not allowed as a credit against the output liability, and that's a huge cost, about 18% additional cost. So that's one thing which government can consider to relax or allow the credit of the GST, which is spent on development of the data centers. That's ask number one. Ask number two is the depreciation, which is going to be on the entire $70 billion of investment. There will be depreciation that the companies or data centers can claim. Today, there is ambiguity. The tax depreciation rate can be 10% or it can be 40%, depending on whether it is building, plant, or or it is computers. That ambiguity needs to be set at rest. So these are the two large demands from the industry. There are other smaller demands like the foreign client should not be taxable in India because they use India data centers. So all those things, if they can, and lots of representations have gone from the industry, we need to wait as to how government resolves some of these and gives clarity.
Coming into Prateek there with a closing remark. One thing that you think government will definitely do this time on the indirect taxes? Your
I think
closing remark.
they will bring in the customs complete rationalization and overhaul, as they were saying. I'll just add one more, which we have not spoken about. India is going to look at alternative export markets. So I will keenly looking at any facilitation or any scheme for India to say, if you export to newer territories, this is the support that we will give to you. That's another thing which is on the anvil, to my mind.
So trade facilitation definitely is what Pricewaterhouse is looking at, along with the customs amnesty scheme. That's their top wish list. And with that, it's a wrap on this special broadcast. Thank you for watching. Stay tuned to CNBC TV 18. The news continues on the other side.
Hello and welcome to this edition of The Newsmaker. Over the weekend, a big deal in the hospitality space. Lemon Tree Hotels has announced a strategic reorganization of its business, creating two distinct platforms: an asset-light hotel management company and a scale hotel ownership and development vehicle, Fleur Hotels. As part of that transaction, Warburg Pincus, the private equity giant, is acquiring APG's entire 41% stake in Fleur Hotels and committing up to 960 crores of fresh primary capital to support its next phase of expansion. It is also a renewed partnership. Warburg Pincus was an early backer of Lemon Tree nearly 2 decades ago, helping build what is today one of India's most recognizable mid-market hospitality brands. The latest investment comes at a time when India's travel, tourism and discretionary consumption cycle is seeing a structural upswing supported by infrastructure build-out and rising domestic demand. With such a landmark move to kick off 2026, we thought it would be the perfect opportunity to speak with one of the primary architects of this strategy. We are joined today by Vishal Mahadevia, Managing Director and Head of Asia Private Equity for Warburg Pincus. Vishal also serves as the Global Co-Head of Financial Services, a role that is particularly relevant given the firm's recent successful $3 billion close of its third financial services fund just a few days ago. Well, this interview also comes at a momentous time for Warburg Pincus as the firm celebrates its 60th anniversary this year. Since its founding in 1966, the firm has become a pioneer in global growth investing, now managing over $100 billion in assets across more than 215 portfolio companies. In India, Warburg's journey began in 1996, making them one of the earliest and most successful global PE firms in the country, with roughly $10 billion invested in India to date. Their portfolio reads like a who's who of industry leaders, from the early success of Bharti Airtel to current powerhouses like IDFC First Bank, CAMS, Kalyan Jewellers, and many more. Air India has, of course, been one of the large new bets as far as the consumption space is concerned. Vishal, of course, has been at the center of that journey, helping deploy capital through multiple cycles, build scale platforms, and deliver some of the market's most closely watched exits. Vishal, it's a pleasure to have you with us here. Thank you very much.
Thanks.
Congratulations on the big deal with Lemon Tree. And of course, I mean, at the outset, let me say congratulations. 30 years of Warburg in India, 60 years of Warburg, as a firm.
Thank you, Prashant, and it's great to be here. Thanks for having me. It's actually quite amazing. 30 years, 3 decades in India. When we first came out here, I think the economy was less than $500 billion GDP. It was really not on anyone's radar. And being here for 30 years, through ups and downs, through all these cycles, we're just terrific. So happy to be here. And we're lucky that we've been able to partner with some of the best entrepreneurs. And you started out talking about Lemon Tree, but to be back with Patu, as when we just started more than a decade ago, working with him, it's just been terrific and great to be back with him.
We'll come back to a little later in terms of the journey of Warburg itself and what's ahead. But Lemon Tree, you're coming back in a way, right? Because you were there in the beginning 2 decades ago. Small company, it's a very large sort of company now. What's the logic? And just tell us a little bit what investors should expect now after this transaction goes through.
Sure. Look, I'll give you 2 very simple reasons we're back with Lemon Tree. And number one is Patu. I think in India, in 30 years, we've seen who you do business with, who you partner with, is much, much more important than the company that you invest in. And so a chance to come back with Patu and his entire team and seeing how they've grown and built really one of the leading hospitality businesses in India is terrific. 2, I really think hospitality is at an upswing. You've got all the reforms, the infrastructure bill that's happening in the country. You've got a more affluent consumer in the country that's aspiring, that wants more. And as you have this increase in domestic travel, not just tourism, but even business, even overall larger and larger companies, I think Lemon Tree is in a great position to benefit from that. And really, with our capital and hopefully with our partnership, grow that business.
You're also buying out APG's 41% stake in Fleur, right?
Yes.
What was the logic there? And was they had to get out? They wanted to sell, and what? Just talk to us a little bit about that.
I won't comment on APG, but I would only say they've, as they've said publicly, they've done very well. They've been great partners for Patu. But like all financial investors, there comes a time when you've generated very good returns for your partner, and the partner needs an exit. And we were lucky enough with Patu to be able to buy out the stake, come back in, and be a partner with him, and not just buy out their stake, but really provide this additional capital to help grow Lemon Tree, which is the fuel again for the hotel business.
So actually, the overall transaction is much larger in that sense.
Yes,
right?
it is.
There's that 41% for what you're paying.
That's exactly right.
A meaningful sum, and then there is this primary capital of 960 odd crores as well.
That's right. The overall transaction size is multiples of the 960 crores. And hopefully there's even more of that in the future, because we are very positive on both Lemon Tree and the hospitality business in India.
The investment in Air India, right, with Bharti Enterprises.
Yes.
And of course, I mean, you work with Bharti. It's been one of the oldest associations here in India in that sense. Again, it's a consumer bet.
Yes.
So talk to us a little bit about that. What do you aim to achieve with that one?
Yeah, look, Haya India, amazing company. They've grown 25% compounded annually over the last however many years, grown to become the number 3 brand in India in white goods. We've known Haya very well for years. We've known Sunil, of course, go back to our early days in India since 1999, when we made our first investment in Airtel, when it was just a North Delhi cell phone company. And we've come back again with Sunil in the past. So it really is, you see a little bit of a theme. Who we do business with is important. And a chance to partner again with Sunil, to partner with Haya in this new structure, and then create another Indian champion. Make in India, make for India, alongside Sunil, who understands the Indian consumer as well. I really think it's a terrific cocktail. A lot of hard work, a lot of execution required, but the opportunity is tremendous. Again, affluent Indian consumer. They want to buy better goods. They want value for money for their purchase. They trust brands. They want better technology. So all in all, if you can pull all of that together, I think Haya in India can have tremendous success.
You know, the big story for the last 15, 20 years with regards to the consumer in India is that, I mean, we all used to look at what's happened in China and say, well, you know, look category by category. What's happened here, there will happen here. I mean, you know, per capita consumption of this and that, etc. I mean, everything from ACs to footwear to everything. I mean, you have extensive amounts of experience in China. You travel extensively across Asia, for that matter. Is that thesis still correct? I mean, that is the broad way to look at it, or is there a change?
No, I think I would say India will develop very differently in terms of both the speed and the level of its penetration rate and what consumer categories India will have. But the direction of travel is undisputed. In fact, what really changed, I think, for India and accelerated that trend from unbranded to branded, from unorganized to organized, was COVID. That actually changed everything. People were more comfortable using technology, buying online, paying online, digital payments, everything enabling that system, along with the government regulation that happened, you know, a decade ago. It just accelerated this trend. And so you have the Hayas of the world. We invested in a company called EBCO, in a company called WaterTech. As you go down that list, I think that trend is accelerated. It was always there, but Haya sits in the forefront of it.
So from a consumer perspective, the broad bet is premiumization across categories.
I think
that is what you're betting on.
I think the broad bet is premiumization at every level. So someone at the bottom of the pyramid is premiumizing what they used to buy, and someone in the middle of the pyramid is premiumizing what they need to buy. So it's not just premium products. I actually think you want to be able to serve that mass market in India, but every Indian consumer is aspiring to buy a slightly more premium product, and you have to be able to cater to that with good value and better products.
You know, what we're going to do, Vishal, is take a quick commercial break here. We'll talk about financial services. So many transactions lately. You've closed a very big fund, and I'll ask you where you plan to invest and put some of that money, especially in the Indian context. So stay with us. We are back with Vishal Mahadevia of Warburg Pincus in just a bit. Welcome back. You're with us here on the Newsmaker. Vishal Mahadevia is head of Warburg Pincus. He's with us here talking to us about, of course, the latest bet with Lemon Tree. Consumption is a theme that he's betting on. And, of course, now we turn our attention to the financial services space. Vishal, thanks very much. You've closed this $3 billion giant fund. How central is India to that deployment in that sense, Vishal?
India is key to that deployment. Financial services and financial technologies, which really both go together. I don't think you can separate the two. Really has been core to our financial services practice globally at Warburg Pincus. It's the single largest sector that we've invested in our 30 years of investing in India. And really a very large part of the fund. India is frankly also a very large part of everything Warburg Pincus does, but within financial services, it's even larger. I think we built a network in financial services over 30 years of people, entrepreneurs, founders. And I think you're just still at the early stages and early innings of that journey.
You've got current sort of investments out there which are running, but you'll make more. Do you feel that you should have raised this money a little earlier? So many spate of deals, right? Shriram Finance, there's RBL, there's Federal, there's, Samman Capital. So many kinds of deals. And it's only picked up. I'm not sure. Is there a trend, a common thread through all of these? Why this is happening now?
So I can't comment on the other deals, but I'll tell you on financial services, the common thread for us. So firstly, this is our third financial services fund. We've always, because of financial services, which have been large, a companion fund, which we also invest with our global fund. These deals are because financial services, for a number of years, if you look at the public markets, it's one of the few sectors that I think is still trading below its long-term average valuations.
Yeah.
You can't say that for too many sectors in the Indian public markets today. The companies need capital in financial services because they're growing fast. Growth is back, both as consumers need growth and corporates want to start tapping for growth. So I think that opportunity on balance sheet financial services now will continue to be interesting. Everyone's seeing it. We were first. I wouldn't say we were first. We were early when we invested in IDFC Bank, our first bank last year. And you've seen a number of these spate of deals happen after that as well.
Are you talking to companies in that space?
We're always talking to companies in the financial
I'm talking about large, already sort of, not small companies, not companies which are small, but scaled up large companies like the kind of deal that we've seen right now, right?
Yeah.
I mean, Shriram, when they did this deal, it was a very large company in that sense. So will we see more of that, especially from you?
You will see more of that from us, but I think we're very specific about what we want to do. So in each area of financial services, we want to have a play, but it's very micro. Depends on, as I say, the person. It depends on the company, on that specific opportunity, the valuation.
So you're looking to fill a gap in that spectrum.
So in banking, we have a large stake in IDFC First Bank. I never say never, but it's unlikely you're going to see us do another large bank at the same time. In wealth management, in asset management, in payments, all are areas where we are extremely active. We're talking to companies. We'd like to do something, and we will continue to be active. We've been investors in the past in that space, and we will continue to look for opportunities.
Ticket size-wise, I mean, no, it's not...
I think we would like to invest at least $300 million in a single ticket in any company. That's not hard and fast, but the bigger, the better. If it's $1 billion, even better.
Okay.
So really, we are looking to do larger things. We do fewer things, but larger things, and where we can have an impact both on the company as well as on the fund.
$300 million on the lower side can go up to about $1 billion, if possible. You mentioned valuations in financial services looking a little better as compared to other parts of the market. What is happening with value? I mean, public markets, public equities, the common refrain, complaint, hand-wringing is about valuations being too high.
Yes.
In private markets, I mean, are deals coming? Are they fairly valued? Do you find bulk of them very expensive? What's happening?
I look at the banking sector in India, for example, and everyone can have a different view. And I think if you believe that the bank ROEs are going to expand and growth is going to come back, banks today in India are cheap. On a PE basis, on a price-to-book basis, they're all trading at a discount, as I said, to their long-term averages. So I believe it's not a private or public market piece where banks and financial services or companies are concerned. Broadly, when you look at private equity, I do think the private markets typically where you find large opportunities, should be at a better valuation than what you see in the public markets when we are entering as an investor. The reason is they all come with some degree of complication. You have to add systems, controls, governance, you have to change strategy, you have to put more capital, and you have to take some risks. So by the time the company is ready to be an IPO or go to the public markets, a lot of those risks should be mitigated. And for taking those risks, you should get a better valuation and be able to earn a higher return.
You know, the flow of money has been just, terrific, right? In terms of SIPs and insurance money, pension money, et cetera, and there is also, from a common small investor point of view, they look at all these large, exits, promoter blocks, and 2025 was a record year in that sense. They say, well, this is a en masse transfer of wealth away from retail, common small shareholders to promoters and early investors, et cetera. How would you respond to that, Vishal?
Yeah, I think that's not true at all. I think there are cases where people would say, hey, that stock didn't make money or didn't do well and it was a transfer of wealth. We've been here 30 years. We've been in private companies, we've been in public companies, we've taken company public, and we've created Indian champions that have reached a different scale. Our initial investment in Bharti in 1999 was $30 million. Today, I think the company is over $100 billion of market cap.
No, this question was not about Warburg and what you...
No, I understand. I'm giving I can only speak the Warburg example a little bit as you talk promoters and private equity. I actually think the public markets, for good companies that are well governed, if you believe in the story in India, and you get a chance to buy shares in that company, you have to be patient. You got to be able to wait as you go through the cycles, but returns should be there. No good company that's out there that's a public company, whether the promoters have sold or whether private equity funds have sold or others have sold blocks. When it's a good company, you look 5-10 years later, it's not multiples of where it was.
And it's so interesting, right? In the US, actually, it's the opposite which is happening. So much wealth is being created outside of the listed end. Everything is happening in the private sphere. Yes. Access to those companies is pretty limited to a small select club of people. Here, of course, in a way, it's different. How's the role of PE and what you've done kind of changed, and how will it change going forward, Vishal, from a capital provider to kind of a sort of more strategic kind of player involved in running the business and kind of imagining the future of the business?
It's a great question. Look, private equity has had to evolve. When we first came into India, it was undiscovered. So you could find very established entrepreneurs, businesses that could benefit from our capital at very good valuations.
Sure.
That's not there anymore. So just coming in and being a passive investor is very hard to go and say, I can generate alpha and private equity returns. We have to do something more. For us as Warburg Pincus, that doesn't mean running our businesses. We have terrific partners, entrepreneurs, management teams who run the business. But you have to be able to bring some value, whether it's your global network and connects for global businesses that can benefit, whether it is helping them with their technology, whether it's helping them with their financial systems and processes, whether it's helping them with human capital and strengthening their management teams and HR practices. There's a whole litany of things that we at Warburg Pincus have invested in our team and people to be able to help those companies. And you have to be able to do that to generate those returns and that operating
add value beyond just the capital.
Absolutely, because capital is a commodity today.
If you were a public market investor, I'd ask you which are the most attractive areas. We talk about consumption a little bit, financial services you clearly like, and you've got large check sizes to write. Is there anything out there which is, some have complained, well, India is too well discovered in that sense, right? There's too much capital now. Actually, I don't know what you think of it, financial access to financial products in a country like India, with a per capita GDP where we are, it's unprecedented, right? We reached this level in many other countries at much higher levels of per capita. So that's the hand wringing, etc., which happens, which is too well discovered. You kind of agree with that, or you think there are still opportunities thematically where one should focus on over the next year, 2 years, 3 years?
I'd say definitely things that thematically, and this is where we spend all of our time, not just consumer as a theme. You have to take it down one subsector, then another subsector, and another level deeper. I'll give you an example. I wouldn't say it's undiscovered, but something that I think can become bigger and bigger for India and then India for the world is medical devices.
Okay. And you have an investment there, right?
We have two.
Merrill
we have Merrill and a company called Appasamy that does ophthalmological equipment, sorry, and really the intraocular lenses that are used for cataract, retina surgeries. Terrific companies, both of them. But they're creating medtech devices that can be used in India for the consumer, but are also technology that the world wants. Great value, great technology, great proposition. And so these are smaller companies today. I would say that fairly large. But
Merrill is, I mean, I think...
No. I don't mean like smaller. But when you talk about in the market, people don't talk about this that much. It's easier to talk about consumer. And when you talk healthcare, people talk about pharma or hospitals. So I feel there are these areas, but you have terrific companies, terrific entrepreneurs. Take Merrill, which you talked about. Out in Vapi, Belakia family, they built this outstanding business. It's relatively under the radar. So I look at this and you'll see more and more of that. And Indian entrepreneurship is going to continue to sprout in different places to build these companies. And that's our job, to find them.
So thematically, is it, in a way, for the lack of a better way to put it, import substitution as a way? Medical devices, for example, is one.
I think that is one part of it for sure. Import substitution and then stimulating demand. If you can provide a knee replacement at a substantially lower cost and high quality, the amount of Indians that can afford to get a knee replaced, who otherwise would go walking around, I'm just making it up as an example, are more. And therefore, you're creating not only the size of the market, but you're also substituting from what would otherwise have been imported product or other branded product in India that's a lot more expensive and not necessarily better quality. Second, as I said, is the export opportunity, because other countries are facing the same issue. And so they'd love to have great high-quality medical devices they could get.
Vishal, as you sort of look ahead investing in India, and as you look back as well, I mean, say, go back 10 years, right? What one or two things which have changed in a very meaningful way here in India as you look? Is it the quality of entrepreneurs? Is it ambition, which is now scaled up quite a bit? Capital, of course, is, I dare say, not a problem in that sense. Although in deep tech sectors, etc., we still hear that, well, you know, capital is there, but maybe not sufficient amounts of risk capital. What would you point out to?
Gosh, I'd say India has been through this period of both political and economic stability, which is quite amazing. I don't think I've been at a time in India when the economic indicators from a financial economy standpoint have been stronger. There are challenges all over. We can complain about, you know, a whole host of things. But that's really very strong. I'd say the reforms that took place starting 10 years ago, they don't seem to be slowing down. And that creates that next impetus for growth in India. And entrepreneurs are just more confident. I'd say there's just more of a level playing field. You're seeing entrepreneurs everywhere, not just the top 10 business houses or others, etc. Not that there's anything wrong with that, but you're just seeing such a larger market of entrepreneurship. Capital, as you said, is not the problem. It's finding the right entrepreneur, the right idea, and then helping them as they continue to grow it.
Actually, long time public market investors have all become venture capital and private equity investors. I mean, in the last 2 years, not bothered about public markets. Everyone is focused on early stage deals.
I mean, just look at the public markets historically. If you needed capital, you had to go to the public markets before you were ready as a company, right? It's changed.
Yeah, it's changed. You know, you're celebrating 60 years of Warburg. What does success in India look like as you kind of sort of look ahead next 10, 15 years, Vishal?
I have a very simple thought in my head. Always be humble and remember we want to, as Warburg Pincus, now, 10 years from now, 20 years from now, be considered to be the best partner, partner of choice when someone is looking to find a new owner for their business, when someone is looking for capital to partner with them and create the next champion in India. We want them to think of Warburg Pincus first. It's not the largest private equity fund. It's not the best returns. I mean, all that will happen. But the first part of it, in my mind, stays day in and day out. That's what we want to be.
That's very well put, Vishal. Thank you very much for dropping by today. Really appreciate your time and good luck as you sort of look ahead and execute.
Thank you for having me here.
Thanks very much. Well, that is Vishal Mahadevia of Warburg Pincus on this edition of the Newsmaker. I enjoyed it. I hope you did too. Thanks very much for staying with us. More comes up in just a bit.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Ritu Singh from the Bangalore studio. These are the top headlines from the startup space. Dharna Capital, an offshoot of Y Capital, has raised $250 million for its second India-focused vehicle to back tech and consumer businesses. With the new fund, its total assets under management are at $450 million.
AI-native finance platform Blue Copa raises $7.5 million in a Series A funding round led by Analog and Bloom Ventures. It clocks 5 times revenue growth in 2025.
Artisanal coffee startup Good Farmer Food Concepts raises $1.5 million in an ongoing pre-Series A round, adds Rahul Dravid, Rohan Bopanna to the cap table. The funds will be used to expand presence and invest in R&D.
Inframarket, an online marketplace for construction materials, reported a 27% year-on-year increase in consolidated revenues for FY25, even as its net profit declined 42%. The firm's revenue from operations stood at 18,472 crore rupees, compared with about 14,500 odd a year ago.
SaaS firm BrowserStack has announced a $125 million ESOP and share buyback program for its employees and early investors. The company's third buyback program will benefit more than 500 current and former employees, along with early backers. Well, those were the headlines we are tracking for you this evening on What's Brewing Today. CFOs are expected to deliver real-time numbers, zero-error reporting and faster decisions, even as most finance systems remain stuck in fragmented manual workflows and month-end fire drills. A new wave of AI-native startups is now trying to change that. One of them is Blue Copa, a Hyderabad-based enterprise fintech that has just raised $7.5 million in Series A funding to build what it calls autonomous finance operations, where reconciliations, closes, payables, and reporting run themselves continuously and in real time. With marquee enterprise customers, global expansion plans, and investors backing what could be a multi-billion-dollar shift in the CFO tech stack, Blue Copa is betting big on the future of enterprise finance. Joining me now is Raghavendra Reddy, the co-founder and COO of Blue Copa. Raghavendra, welcome to Startup Street. You've seen 5x revenue growth and 3x customer growth in 2025. Most enterprises already have, ERPS, accounting software and BI tools. So what's fundamentally broken in the way finance teams operate today?
Hi, Shruti. Firstly, thank you so much for having me on the show. It's not about, lack of systems in the current ecosystem, right? It's how disconnected the whole tech stack is as we speak. Right? ERPs are probably very good from a system of record standpoint. You have BI tools which would help you from a hindsight standpoint. But even today, finance teams spend almost 70 to 80% of their time on manual, repetitive tasks. That's where Blue Copa likes to make a dent. That's all happening because of the batch process that the current tech stack currently offers, right? So the world is moving towards continuous finance operations, which is where again Blue Copa comes in. The intent is to make the whole operations of finance very, very autonomous.
Okay.
Like I said, right, that's where a huge distinction comes between ERPs, BI tools versus Blue Copa as we speak.
So autonomous finance sounds futuristic, Raghavendra. In fact, you claim Blue Copa can automate 90% of reconciliations and enable a continuous close. How radical a shift is that from the monthly fire drill model finance teams live with today? And how will the Series A accelerate what Blue Copa builds over the next 18 months?
It's definitely, a foundational shift, I would say. As we speak, still a lot of companies do a lot of month-end drill. From there, moving towards, continuous close is definitely going to be a bigger shift as we speak. 90% of the automation is definitely something that we want to attain, and we are going very, very aggressively towards that direction. Right, coming to how we plan to deploy the funds over the next 12 to 18 months, we would want to deploy across 3 areas largely. One is doubling down on our AI side investments, particularly on the foundational model. The second is the expansion. Today we have marquee customers across Asia, Middle East, and US.
Yeah.
We want to double down using the current capital plus using some of the logos that we currently have. And finally, to do all of this, you will need to have a very strong leadership team, which is where significant capital again would go. So largely these 3 areas is where we would spend, Shruti.
Okay. You know, a lot of enterprise software companies are bolting AI on top of old systems. Why did you choose to rebuild the entire data backbone instead? And what is your proprietary AI engine at Sensex AI do that traditional finance automation tools can't?
So AI is only as good as the underneath data, right? So the problem with the legacy tools is that they would not be able to support real-time data, real-time decision making, or AI native actions. So which is where we are reimagining the whole data layer itself, right? Blue Copper, what it does is gives 100% of the data that finance teams need in a very clean, normalized, and decision-friendly fashion.
Sure.
So there's no other option but to reimagine the whole data layer itself. And coming specifically to the Sensex AI that you mentioned, the difference between Sensex AI and any other generic AI is that Sensex AI is purpose built for finance function, right? It understands finance context.
Okay.
For example, if there's a reconciliation that happens from a finance function standpoint, it doesn't just tell you what is reconciled, what is unreconciled, right? It gives you actions that you can take. It tells you based on your past, activities that you would have done, based on some of the best industry practices, for example. It takes a lot of functional aspect into the traditional or generic AI model. So it's purpose built for finance function.
All right.
Which is where it would definitely create a lot of, dent, I would say, in the CFO tech stack.
Sure. You know, Raghavendra, you work with customers, including a Fortune 50 global retailer and large digital native companies. What kind of transformation are they seeing after switching to Blue Copper? What kind of improvement in efficiency do you bring to the table? You know, if you could also take us to the current business growth numbers quickly.
Sure. So last 2025, our revenue increased by about 5x. Our customer base, went up by 3x. That also shows that largely once we get into any account, expansion is what we strongly see in any account that we get into. That also shows it's not just an experimentation that customers are looking for. It's also the operational adoption that Blue Copper caters to. Right, in terms of the in terms of the transformation that we see, right, largely again around 3 areas. The first is cutting down the whole record to report cycle itself. Right, today we think it is anywhere between 40 to 50% that we bring it down to. Second is significantly enhancing the overall efficiency of the finance function per se. We claim 50% increase in the efficiency, right, and I'm sure that will keep going up as we move towards AI side investments. And finally, anything that you do in finance function needs to be 100% audited, right? It needs to be compliance ready. I can assure you that finance leaders with a platform like ours can ensure the whole processes are 100% compliant, which means listed companies also get to see what they would need from a compliance standpoint, 100%.
Okay. You know, one final question. Analysts estimate the autonomous finance market could reach $27 to $57 billion by 2030. There's huge potential. In fact, you're now expanding across APAC, North America, and the Middle East. Raghavendra, what's the kind of demand you're seeing currently? And 5 years from now, how different will the role of the CFO look if autonomous finance takes off?
So particularly coming to autonomous finance, we see very strong demand, particularly from APAC, North American and Middle East markets. Within these markets also, we see a lot of interest from enterprises and GCCs in particular. So I'm pretty sure that mid-market, higher end of mid-market to enterprise is where the game is going to be, right? And particularly 5 years from now, if you ask me how does the whole finance function or CFOs activities would look like, I can guarantee you that it's moving away from data heavy or reconciliation heavy approach to decision making approach. You will also see a lot of noise which will get cut down around data and reconciliations, and a lot of time is going to be spent on strategy, capital allocation, risk mitigation, for example, valuation increase, for example. It's going to be more on value creation versus a lot today, which is spent on data and management around data aspects, Shruti.
All right. On that note, it's time for me to wrap up our conversation. Raghavendra, many thanks for joining us on Startup Street, and wish you the best with all your growth plans.
Thank you so much. Thanks for having me.
All right, and what else is brewing today? Future Cure Health, which is a healthcare technology company that focuses on super specialty care, it has mopped up 104 crore rupees in a funding that was led by Carnelian Asset Management and others. Now, the company says this funding will help it expand access to the diagnosis and treatment of vertigo. Now, Future Cure runs Neuro Equilibrium, which is its wholly owned subsidiary, It operates around 300 clinics in India and in 16 other countries. And it says it has enabled diagnosis and treatment for over 150,000 patients so far. For more on the company's growth trajectory, joining me now is Rajneesh Bhandari, who's the founder of Neuro Equilibrium. Rajneesh, thank you so much for joining us here on Startup Street. Just for the benefit of our viewers, start by telling us a bit about your company and the gap that you found in this vertigo treatment market, very niche, very specialized, that you're trying to bridge, and therefore the size of the market opportunity you're chasing.
So thank you for having me on this show. So vertigo dizziness is something which affects a very large population. So 15% of the population will have vertigo dizziness sometime in their lifetime. And 5% have vertigo dizziness in any given year. So it's more than diabetes or cardiac disease. And what is happening is that suppressants are given to suppress the symptoms rather than finding out the underlying cause and treating it. So we found this gap. We developed the diagnostic equipment, and we have set up clinics in India and across the world.
All right. Interesting space there, Rajneesh. But in terms of this funding, what will be the priority for deploying this money? I mean, could you give us specifically how you're going to utilize it?
Correct. So we would be expanding in India and outside India. So 500 clinics in India and about 200 clinics outside India. And with that, we also will be getting the regulatory approvals in US, which is the next frontier for us, and also expanding to other lifestyle diseases like diabetes and migraine.
Okay. And just to be clear,